Good morning, everyone, and welcome to the Traders Corner Investor Summit Stock and Options Special Event. My name is Anthony Chapman, and I'll be your host today. Thank you for joining us. The current trading environment is absolutely ripe with opportunity. Inflation remains a major market driver. Interest rates uncertainty continues to create volatility. Global events are impacting commodities and energy markets, and also AI and tech stocks are making a correction. Traders across stocks, options, and futures are finding opportunities every day. That's the good news. We got to keep looking. The key question is what's working right now? That's exactly what today's event is all about. We've assembled a panel of amazingly great 8 professional traders and market experts who will be sharing unique strategies, tools, and techniques that they are using in today's market environment, and they want to share them with you. Before we get started, I want to remind everyone about our special giveaway sponsored by Prop Shop Trader. We'll be giving away $100,000 in prop trading accounts today. 4 lucky winners will receive a free $25,000 prop trading account. The drawing will take place at the conclusion of today's event. So be sure to register using the giveaway registration link, and I'll continue posting the link in the chat box throughout the day. So yeah, what I'm going to try to do is I'm going to try to go back to what we did the first time, and you got to remain for the entire duration, and just give me like a thumbs up, and I know that you're there because I felt like it was a little bit more interactive and people enjoyed that a little bit better than when we didn't make it until the end, and people were able to just say that they were there or whatever. And so, all right, so I'm going to be working on that. And first up, we have a great presenter from a great company. Uh, our first presenter is a longtime market analyst, options trader, and the founder of Big Trends. Price Headley has spent decades helping traders identify high probability opportunities using disciplined option strategies and technical analysis. Today, Price will reveal a unique approach he calls how Nifty 50 options have been stacking 500-buck winners. You'll discover how he uses a focused watch list of just 50 stocks, targets same week options opportunities, and structures trades designed to pursue 50% returns in less than 24 hours. If you're looking for a streamlined options approach that doesn't require monitoring hundreds of stocks, you're going to enjoy this presentation. I'm sure I will. So please join me in welcoming Price Headley of Big Trends.
Oh, well, thank you so much, Anthony, and great to kick things off today. Good morning, everybody. Like Anthony said, I mean, the markets are presenting lots of opportunities, lots of volatility. Of course, you got to know which way to look, right? You got to know which way things are setting up for your strategy. You got to know also, of course, how to manage your risk, of course, because there is volatility. Even with the Micron earnings overnight, everybody was raving last night about how great that was going to be for the markets. And after a gap up, we gave back at one point more than all those gains in the NASDAQ, and then now kind of grinding back up a little bit to a slight positive. But the point is, there's plenty of movement, right? So the question is, how do you get focused on the right kind of strategy? And for us at Big Trends, we look at a variety of edges. How do we create edges? But one of the greatest things that's come out is short-term options. And in this case, we're looking at options that are trading every single week, but we only trade them getting in on a Thursday afternoon, hopping in Thursday afternoon to pop them up for the next day right before their expiration. And so we hop in and out within 24 hours without ever having a day trade with this strategy. We call it Nifty 50 options. We're looking for 50% quick strike winners. We're not trying to get doubles, triples, quadruples with this strategy because you're just looking for that quick pop opportunity. But it is one of those that, it's a lot easier to get 50% gains more frequently than shooting for the triple digit ones that won't come around as often as you would like. So that's something we're going to talk about, the directional movement lines, a DMI indicator with a unique price action pattern setup. Let's get into it. A lot to cover with you as I kick things off today. And so remember, the information shared with you in today's presentation, it's based on our proprietary research. It's intended for illustrative purposes only. What we talk about here should not be considered specific advisory recommendations. Of course, that stock and options trading have large central rewards. Let's face it, they've also got large central risk. You've got to manage that risk always. We'll talk about both sides of the coin, how we manage winners and stop outs today. Remember, the past performance of any trading system or method is not necessarily indicative of its future results. So see our terms of use on our bigtrends.com homepage for more information. If you don't know me, I've been trading options for 37 years and counting. Caught the trading bug while I was a student at Duke University back in the late 1980s, and then launched bigtrends.com actually in the late 90s and 99. So now in our 27th year serving our Big Trends community. blessed to kind of guide people about how to be systematic. No matter how much experience you have, you can't let your ego take over. You've always got to be trading market structure. I'm going to share with you the structure of Nifty 50 quick 50% winners that we look for in 24 hours or less. So we'll walk you through how this looks. And frankly, it was a great time to talk about the strategy because when Anthony said they're doing an event here on a Thursday, I was like, great, I can talk about it Thursday because get ready. We'll have trades this afternoon with a strategy each and every Thursday afternoon to pop them into the following trading day. Show you a bunch of success stories when it works, also how we manage stops and learn this Nifty 50 option strategy in more detail. Now, you've probably heard about probably one of the hotter trends out there in options trading, zero DTE options, 0 days expiration. We're not doing quite that. We're doing 1 DTE. We're not trying to trade them on this strategy on the day they're going to expire, but we hop in the prior day. A couple of nice things about the prior day technique is that if you buy them a day before, is that that if you're going to close them out the next day, you never have a day trade. Now, you probably heard the pattern day trader rule has been abolished and eliminated, but of course, some of the brokers are going to take some time to get that implemented. That means you can trade in and out same day, basically without any restriction once whatever brokerage company you use has that implemented. But in this case, you don't have to worry about day trades, right? We're in one day, out the next, but you're also not exposed to the market that long that way. You're able to hop in and out quickly, and it's all about just looking for the right setups. But of course, what the benefits are as you get closer and closer to expiration, sure, there's more risk as you get closer to expiration, but there's also a lot more reward, and you're paying for a lot less time premium. So basically, then it truly becomes a question of, do you have a good system, a good methodology to put the odds in your favor that you'll be right more than wrong, that you'll be getting the direction of the move working for you. And we're directional traders generally at Big Trends. We find that our methods give us enough of an edge that we can benefit from trends being factored into our options trading. So that's what we're all about here. And so Nifty 50 is using those 1 day sell expiration options. And here's what we're doing. We're looking at a quality list of blue chips, 50 stock blue chip focus list. So the 50 stocks within the Nifty 50 program. We're entering the trades at 3:30 p.m. on Thursday. So this afternoon, 3:30 p.m. Why do we get in at 3:30 p.m.? Well, we're looking at daily charts. You'll see it. We'll show you a bunch of charts here today, but the idea is that we're looking at how are things positioning as we get near the end of the day. If you look at a daily chart in the morning and then you make an action thinking that the daily chart's breaking out in the morning and then it flips on you before the end of the day, guess what? You may get faked out if you're too early, too premature on that. We don't want to be too early on that. We can have actually up to 4 new trade signals each and every Thursday afternoon. I'd usually expect more like a couple of trade signals on average, but we could get up to 4. We could have 1, but the idea is that we're looking for usually a couple trades a week on average with this strategy, and we'll get out the next trading day on Friday at 1:30 p.m. Why don't we take it to the end of the day? We're trying to give you plenty of time as a subscriber to make sure you got time to hop on out before we would get to the expiration at 4 p.m. on that Friday afternoon, right? So the idea here is that we'll be in these trades a maximum of 21 hours when you break it down that way. Actually, I say 22 hours from 3:30 the prior day to 1:30 the next day at most. And of course, if we get our 50% profit target, we take the money and run before that. We also use a 50% price stop. And then we're looking to be right meaningfully more than we're wrong. Okay, so that's how we let this thing work for us over time. Less than 24-hour hold, but never a day trade. Using price action patterns, I'll show you, along with these same week options that become, like I said, 1 DTE, 1 day to expiration when we pop in on a Thursday. We've had some months where we've had as many as 14 new trades. But like I said, 8 to 10 new trades a month is probably more in line with the averages. Let's start by looking at a recent winning trade example. So here we go. Just about a month ago, May 28th, we bought into calls on Uber. Now, like I said, these are daily chart patterns that we look at. Okay, so we're looking at daily candle setups here. As you know, a candlestick, most of you should know that, but if you don't, of course, what the white open bodies mean we close above where we open that are painted in green there. The red candles, of course, are where we close below where we open. So part of what we're looking for with our pattern here, when we get into the Thursday afternoon setup here, is we're looking here at a situation in which we're looking for, and I should say these are, I was going to say, I said daily, these are hourly charts, pardon me on that, because we're looking at hour by hour, because we're looking at how are things shaping up into the final hour of the trading day. So we do want to see the setup into the final hour. And the thought being here that, look, we're focusing on what is the consolidation that's happening here with a lower high, higher low, and getting a positive close on that particular candle. So when you see a pause, a consolidation, most people kind of lose interest when it pauses. Most people think, I just want to trade breakouts. But the idea here is that, you know what, when it starts to move, but then it actually shows you that we're getting a pause here, that's actually setting us up, we think, for a nice positive kick back up here. Okay, so we like to see that little pause that refreshes. And in this case, the DMI lines are shown on the bottom panel, but we're actually not using DMIs on the bullish patterns. We're only looking at the DMIs on the bearish pattern. So usually you see the negative DMI says that we're above the positive. That usually implies a negative trend. But actually, we've noticed on bull trends that if we've been moving up like this, and then we get that pause factor, we actually want to take advantage of it with a call trade late on a Thursday. So this one, you see Uber trading in the neighborhood here of about 70.7. So when you say, okay, it's at 70.7, what do? What do you buy? Well, when we're trading them with the day to go before expiration, we generally like to buy them a little bit in the money. We can't always get that if it's a higher dollar stock, but we're measuring it relative to that stock's recent volatility. We look at something called average true range. You probably heard of ATR, where it looks at recent high lows, factoring in gaps as well, and says, okay, here's how much Uber's been moving. This is the right type of option to buy to get a quick 50% pop or better. So remember, if we're buying a 69 call, the stock's 70.7, that thing's worth about $1.70 intrinsically. You've got a right to own the stock at 69. That's what a call gives you when you buy it. You could buy the stock at 69. You could theoretically exercise it at the current price of 70.7. We're not doing that, but you could pocket that 170. We don't do that because, of course, you're going to pay a little bit of time premium. In this case, only 29 cents out of your almost $2 option. So maybe, what, 15% of the option is time risk. If the stock flat lines into the next day, you're only losing that time value by the end of the next afternoon. Of course, we'll be out by 1:30, if not earlier. But here's the key. Look what happens the next morning. On that Friday morning, the stock opens a little bit lower, and you see it actually spikes down. I put a V on that first little interbar spike on that Friday morning. So there was a time in this trade where we were not right. That can happen. So a big part of the aha moment here is that a lot of people say, well, if you're targeting a 50% gain, you probably should put your stop at maybe half of that. We don't think that's the right approach here. If you put a 25% stop, you'll get taken out on a quick snap against you like that, and you'll get left on the sidelines down 25% when you've got a number of those that will reverse back in your favor. We feel that the 50% stop is much better at giving you enough wiggle room and therefore enough staying power to hang with trends that generally should work more often than not based on our analysis. So the idea here is that how do you give yourself enough wiggle room, but also not be too greedy, not be too overly optimistic to shoot for too much on the upside and then leave profit opportunities on the table. Obviously, one way to boost your win rate is to take your profits reasonably faster. Now, we don't want to take too small of a profit. But we find that the 50% win, having a one-to-one reward to risk works if you've got a higher win rate compared to lose rate, right? So the idea here is that, okay, we buy them for about just under $2. You know the math, right? If you paid $2, you'd be targeting a pop up to $3 as your 50% profit, and of course your stop 50% down off of $2 would be $1, right? So that's roughly speaking what we're shooting for here. And you see we do close it out there as the stock pops up here to almost $72, actually slightly above 72, into that 11:30 third hourly candle on that Friday, May 29th. So look what happens. We're basically saying, okay, we take that 50% gain and we say, book them, Dano, take the money and run. That's another winner you've popped into your portfolio with a 50% gain. Of course, if you're putting in, say, 1,000, or actually in this case, we're saying $2,000 allocated per trade, that would get you, in this case, you can see 10 contracts for 1990, right? Pretty full allocation there. You're trying to go ahead and make a 50% gain. 2,000 turns into 3,000. and you're on your 10 lot and you're making $1,010 before commissions. Commissions, of course, come way down. They're now anywhere from $1 to even a half of $1 a contract per side. So you're keeping the vast majority of what you earn, much better than when I got started in options, started trading options in 1990, and they had ticket charges and much higher rates. So great time now, better than ever to be an options trader. Um, and so you see 50% gained off of basically in on that Thursday afternoon, out on that Friday late morning. Okay, so we're only that trade in market hours, what, for basically 5 hourly candles there. So less than 5 hours we're in that trade in market time. So you get the idea of, okay, we want to rinse and repeat that as much as we can, right? The more you can do that and be able to just say, okay, have the odds in your favor, know that you will get times where you get stopped. And then otherwise, if neither the 50% gain or the 50% price stop hits, we time stop it out at 1:30 on that Friday. Now, we do send out real-time email alerts, and you also you can get real-time text alerts as well. So it makes your life a lot easier to say, okay, you know exactly when to get in, exactly when to get out based on these set rules. Of course, we're trading a lot of blue chips, including Dow Industrials names like JP Morgan, Morgan's, let's say Microsoft and McDonald's to go with, of course, a Lowe's Home Improvement, AMD. You know, the chip stocks have been bonkers, blasting to the upside with the Micron news, obviously volatile here today. But then some other names that maybe you're not as familiar with, like a Shopify, which actually is a pretty big e-commerce player, not to mention tobacco stock, Philip Morris, Caterpillar, and Disney, also Dow stocks, but also in different sectors that are not necessarily tech, right? Most people are so AI focused and tech focused that they're missing that. I don't know if you've been watching, but the Russell 2000 has been outperforming the S&P and the Nasdaq lately, right? We're getting rotation into non-tech areas. You need to be diversified and not just all in on tech and AI. Okay, so even a name like Southern Company, kind of a utility base, but now benefiting from some of this power generation AI story. But you see a Dow Chemical, an Airbnb, Analog Devices is tech. NVIDIA, of course, is the big daddy of them all, a tech chip stock leader, and 3M, DocuSign, and more. American Express, Qualcomm, Intuit, parent company of QuickBooks. I mean, the point is that we've got a variety of sectors, a variety of stories going on across pretty much every key element of the economy, and plenty more that makes up our key 50 stock list. When you become a subscriber, you get our full 50 stock focus list. Now, new trades, like I said, can trigger at 3:30 p.m. on Thursday. So we expect new trades this afternoon at 3:30. So we wanted to get you taking advantage of that. We've got a super special to try it out for a short period and get comfortable with it. So you'll want to stick with it. But the idea here is that this also makes you incredibly time efficient. I don't know about you, but everybody talks about money is a scarce resource, but you know what? Time is the other scarce resource, right? We've got to optimize our time. And the beauty is that when we do that, we can really get a lot of great return, not just on our investment, but on the time, minimal time we commit, just once per week, looking for these trades to hit your email box and your text alerts at 3:30 p.m., give or take a couple minutes. So you got enough time to get in before the 4 o'clock bell rings on Wall Street. So the idea here is that we're going to use same week options that they're in their final day before they expire the next trading afternoon on that Friday. So you say, okay, that's not giving yourself a lot of runway, but the idea is that it's all about a price structure pattern that puts the odds in your favor over a longer sample of trades, right? You don't want to just grade any system off of how you do on your next trade. So I always tell new subscribers coming in, I'd rather see you trade small at first, give you enough time to get comfortable, and then you can scale up once you see that you can execute the system consistently and not expect any one trade to make or break you, right? It's about just rinse and repeat over a lot of samples. That actually is what puts the probabilities in your favor, okay? So this is a quick swing trade. So it's not a day trade. It's not a full week hold. It's basically in one afternoon, out the next. So low time commitment means you don't have to sit there screen watching all day. You know exactly what to do too when you get filled, placing your 50% price target, your 50% stop loss, and then letting that play out until 1:30, time stop it if neither one of those hits. And we'll remind you with all this with follow-ups as well. So the bull trade I showed you before is a price action contraction pattern, a consolidation, what we call an inside day, lower high, higher low. kind of a pause that can refresh those trades. For bear trades, we kind of look for the opposite. We're looking for a flip, a hard reversal type of a setup here where you can get what looked like a breakout up, then it rips back down, and then it says that we are indeed trending down. We also say it doesn't just look for any old stock that does this. It's got to show that that stock, if you traded it over typically the last decade, or we have a decade or more of data, how has it done over the last 10 years? What that means is that you're going to factor in things like the COVID era in 2020. You're going to factor in the 2022 bear market phase. You're going to factor in the recent bull market phase. You're going to look at a lot of different types of environments and say, how has that stock done with this pattern over a large sample of environments? That's important. And when you get the profit factor in your favor, that means you're not just looking at how your win rate is, you're also looking at how much you can size of win versus hopefully smaller size of loss. Now, I don't give away all the settings here, all the parameters, but when you become a subscriber, even with our special short-term trial, you can try it out. That basically you get all the settings, you learn the system, you learn how it works. So we're big believers in education and learning, helping lead to more earning power for you as well. Let's look at some more chart examples to kind of help visualize. I mentioned Morgan Stanley is on the list as well. MS. So here we go. This was on that same day that we did Uber. Okay, so just showing you how you will get multiple trades a number of weeks, right? And so the idea is that we're not going to give you too many at once, right? We want to get you the appropriate leverage. But here you go. Morgan Stanley has been trending up. And then you see as we come into that Thursday afternoon, slightly higher low, slightly lower high with the positive finish on that late day Thursday afternoon, 3:30 final full hour count. That last half hour, 3:30 to 4, you will get another candle there, but it's kind of not quite as telling in our view as the full hour candle from 2:30 to 3:30. So closing at 3:30, we've got our buy signal. Look at where Morgan's trading at that point, up around 204. Okay, now here's an example because it's a higher dollar stock. Remember, if you bought 100 shares of Morgan, you would MS would cost you over 20 grand, $20,400 at that point. We're controlling that $20,400 of stock for just $248 on average in this entry here. So about $2.50, and so you see here that we buy a 202.5 strike call. So that's about $1.50 in the money. So well, that one's got a little bit more time value as a percentage of the stock, of the option price, I should say. About $2.50, we're paying about $1. That's about 40% of your total premium is theoretical time risk. Why will we do that with just a day to go before the expiration? In this case, just over 24 hours later. Well, because Morgan doesn't have to make a big move to have us to get a 50% gain, right? What do we need? We need about 375. And you add that on top of your 202.5 strike means we need to move to about 206.25. You see what happens here is that the very next morning, second hour into the trading day, it pops beyond 206.25 all the way up to almost 208, and we're locking in our 375. We're locking in our slightly more than 50% gain. And again, putting in $2,000 would have got us in this case 8 contracts for just under $2,000 full investment. And then we're closing all 8 of those out when you're making $127 per contract times 8, right? So you see that's just over $1,000 of total profit gross in the trade. And again, whatever happens after that, I don't care. Take the money and run is really a big key theme of this strategy here. So locking down that 50% win is a great one. Here's some Mickey D's. I'm loving it. We were loving it. Subscribers were loving it on this case. Well, here's a unique pattern that was the prior month in late April, where you see, well, gee, we got a consolidation pause with a positive upturn right near the end of the day after the stock had pulled back. You say, why would you buy there? Well, because our data says that when you can do that with McDonald's on those Thursday afternoons, it's usually due for a snap back up. In this case, stock is about 314.5. We're buying a 310 strike call. Remember, 100 shares of Mickey D's cost you over 31 grand. We're controlling that for $580. This is a little bit safer in the money play here, where we're buying it's all relative safety, right? I mean, every trade you do has risk, right? If the stock tanks against you the next day, you could lose what you put into it if you don't have a stop loss plan. That's why we say put a 50% stop in to have a reasonable enough uncle point, but not get whipsawed by too tight of a stop. And so you see in this case, look what happens. This stock starts to, it's about 314.5. We buy a 310 call. It's about $4.50 in the money. We pay about $1.30 of time. So we're paying just over 20% time risk, no, not quite 25% time. And look what happens. The next morning on that Friday, it not only gaps open, but briefly trades as high as 321 and change, right? So these options got up as high as about a double. They were worth just over 11 and a half. We didn't get the double. We took it out actually at 11. Okay, it was a little better than what we expected, right? We made 89%. So happy to get that positive windfall right off of the open. We will send reminders to you like, hey, we've got our orders working here at just under $9, but we get felt better than that as it opens up even above that and quickly snaps up above that to pop us out for a better than expected. What would that be? Per contract, you can see a $1,560 gain, and we didn't even get our full 2,000 in, right? We would have gotten 3 contracts in here for in the neighborhood of about $1,740, right? So happy to lock that down at a positive windfall. That can happen, right? It can gap past where you expect it. Here's another one you see with the big gap. This is Airbnb. Mid-April, you can see that we bought the 135 calls as we got that nice little snap back up here. Again, it's still a consolidation window here, right? Consolidation means lower high but higher low. It's a pause. It's refreshing. After the prior rally, it had that little pullback on that Thursday, but starting to stabilize into the end of the day and say, look, stock's about 137 and a half here. We're buying 135 calls, about $2.50 in the money, paying 310. So we're paying 60 cents a time, just under 20% time risk. So remember, you've always got price risk, but you want to control where you don't lose a lot of time value if you get stuck in a sideways pattern into that final day. In this case, we didn't get stuck into that. We got the gap up. It gapped up actually right when it gapped open, we were out at our 50% profit target. Bought 3 contracts for $930. If you put in $1,000, of course, in this case, putting $2,000, you're taking down a $930 winner on an $1,860 total investment on 6 contracts if you're putting in 2,000, right? It's the beauty of trading, and options trading in particular, is it's totally scalable, right? Whether you're trading 1 contract, whether you're trading 10 plus, the idea is that you want to have a game plan to follow through on exactly what you need to do risk versus reward wise, right? So that was Airbnb. Here's another one with DocuSign. Again, another example where it stabilized here for us, March 20th entry, getting that pause that refreshes, a little bit lower high, a little bit of a flat line low, but holding kind of into our pattern there. So we get into the close of that 330 point there with stocks up just under 85. Find an 82 and a half strike call. Again, it's about 60 or 70 cents in the money, about 20% time risk. We're paying 310. And again, that look what happens. Intraday, that next morning, it gaps lower and then trades as low as about 83.6. Guess what? Those things were only worth like $1.10 intrinsically. You say, well, is it trading at $1.10 on that Friday morning? No, it's still got probably another 60 or 70 cents on that, and in time value, it'll still hold as it pulls back closer to the strike price in that Friday morning. So it's one of those things where we might have been down at 1.30 or 33% on that option, but we didn't get down 50, right? So again, I remind new subscribers coming in, don't get cute and say, oh, I'll cut my risk in half by doing a 25% stop instead of a 50. That's a mistake. That's not following the system and the way the system is configured to help you put the odds in your favor. So again, if you put in this case, 6 contracts get you in for $1,860 on a $2,000 cap, you would make $930. The next midpoint of the trading day, just after noon, before we hit to our 130 time stop, stock got up to about 87 and a half, right? An 82 and a half call at 87 and a half is worth $5, right? We're out of 465. So we take the money and run. Now, what about put trades? Let's show you the put setup here. So what we're looking at here on a Thursday is that we want to see an example here where, in this case, Roblox showed that it was actually looking like it was making a range expansion, but in a downtrend where the DMI lines, this is the directional movement lines. Let me show you what the DMI lines represent. The negative DMI line on the bottom panel here is in red. It means that, have you made lower lows recently? Well, yeah, obviously you can see a lot of lower lows on Roblox, okay? Have you made many higher highs recently? Not so much, right? You can see it's been making lower highs. So that green line, the positive direction movement, says how many new highs have you been making? Less and less. What happens is that, of course, that becomes a guide for you of saying who's winning the war between the bulls and the bears. I use the DMI lines all the time, not just in this method, but even in other short-term trading methods, just to show me who's got the ball, who's leading the charge, who's playing offense right now. In this case, the bulls are on their heels. They're on defense, right? They're basically losing the war on a short-term basis here. And so this bounce doesn't concern us that as an opportunity to say, is it now a bounce that sets a bottom in place? As you may know, a lot of times in bearish markets, some of the biggest moves happen on these short covering rallies, on these 1 or 2 bar bounces, where you get these quick little snaps to test the bearish result. As long as the DMI lines here don't flip, right? In this case, the DMI lines are staying net negative, even though they've converged into each other a little bit. As long as that red line stays above that green line, we say that's still a bearish trend. So we actually buy puts there because you make this range expansion, right? So let's talk about what the range expansion is here. Let me just show you that, yeah, what we're looking at here is that you made the lower low right there, lower low, and obviously a much higher high here, right, versus the prior hour, right? We're just looking against the prior hour. And so the key is that that range expansion says, yes, into that close there, stock's about just under 57 and a half. We're buying around 57 and a half. We're buying a 60 strike put. What's that worth? Remember, a put option gives you the right to sell the stock at the strike price of 60 in this example. So if it's at 57 and a half, it's already worth $2.50, and we're only paying 263. So we're paying virtually almost nothing. You can see what we're paying, maybe 13 cents out of our 263, maybe about in this case maybe like 5% maximum of time value that we're incurring in this trade. 95% of our premium is intrinsic value. That gives you incredible stability to say if it flatlines on you, you're not going to be risking much, and also means you're not going to be getting shaken out as easily, right? The time premium, if you overpay for time, a lot of time premium coming close to the expiration, you can get shaken out really easily on even a 50% stop, right? So we want to say we want to have that staying power to hang with it. Now, what do we need? We need it to go up in the neighborhood of just over 390 to 395 or so to pop to our 50% price target. What does that mean? It needs that from a 60 strike put, it needs to be worth down around 56, it's worth around $4. We can see we need it to get around 56. Look at that. That next first hour, that next Friday morning, it pops to 55.16, right? So during that bar, we're getting out around $4, actually officially 405, and we're saying take the money and run. Look what happens if we weren't proactive. Look, it's going into later in the session, and then it's popping back up to almost 57. This thing's worth about $3 near the end of the day. We popped it out at $4 and took the 50% or 54% gain, actually, $994 profit on up to $2,000 investment, right? Which would get you about 7 contracts here. So the idea of this, I should say, would yeah, that basically what you're looking at is how can we rinse and repeat this, and also be proactive. Get those price target orders working and stop orders working once you get filled on your trade. It's really simple. Once you know what your entry price is, just put a 50% of that above that profit target and half of that below as your stop loss. And you can actually, and a lot of brokers have both those orders working simultaneously. It's called an OCO, one cancels other order. We help new traders come in with that all the time. So here's an example on another name, C Corp. You see C Corp had gone from net positive on that Wednesday to going to net negative. You know, when we're getting the negative crossing above the positive, the bears are taking the ball back. And then you see what happens. Whether it closes higher or lower there, we just want to see that there's that range expansion, the higher high, the lower low, to say that there's some greater volatility starting to set up here. So this is where C Corp's trading down here near $80. We're buying an 82 strike put that's going to expire the following trading afternoon. We're buying those about 2 points in the money. We're paying 231. So 31 cents or so a time means we've got, in this case, just under 15% of our total investment is time risk. What do we need to happen? It needs to go from 231 up to about 3.5. And so you see here that at 3.5 on an 82 strike put means it's got to get down in the neighborhood of about 78.5. You see what happens by that second bar. We're out. It gets to about 78.25, and we're locking it down at 3.5, taking that 51% gain, $952 generated for up to $2,000 investment on this one, right? So the idea is, okay, rinse and repeat. But in the bearish ones, we've got to have that directional movement line telling us that we've got the bear trend on our side, right? Bearish trades require that little bit of extra filtering. That's important for us. Of course, not every trade is going to hit a 50% price target and or 50% stop loss. Some of them just end up being a little less volatile. That when that happens, here's C Corp the other way to the upside. Like so, some names we will like to trade both directions. Some other key names we might only trade long or only trade on the downside, depending on what their history says. So in this case, C Corp calls. Remember, the call setup is lower high, higher low, right? It's marginally lower high, but a lot higher low, right? So we're getting in there, and you see we endure a little bit of volatility into the close and into that next morning. So this is the power of having some cushion via the intrinsic value here. So it was trading around 126.8. We'll call it 126 and 3/4. We're buying a 124 call. It's worth about 2 3/4 in the money, and we're only paying 312. Right? So for every $1,000 you do, you get 3 contracts. If you're doing $2,000 worth, you get 6 contracts in for like $1,872. And so you see that, okay, in this case, it's worth 2 3/4. You're only paying about 37 cents of time, just about what, maybe 12% of time value in that trade. So this is the power of enduring a pullback the next morning down to about 126. Right? So we're wrong by not quite, but close to a point on the stock. In theory, at 126, it's got at least $2 intrinsic. Obviously, our stop's down there around a buck 55, buck 56, half of what we invested. That would imply, later in the day at 125.5, we'd have a problem. But early in the day, little pullback like that, it's not going to get that close to our stop. We might be down 25 to 30%, but that's not a worry. We hang in there, it snaps back up, and we're in this case by 130 saying we just missed. What was the high of this one? It was like 128.4. That thing would be worth like 4.4 at best, and we needed what, like 4.6. So we didn't quite get there, and then when it rolls over, we end up taking the 20% gain, $378 profit, stock finishing around 127.8, right? So it's worth like 3.75, right? There it is. So the point is that, okay, they're not all going to get to your target. It's part of the game. They're not going to, some of them won't get to either a target or a stop. But here's one that did get to the stop. Remember, the stop is 50% loss. So in this case, look, we bought the Qualcomm calls. We thought that our data said that, hey, we're getting stabilization on this chip leader. Just announced some other big news late yesterday. Got a nice pop on. But the idea is that, look, it's trading near 190, right? This is a very in the money situation, right? We're buying a 182.5 strike call. In this case, you're going to get a lot less contracts for $2,000 worth. You only get 2 contracts at just under $800, $795 a piece. But remember, that's still got good leverage because you're controlling about 19 grand worth of stock with a stock at 190 for $795. So you can see we're buying it just around that $8 level. Means our stop's down around $4. And you can see in this case, we got close to our price stop, but our 130 time stop hits, takes us out at almost that price stop level, 47% loss, right? So in this case, not thrilled about it, right? It got off to a good start right after we got in, but we didn't get up to our profit target, unfortunately, right? Maybe got up to worth about $10 or so intrinsically. Might have been trading as high as 11. We needed like 12, just close with no cigar, and then stopped out the next afternoon. Take that loss, and you just say take the money and get back, salvage what you can, and get back on to the next trade. But also, one of the benefits of buying options, in my view, having done it now for 37 years, is that you can get bigger winners relative to your risk, right? That's always a big attraction of buying options. And so when you get gaps like that past your target, it's awfully nice. This is Upstart, UPST. It's trending up. We're getting that still a little pause, even though it looks like a nice uptrend on the chart, right? You're getting that 1 bar consolidation with a positive close, right? So the idea is that, okay, this is healthy. It's a consolidation that says, yeah, this thing still has potentially more to go to the upside. Stock finishes that 330 window around 32.4. We're buying a 31.5 strike call. It's got about 90 cents intrinsic value. We're only paying a buck 07, right? So about 17 cents of that 107 is time risk. That's what, like right around 15, 16% time risk. And then you're saying, okay, guess what? It snaps up the next morning. There's the open the next morning up just under 34 bucks, right? At 34, it'd be worth like 2.5, right? We're out at 235, right? As they go deeper in the money, right, you will see your time value start to go away on that final morning of the expiration that afternoon. Still, 107 turns to 235. That's just 119%, more than double what our 50% price target was. I would say thanks for that windfall profit, right? If you got in 2,000 bucks invested, that's getting you in the neighborhood of about 18 contracts that you're ripping for more than twice of what you expected. And so, okay, instead of making 1,000 on 2,000, we're making 2,300 on up to 2,000 for that 119% outlier, right? That's not going to happen that often, but it can happen. And of course, people love those when they do double plus. But hey, 50% winners is the same result as 100% winner. So the question is, okay, yeah, you got to trade 2 times as much theoretically, but the idea is that it's easier to get to that 50% target than to wait for the 100%. And sometimes you're waiting for the 100, you're sitting at 50, and then the 50 disappears on you, right? So that bird in the hand beats the 2 in the bush. So I mentioned a trial offer since I only have a few minutes left before our next fellow trader and speaker comes in, and definitely encourage you to stick around for all of them. There's tons to learn in trading, lots of ways that you can make money in the markets, and always know how to manage your risk in any strategy. 3 months, I think, is an appropriate time to consider a legitimate trial to say you've seen a variety of market conditions, you've seen a variety of setups, and seen enough to say, okay, can this work for me as well? I'm confident that you'll be very pleased after 3 months, and all subscribers, once you come in on the 3 month, will get our best renewal rates after 90 days. So what we set up for you is that you get the same benefits as a longer term subscriber. You get the settings and rule sheet. You learn the system over the coming 90 days. This is going to help you basically position for pretty much all the third quarter and position to take advantage. As you know, third quarter summer season can get choppy. This is a great strategy to take advantage of quick strike, kind of chop up, chop down, basically quick snapbacks, lock it down, get back to the sidelines. I think that's why I wanted you to be positioned for the summer season and helping you as we move into late September into the trial period. Okay, so the idea here is that you also get access to my email, to my analyst team with via dedicated email if you've ever had a question on the system, right? So you learn it from us. I give you weekly video training as well. If you're buying off my website, you pay 197 bucks a month. Over the next 3 months, you'd have been in for just under 600 bucks. But I'm giving you today for basically 2/3 off. I'm going to take it down from 591 to just 177 bucks. The reason I did that is I was thinking, well, what's the value if you get one winning trade? Obviously, you can make many multiples of that 177 on a 50% winner with the Nifty 50 options program. So basically, what we've done is set up this super savings offer for you. It's already set up on this page here at bigtrends.com/50. Now, when you go to that page, I just want to show you what that looks like. It's really simple. We don't put a lot of text and talking it up there. We're like, by the time you get to this page, you know what you need to do. You need to lock it down. Of course, we take all the major credit cards, or if you want to save a whole lot of typing, if you put in your payment info there, you got to type it in. You can also click through the PayPal. Either way, you've got to review our terms and conditions on how we do business now in our 27th year, agree to that. And then if you type it all in there, you hit the green complete your purchase, or you can click the PayPal link without typing anything else in. It'll securely route you to PayPal, log in, choose your money source, and you've just locked in the next 90 days for less than $2 a day, 177 bucks. So if you got any questions, you can call us toll free at our 800 Big Trends number. It's at the top right of that page. 800 Big Trends is all you need to remember, or email us clientcare@bigtrends.com. Quick FAQs. It's simple. It's buying a call when we're bullish, buying a put when we're bearish. Average entry price per contract in the last year has been just under 300 bucks, 299 bucks a contract, right? So if you're putting in $1,000 worth, that would get you in for 3 contracts, 2,000 bucks an average of about 6 contracts. We only get the new trades out right around 3:30 p.m. on Thursday, so we're ready for a new batch of trades to come out here in a matter of about What is that? Maybe 4.25 hours. So be ready, take advantage of that, get signed up before we send our next batch of trades here in a few hours. Never a day trade, right? We're getting in late one day to be out by the next afternoon at 1:30 at the latest. Real-time emails, as well as you can get set up for the text alerts, which I do recommend. We'll never carry more than 4 trades open at once. Of course, we clean them out by the next day, and then we're back to the sidelines until the next Thursday. We'll always be out by Friday at 1:30 p.m. Eastern, and then you get all the educational resources with it, settings and rules. I'm even throwing in a special strategy session I did for all subscribers where I teach you the system. I go deeper on why the rules are the way they are, why we do what we do, and then access to me and my research team anytime you've got a question. Like I said, one trade like the Uber winner we showed you from just a month ago easily carries you, right? I mean, the idea is that there's the Uber by $199. If you're putting in 2,000 bucks worth, we said that made you 1,000. Even if you're putting 1,000 bucks worth, that would get you what, 3 contracts in, and that is, as we said here, it can make you, actually, get you 5 contracts in and make you 500 bucks. That would more than pay for your 177 trial on just one single trade. So like I said, 3 months with all the learn while you earn resources, yours today for only $177 at bigtrends.com/50. I'm out of time. Need to hand it back over to Anthony. Thanks, Anthony, for letting me kick off your great event here today. And folks, stick around for lots more great fellow education from fellow traders and great presenters. Back to you, Anthony.
Hey, thank you so much, Price. Be sure to
My
check out
pleasure.
the offer. Yeah, thank you. Check out the offer at bigtrends.com/50. That's 50 with an F, Fifty. So that's Price's offer there. Take advantage of it. They're kicking butt. So that's bigtrends.com/50 with an F. Spell that out. Thank you, Price. That was an outstanding presentation and a great example of how focus and discipline can simplify options trading while creating opportunities in today's market. We appreciate your valuable information, generous offer, and your time with us today. I've placed Price's special offer link in the chat box. And don't forget, we'll be giving away for free $25,000 prop trading accounts, courtesy of Prop Shop Trader at the end of today's event. And be sure to check that link out. It's a Survey Monkey, just a little survey thing. Put your email in there, and then be ready to play at the end of the day. Next up is a future trader with more than 2 decades of experience, Tim Receipt of eMiniMind. Tim Receipt is a 20-year trading veteran who learned from some of Chicago's top professional traders before founding eMiniMind. Today he'll be sharing 2 simple strategies. Today will be two simple strategies for day trading of the E-mini futures. And let me make Tim our presenter. And during this session, Tim will show you two easy to execute trading strategies, so 2 different ones, where he places entry, stops, and targets in a powerful psychology technique that can help traders improve consistency and execution. So everyone, please welcome Tim Receipt. Is it Receipt or Rossetti?
Reset.
Reset, yeah.
Awesome. Thanks, Anthony. Appreciate the introduction. Welcome. Thanks for having me. If you're ready to go, I can be ready to go.
Yeah, it's all yours. I'll make you an organizer so you can see the questions as well.
Okay.
I think we ran out of time last time for questions, but yeah, it's all yours.
Thanks for tuning in, everyone. As Anthony said, you do have the ability to ask questions. I'll try to keep my eye on that question box as we go, try to answer your questions throughout the presentation. So we've got about 45 minutes, and we're going to talk specifically here about 2 strategies that I use to day trade the E-mini futures markets. We'll also get into a little bit of trading psychology that, in my view, is more important than the actual execution part. So even if you already have a strategy, or you want to take bits and pieces of some of the things that you might learn today, applying the trading mindset portion or the trading psychology pieces, you'll find that I think you'll find that really, really helpful. So as Anthony said, I blog over at eMiniMind, and as the name implies, the mindset piece is a big part of what I focus on in my trading. So for those that are unfamiliar with myself, I've been trading since about 2005, 2006, and I spend a lot of time getting outdoors as best as I can, getting away from the trading screen, and that really helps me focus when I'm in front of the trading screen. So just a couple of photos of myself and some of the things I like to do, hiking and mountain biking and things like that. I grew up in the Chicagoland area, and so I had a lot of access to traders. I spent some time down at the Chicago Board of Trade. Was kind of in the um, up and coming period when guys like Tom Sosnoff and Don Kaufman, and guys that were I say guys, mostly guys that were around the Thinkorswim kind of development in the early 2000s. And there were a couple gals down on the trading floor that I got to know, and a lot of the folks down in the trading pits in the early 2000s, kind of shoot us away from the pits, or in a way kind of said, you know what, the pits have been drying up over the years, and really the opportunity is on the trading screen. And so from just kind of getting connected through a friend's uncle who worked downtown there at the Board of Trade, they kind of put us in touch with some folks who'd been trading on the computer since the late 80s. And that's kind of how I got turned on to more of the computerized trading. And then that led me to day trading futures. So I did get my start with swing trading, and I did that for a couple years, and then kind of migrated over and added the futures trading component to it. So primarily today, I day trade futures, and I also swing trade stocks. So I like to keep things pretty simple. I focus in the first hour and a half, 2 hours of the day. So from the NYSE open going about 2 hours, that's kind of my main day trading window. That's when you have the overlap between the NYSE session, the European session. That's when most of the volume uh, takes place. That's when most of the action is occurring. The close also sees a spike in volume, but you can get a lot more reactionary trade. And so if you can't trade the open, the New York close would be the second best time. You just have to be careful that you're not, you don't get caught in a trade after the bell. So like I said, I grew up in the Chicagoland area around a lot of traders and access to traders and investors and things like that. Then I went to Arizona State out in Tempe, Arizona, and then now I live in Scottsdale, Arizona for 9 months of the year, and then I come up to South Dakota in the Black Hills, or have a house up there too for the summer months. So it's a nice setup. I still like Chicago, but for those that are from that area around the Great Lakes, it can get kind of gray and just cold in the winter, and there's not always snow to go outside and play in. So being in sunny Scottsdale, Arizona is definitely a a nice move, especially when you like to be outdoors riding your bike and things like that. So in addition to some of these live webinars and things, I've had the pleasure to speak at a whole host of traders expos and money shows and the CME and stuff like that. So other than trading, like I said, getting outside is a really good way to kind of reset, even if it's just a quick walk around the block. You don't have to do anything extreme. You don't have to go for big, long hikes in the mountains. That can be good on like a quarterly basis to do something that, you know, gets you away from the screen for a couple of days. But the main idea is we want to be very focused with our trading when we're in front of the screen, and a couple hours a day is really plenty of time to make some trades, make a good living, and then get out and do the other things that you enjoy. So I always like to start with this idea that what works in trading is really unique to each trader. And so you want to focus on the strategy that resonates with you and really master that and become a master of the art of trading. And if you can focus on that as opposed to trying to make a certain amount of money each day, then the it's kind of like the saying, if you focus on what you enjoy, the money will follow. With trading, if you force and try to force things to make a certain dollar amount per day, typically your trading will start to erode and bad habits will come into play, and it becomes very difficult to make a long-term career. So if you can focus on solid, repeatable, consistent execution and master that part, then the trading profits will follow. Yeah, if you want, so Kumar asks about my specific trades and things like that. I do document all that on over at E-mini Mind. I've been doing a live session on Tuesday mornings for maybe 15 years now, 14, 15 years. And I also track all my trades. So those are all over at E-mini Mind too. So as we go through the different strategies today, if you want to see some, uh, go back and look at timestamps of the various trades that were taken, you can do that and then kind of compare your trades to my trades and things like that. All right, so this is my chart setup. I keep things very simple, as you'll find, and clarity and simplicity are your two best friends in trading. I use Thinkorswim, but you can use whatever platform. Nothing that I use is proprietary to Thinkorswim. I suppose I do have a market internals breadth and advanced decline line box that's coded for Thinkorswim, but you can set that up with Ninja or other platforms. I know a lot of folks are on Ninja, and that is a great platform as well. So I use Thinkorswim for my charts and Tradeovate for my execution. So my trade ladder and execution portion DOM is on Tradeovate. So my middle chart is kind of my one that I toggle through between a daily, a 15-minute chart, a 1-minute chart. The right one is what I call, or what is a 512 tick chart that we'll talk about with the retracements, the first strategy that we're going to talk about. And so instead of a time-based chart like the middle one, 1 minute, 5 minute, 15-minute, just standard time on the x-axis, the tick chart is based on a number of transactions. So 512 tick means 512 transactions. Once that number of trades take place, then the bar closes and then the next bar forms. So the first thing we need to look at is, when does a trend begin? Whether you're trading a trend strategy or a range bound strategy, you need to know, are we trending or are we range bound? So what you want to do is really look at the structure of the market and break down the swing highs and the swing lows. And I always like to start with this because, just like in the if you're playing football at the start of the season, you're going to go back to the basics of blocking and tackling, the basics. And if you can master the basics to where you don't have to think about it when you're in the game, then it makes it so much easier to make these very quick decisions and build that intuition. Because you can look at charts all day long or after the markets are closed and come up with strategies and things like that, but you need to be able to execute in make very quick decisions on the spot. So if we just start from the left of the chart and go to the right and identify the swing highs and the swing lows, then we can get an idea of what the trend is. So if we start from the left, we've got a low, we've got a high, and then from there, we make a lower low, and then we make a lower high, and then we make a lower low, and then a lower high. So at this point, we're clearly in a downtrend, lower lows, lower highs. Great. Now, if we move to the right, we start to develop a double bottom at first, and then we make a higher high. And it's at this point when we go from lower lows, we break that swing high, that LH down here, that lower high. Once that's taken out and we put in a higher high, now we're at the point where the trend is changing. And when we pull back and then move higher, now we've put in a higher low, and now we've shifted from a downtrend to an uptrend. And so it's that scenario that's often can be depicted by something like a double bottom. But the key is just breaking the swing high in a downtrend or a swing low in an uptrend. And this is also very helpful on a daily chart. We go in these long trends, and most recently, long uptrend on the daily S&P chart. We take out a swing low. Now that uptrend is in jeopardy, and we can start looking for lower lows and lower highs and looking for a downtrend to start to form. So whether you're on a daily chart or an intraday chart, the same concept applies to identifying downtrend, uptrend, and that change in trend that occurs kind of in the middle where we're breaking the lower high or breaking the higher low if it's an uptrend into a downtrend. So the first thing we're going to talk about are retracement trades. And I'm going to go through this kind of quickly because this is being recorded, so you'll be able to go back and review things afterwards. I'll also put my email on the screen at the end if you do have other specific questions that come up after the fact. So with retracement trades, we're going to be using the fib retracement tool just to get an idea of where the 50% pullback is. And this is something that was developed in the kind of the trading pits years ago, where the pit traders would look at the first hour's range and look at the 50% point. And if the market opened and moved up and then retraced halfway, then they would look to buy at that point and look for the uptrend to resume. So using the fib retracement tool, you always want to go from the left to the right. And that 50%, that's not a fib number. We're just using the tool to get that halfway point to simply visualize it on the chart. And so by using the 50% line, that gives us an idea of when the market has pulled back. And so in this case, with a downtrend, waiting for the market to pull back to enter short allows us to identify the downtrend, but not chase it down, not selling at lows, being late to the party. We're waiting for the market to bounce to come up into our short to be able to get into a trade. And this also, so I'm using the futures markets to execute my trades, but this also works very well with options, buying and selling call options, because you are buying puts. In this case, if you're shorting, you'd be buying puts when the market is up and buying calls when the market has pulled back, so when the market is down. And you could also buy and sell, SPY, the ETF, but the futures markets are going to give you the best, well, a couple things. It gives you the best tax treatment with just having one schedule at the end of the year and 60/40 tax treatment, and a couple of other things that are beneficial for simplicity's sake. And it also makes it very easy to execute. So the halfway back point is your entry point. Like I said, it's not a fib number, but the 61.8 is kind of our failure level, and that is a fib number. And that's just, roughly 2/3 of the move. If we retrace more than that, there's a good chance that we're going to go all the way back and the trend has now failed. So the 50% line and the 61.8 are the two solid lines you see. And then the negative 23 0.6, also a fib number, and then this negative 61.8. Those are kind of our projected targets. You don't have to exit the trade at that point, but that just gives you a target of, roughly 20% beyond the lows in this case for a short is a spot that the market is likely to, bounce. And so what we're looking to do is take a short at the 50%, let the market sell off, and then when it bounces, we can draw the next 50% from where we entered on the last trade down to the new lows. And you can either continue to enter and exit, enter at the 50, exit at the negative 23, and then re-enter at the 50 and exit, or you can just trail your stop and just continue to trail it as the market goes down to the next low, bounces to the 50, moves down to the next low. I have, let's see. I have volume on my chart here. I don't really use it to execute trades. Um, when I toggle between the overnight session and the regular trading hours, that just makes it very easy to see where the NYSE open starts because the volume is so much higher. So that's really the only reason I have it on the chart. When it comes to the specifics of the execution, waiting for that swing high or swing low to break gives us the signal that, okay, we're starting a new trend. So if we were, let's say, in a downtrend on the left of this, off the left of the chart here, lower low, lower high, lower low, now this setup takes out the swing high, takes out that lower high that was put in. Now we are potentially starting a new trend. We pull back, we draw our 50%, pull back to it. They don't always come, perfectly to the 50%. But what I like to do is draw the 50%. I use the 50% and then just round up in case we come, a tick or two away. Just round up and add a tick. That gives me a little bit of, jump ahead of the actual 50% number. Because in order to get filled, typically price needs to trade through, the order needs to go through your price. So if you just put your order at 5,000 and price touches 5,000, you may not get filled. It needs to go through that 499 and 3/4 to ensure that you're filled. So just rounding up to go long and add a tick. And then I use a 2-point stop on the ES, which sounds pretty tight, but when you're on a 512 tick chart, the ranges are a lot smaller. I don't want to say it's equivalent to like a 1-minute time frame, because when there's more trades occurring, the candles will form faster. And when there's fewer trades, like in the Asian session, then the 512 tick candles will form slower. So time isn't a good relationship, but 2 points is a good stop placement for a 512 tick chart. And then you can trail your stop. You can do a couple of things. So I like to trail my stop with this approach, because we're getting in on a pullback, and the market can easily run 6, 7, 8 points in sometimes a matter of minutes. A day like today, yeah, I mean, we were dropping 10 points in only a couple of minutes. But trailing your stop allows for those bigger winners to offset, a very small loss of, 2 points is a pretty tight stop. I'd rather get stopped out and then reassess and place another trade than have a really big stop and a small target. Because let's say I had a 6-point stop and a 2-point target. Yes, some trades might, I might take a bunch of heat and it might come back and I might get that 2-point profit target. But then one losing trade is now 3 times the size of a winning trade. And mentally, that's really difficult to, stay in the game, because you have 3 winners and boom, it can be wiped out with one losing trade. Whereas if you flip it around, you have a roughly 6-point target and a 2-point stop. Now you could have 2 losing trades and then boom, catch one winner, and all of a sudden, be in the black. So a couple ways you can trail your stop. You can trail by just trailing the next 61/8. So I'll pull up let's see here. Actually, I'll run through the different methods and then we'll look at a couple examples. So you can trail your stop behind the 61.8. That's a safe place to keep it. Just a couple of ticks outside the 61.8. You can use the next swing low. So if you're long and your market's going higher high, higher low, higher high, higher low, trailing your stop underneath each swing low, that's a fantastic way to trail your stop. I use that a ton on daily bars when I'm swing trading. Um, as the market makes a new high, pulls back, new high, pulls back, just trail the swing lows. And then if you want to get really aggressive, if the market is nosediving and going down really fast, you can trail each 512 tick candle and just keep moving it down, dragging it down, down, down. That works a lot better than just, panicking and hitting the flatten button or exiting the trade just because you have, 10 points of profit. It's much better to just trail your stop really tight behind those 512 tick candles because a lot of times you'll end up, taking another 5, 6, 7 points easily by trailing. And you can do a combination of these where I'll start by trailing swings as the trade gets going. And then if it really starts to take off, then I can just come in and tighten it behind each 512 tick candle. You can use an 8-point target. And I put this out there because I know a lot of people are trading on prop firms. And with the way some of the parameters are set, you can't let a big winner come back and if you're up 10 points and it comes back for break even, I think the 10 points counts as unrealized gain and it goes against you. So I don't know all the specifics. I know there's a ton of prop firms out there these days. I just trade my own account, so I'm not super well versed in those. But if you have a profit target of 4-1, that's very good reward to risk, and you can boom take your I would call an 8-point target kind of like getting a double. It's a pretty easy to get to base, but it's not a full home run. A 15 or a 20-point trade would be a little bit more of a not something you see every single day. The market's not going to give you 20-point profits every single day in the ES. So 8 points is a nice sweet spot. And a couple things to look for, whether you're trading retracements or anything if you're using the futures markets, the 30-minute range is really, really helpful. So marking the first 30-minute high and low, so Eastern time, that'd be 9:30 to 10. Mark that just with the horizontal line after the 30 minutes go by. If we break out of the first 30-minute range, there's a good chance we're going to be trending. And so if you go to any trending day and go back to the first 30-minute range, a lot of times it's very small. We just break out and keep going, keep trending the rest of the day. But if we break out briefly, a couple of points, and then fall back into the 30-minute range, now we have a good chance to be range bound. So this would be an example of a trending day. You go back to the first 30 minutes. These are 15-minute candles. You go back to the first 30 minutes and it looks really tiny. So a breakout in continuation, by definition, trending day. And so that first 30 minutes is a really good indication. If we are if we get stuck in that first 30-minute range, it can be a very dangerous place to trade. So if you're trading retracements, a break above the first 30-minute high and then a pullback is a good place to look for a retracement trade. That 30-minute high now becomes support, and if we're going to continue upwards, then that's a very optimal place to have a low risk entry point to continue with the trend. And then another example that happens a lot is I will look for so the left chart is the 15-minute, the right chart is the 512 tick chart. I can draw up a retracement on the 15-minute chart and it draws up a short. the market's moving down. And then I can turn to the 512 tick chart to look for a smaller micro short that reduces the size of my retracement. And that's how I can get away with a 2-point stop. And using the 512 tick chart for the entry, I already know the larger trend is down. We set up at a 50% retracement on the 15-minute. And then when you come to the 512, it really gives you kind of a pinpoint entry into the larger trend that's already been established. So that's kind of a rundown of the retracement trades. Now we're going to switch gears into hammers and inverted hammers. And we're going to specifically look at the 1-minute chart, which I find works the best for these kind of setups on the E-mini S&P. And so the basic idea with a hammer is you're looking to go long in an uptrend. You're looking for a hammer to pull back in an uptrend, and you're looking to get long above the high of that hammer. Now, this could also be a daily chart, really any time frame. But if we're talking about day trading, the 1-minute chart is really beneficial. It is fast, but if you're day trading, that's why being very focused for hour and a half, 2 hours is kind of all you can handle, because you got to be laser focused for that time, and then you can leave and go do other things. So hammers in an uptrend, the 21 exponential moving average is really helpful to visually identify the trend. If we go all the way back to where we started with identifying the trend using swing highs and swing lows, that's going to be a very helpful tool you want to practice. But just slapping a 21 EMA on there on the 1-minute chart gives you a very quick glance. You can just look at the chart. Oh, is the 21 trending up? It is. Okay, we're in an uptrend. Wait for a pullback to the 21. Wait for that hammer. The double bottoms can be helpful indicators of kind of the reversals that we talked about earlier. And then just that higher low, a hammer formed at a higher low is kind of the optimal placement at the 21 EMA. If we flip it around and turn the chart upside down, an inverted hammer is just an upside down hammer. That's a short signal. And so we'd be looking to go short below the low of the inverted hammer. And then everything gets turned on its head. It's a downtrend. The 21 EMA should be pointing down. We're looking to short. We could be at a 50% retracement short and get an inverted hammer. Instead of double bottoms, we'd be getting double tops and then looking for the lower high. And so to manage these trades, I use a 3-point stop because we're kind of buying above a hammer. We're buying on a breakout. I give myself an extra point of the stop. And if the candle is less than 3 points, if that hammer is, say, 1.5 points, then you can use a smaller stop, just put it below the candle's low. But 3 points is kind of my default. I like to use a 6-point target on these. You tend to get a pretty quick move to that 6 points, and then you can kind of take your single, if you will, get on base and take your 6-point profit and move on to the next trade. So buying a pullback, a hammer in an uptrend at the 21, that's going to be your most ideal setup. Once you spend a few weeks kind of mastering that, you can expand to other things like spinning tops or various other setups. But to really start with mastering hammers and pullbacks, inverted hammers in bounces is going to be the best place to start. And so using that 21 is so helpful, just because it visually gives you the trend. And then when you come up and tag up on the 21, you can essentially, if the trend is down, you're waiting for that bounce and then waiting for the resumption of the trend. And the inverted hammer is signaling to you that the trend is now turning to the downside again. If you're going to trail your stop, we would do it in the same way, trailing swing highs and lows. And if you get long above a hammer, then trailing, each of these yellow arrows is a higher low, a swing low. And so you can trail swings. Trailing swings is actually a lot more profitable to do, but the hard part is you have a lot of trades that might go 5, 6, 7, 8 points and then come back and you end up only taking a point. So you have some of these smaller winners, and then boom, you catch a 20 or 30 point winner. And that can be hard for a lot of people to stomach, to have an 8 point winner come all the way back and stop you out for a point. So 6 point profit helps smooth out that P&L curve instead of having big sine wave, troughs and kind of smaller valleys, if you will. The 6 point profit helps smooth things out. And that can be a good way to gain some momentum and kind of get into a rhythm, because the rhythm and the momentum is so important in your trading. And that kind of brings us to the mindset part, which is really the important piece. That it's easy to, there's tons of strategies out there, and lots of different strategies that do work and have a positive expectancy and can make a return, that are very simple. But if you can't execute, or if you get in your own head and you start snowballing and just having a few days or a few weeks where all of a sudden you give back everything you made in the last couple of weeks, you end up just treading water and not really uh, keeping your P&L kind of going up and to the right. So a couple things that I just wanted to highlight. Traders fail not because they don't know the setups or the execution part, because they don't understand how the markets really affect your psychology. Even if you take someone who's got 10 million bucks and you have them buy one share of a stock, all of a sudden, it goes from you have no skin in the game to it can feel like you have you've lost all control, and you're so reactionary, and your mind can do a lot of things to mess you up. And there's all kinds of stuff that we're brought up with, different ways we view money, view success, what success looks like. And the more you can become content with less and what you have, then the easier it is to break away from feeling like you need to make, $20,000 a month and have to get to trading 10 contracts. If you can really slim down and ask yourself, well, what makes me happy? And if it's reading the paper on your deck in the morning, or sitting by the creek, or playing golf every day, okay, well, how much does that actually cost? If you need a golf membership and a set of nice clubs, and that's going to cost you $1,500 a month, and you've got you're 55 years old and you got a paid for house, and what are your expenses? That can help really tailor how much size you need to trade, and how much profit per trade to get there. You kind of work backwards. What's a perfect day look like? How much does a month of that cost? And then now we can work backwards to, okay, actually, I really only need to trade 3 contracts. If I can make 20 points a week per contract, now that gets me to my profit goal. So some of that stuff is actually more valuable than, learning other techniques or adding in more indicators to your trading. So let's run through a few of these kind of little, I don't know, tips or psychology hacks or whatever you want to call them. It's best to trade when markets are conducive to your setups. If you are struggling on Monday, it's not in your favor to continue pushing and trying to, quote unquote, make that money back if the market is just not giving you good setups. So cut your losses and wait till the next day. And then if the market is trading better on Tuesday, keep trading, keep taking trades, that are valid setups that meet your criteria. A lot of people set a daily profit goal and then they try to force it when the market's not giving them good setups and dig themselves a hole. And then the next day they fill the hole back in and then stop. So if you can limit your trading during tough conditions, then it makes everything so much easier because the winning days are actually moving you forward, and the not so good days might just be a scratch day or a small loss day, and it doesn't cost you much. So my P&L is not $500 every single day. It's you have these bigger winning days, and then I have days where I don't have any trades. And so sitting on your hands is a really, really important thing to learn with trading, and being able to identify the market condition. Take out a 3x5 note card and put down, your criteria so that you can just run through it. Boom, boom, boom. Here's the 3 things I need. If the setup meets those 3 criteria, it's a valid trade. And regardless of the outcome, it was a good trade to place. The book Thinking in Bets by Annie Duke is really good. It's more of a poker book, but it talks a lot about kind of disassociating the outcome from the information that you had at the start. It's easy to go back and say, oh, well, I shouldn't have taken that trade, or I should have taken that trade, but you have to be content with at the time you place the trade. And if you can just have a quick checklist, yep, this is a valid trade. It's a hammer. It pulled back to the 21. We're in an uptrend. Boom, I take it. And regardless of the outcome, a losing trade could still be a good trade. And sometimes a winning trade is a bad trade because you just jumped in on market and happened to get lucky. So it really comes down to mindset and having kind of a morning routine where you just kind of uh, get in a flow state, or go for a little walk, or do a few push-ups or wall sits, just to kind of get your brain warmed up and primed for trading. That stuff does go a long way, especially if you have kids. It can be Yeah, there can be a lot of stuff thrown at you, and you don't have a lot of control over schedules sometimes, or when kids are waking up and this and that. And so the more you can control the things that are in your control, really does help. You could do yoga or meditation and things like that, but just taking a deep breath, or after each trade, stand up, walk into the kitchen, and come back, kind of is a very small reset. I go for lots of walks, around the block, out in nature, the parks and things like that, and it's a really good way to kind of clear your head and stay focused. Having a decision-making process by having kind of a checklist is really helpful. Because we want to build that intuition where we're quickly making good decisions. And so the more time you spend trading and looking at charts, the easier some of that becomes. But you want to make sure you're diligent and very focused in looking for the same setups each time, and not just bouncing from strategy to strategy. It's important to think differently and kind of ask yourself, if the market's going up, and it's been going up for the last couple of months, do I really want to get long here? Speaking from like a daily long-term investing kind of thing. If the market sells off, maybe it is a good time to buy. And being very intentional with your time. Sometimes you may just need to focus on one skill for the week. Okay, this week I'm not going to widen my stop. I'm just going to set my stop. I'm going to set a target, and then I'm literally going to sit on my hands and get into a rhythm of, working on one thing each day or one thing each week, and kind of mastering that, and then moving on to the next skill. Just like in you know practicing music or practicing sports, you break it down into small bite-sized chunks that you can practice. Then when you get in the game, that's when the kind of stressful part or the high pressure part comes in, and you see, can I execute? Making sure you're always taking calculated risks. There's a really, really good episode on the Tim Ferriss podcast with Ed Thorpe. If you just Google Tim Ferriss, Ed Thorpe, great episode, very entertaining, and talks a lot about the calculated risk side of things. And I always like to quote, over preparing creates luck. And so the more you can over prepare and come into, everything that you do, uh, kind of well educated, but also just prepared for different scenarios, it always seems like you get luckier that way. Challenging negative thoughts and trying to uh, get those out of your head as quickly as they come in is really helpful to help from snowballing. And it's a little bit cliche, but kind of using positive affirmations or reframing negative thoughts into positive are really helpful, so that it keeps you from kind of spiraling out of control. One bad day or one bad week doesn't make you a bad trader, but if we start to stack, that negativity upon negativity day after day, now you just start, spiraling out of control. And luckily, when I started, I had some really good trading mentors that just drilled in, the importance of the calculated risk and using stops. So I've never, never had a big blow up or, blowing up an account or anything like that. So just kind of started small and just slowly, incrementally worked my way up. So I want to thank you guys for tuning in today. I got my email on the screen, tim@eminimind.com. If you have questions as you're going through the recording or materials, or feel free to send me an email. So thanks, Anthony, for having me, and I hope you guys have a great day.
Hey, thank you, Tim. That was great. Those were practical, actionable strategies that traders can begin implementing immediately. We appreciate your valuable insights, your generous offer, and your participation today. Tim, was there any other special links you wanted to put in the chat or anything like that?
No, if they can find out more about me, and eMiniMind is the best place for it.
Okay, check it out, eMiniMind. The website is in the chat. So thank you, Tim, and reach out to him if you have any questions. That was really great. All right. Once again, don't forget to register for today's Prop Shop Trader giveaway, where 4 lucky attendees will each receive a free $25,000 prop trading account. All right, and I put that link in the chat as well. So that's a SurveyMonkey, easy thing to do. Just kind of put your name, your email, and you're in. And we'll do we'll pull the winners at the end of the day. So make sure you're there. Yeah, just make sure you're there to pull the winners later. Okay, so moving on, we're going to talk about futures trading to stock selection and portfolio growth with Zahir Anawari of Sublime Trading. Zahir Anawari is the co-founder of Sublime Trading and has spent nearly 2 decades developing systematic approaches to finding high-performing stocks. With a background in software engineering and investing, Zahir has created a disciplined process designed to help investors identify market leaders before the crowd catches on. So today he'll be presenting how to make 30% a year by consistently finding and compounding high-performing stocks. Sounds pretty exciting. Zahir, are you there? I think you're on mute, and I am making
Yes,
you.
I am. Hello, how you doing?
Yeah, good. How about you?
I'm very good, thank you. Thanks for having me.
Yeah, thanks for being here. Are you from England by chance?
Yeah, yes, absolutely. I'm in London.
Cool. Well, we're excited to hear this smart presentation today.
Brilliant, thank you.
Yeah.
Should I just go ahead with my screen share?
Yeah.
All right, 1 second. Okay.
Hey,
are we good to go?
Yeah, it looks good.
Brilliant. Okay, guys, thank you. Thank you again to Traders Corner for having me. I'm really honored to be doing this presentation. So let's dive straight in. Not much to add on that wonderful introduction, other than we will be focusing on how to make 30% a year by consistently finding and compounding high-performing stocks. I just want to add the subtitle there, which is a repeatable rules-based process for moving beyond opinions, stock tips, and market noise to build long-term wealth. So most investors are drowning in opinions. You probably see a lot of that on social media, market calls, stock tips, crash warnings. Now, of course, we live in this AI world, so there's a lot of noise and hype around that. There's that constant recession fear. You know, whenever there's any sort of correction or pullback in the market, you constantly hear things about the 1930s again and 2000 and 2008 again. Ultimately, it's just a lot of noise dressed up as insight, and we kind of want to move away from all of that. This session is about process, certainly not predictions, using the process, the portfolio process that we've created here at Sublime Trading to identify high performing stocks and assets with repeatable rules. Now, I'm here in London, the UK. My portfolio is almost always predominantly in US stocks, simply because of the size and maturity of the market. You cannot beat US stocks. Even here in the UK, I'm here in the UK. Yes, we do have some UK stocks that perform well, but 80%, 90% of the time, I'm always in US stocks. Sometimes I'm 100% in US stocks. If the opportunity arises to diversify into UK stocks and commodities like gold and silver, for example, then I will absolutely take those opportunities. The process is exactly the same. Ultimately, it's ticker neutral. It's just about price action and what the charts are telling us. No day trading. I'm a big advocate from looking away from day trading. We know that it has a very high failure rate, and that isn't because day trading is difficult. It's because day trading doesn't have an edge. Day trading is based on intraday activity, and intraday activity is random. So whatever's happened in the past, it's very difficult to replicate that. It's almost impossible to replicate that going forward. So I'm a big advocate of moving away from the lower timeframes and moving on to the higher timeframes, trend following. If you look at performance tables, trend followers are always at the top of performance tables. So no day trading, no top calling, certainly no falling knives. We don't want to catch discounted stocks or undervalued stocks, because yes, people say go in at a discount, but if a stock keeps on dropping, then ultimately it's called a falling knife. So we want to move away from that and instead have a rules-based process for finding strength, managing risk, and letting winning assets compound, because that really is the secret sauce to wealth creation. Now, where did this all come from? Well, ultimately, the process was built from frustration. I was tired back in my early days. I started around 2007, 2008. And back then I was really tired of shiny objects, weak returns, conflicting opinions and strategies that looked clever, but failed to compound capital properly. So we built this process. When I say we, me and my co-founder, we built the portfolio process that I'm going to share with you today. And it's ultimately the system that I wish I had back in 2007. Now, back in 2007, it was very difficult to find the right information. And fast forward to today, is even more difficult given the amount of information and traders and educators that are out there. So hopefully this will help you bring a little bit more clarity to what is required of us as busy everyday individuals. I'm assuming everyone on here has a job, a career, married, kids, family, all of that good stuff going on. What we want are processes, simple, straightforward processes that take minutes a day to manage and that compound our money in the background while we ultimately get on with life and, you know, and have pleasure of living this life that we have. So who built the process? A little bit about myself. My name is Zahir Anwari. I've been a trend follower since 2007. The book that changed it for me was Way of the Turtle by Curtis Faith. If you've not read this book, guys, push it to the top of your book list. It is really one of the only books that I recommend. When I read this book, it completely changed everything for me. So Way of the Turtle by Curtis Faith. I have a background in software engineering, which really fueled my love for all the trading technology and the tools that I have built to run this process, because technology is fundamental to everything that I do and everything that you should do. It's a complete game changer. I was a TEFL teacher, teaching English as a foreign language for 10 years, and that really helped shape me becoming the teacher and the mentor that I am in terms of portfolio building. It was a nice transition from teaching English into to training people to build their own portfolios. On a personal level, I built my wealth through photography. That's really where I started earning good money. We were in advertising photography, so we had big clients where our images went on the side of buses and billboards. And when the money started coming through, that's when I really started to understand and learn how to invest it. I mean, you know, we're often forced to go down the route of property and buy a house because that's what our parents encourage us to do. But I didn't want to do that. I wanted to learn how to invest my money. And like everyone else, I started day trading, realized it didn't work, came across trend following, and the rest is history. I'm the co-founder of Sublime Trading and the Reversy Fund. I have a hedge fund incorporated in Luxembourg that's built on a 10-year track record that got it opened, and ultimately built the process that turns professional trend following decisions into clear, usable portfolio workflow. I'm now in a blessed position to be able to contribute to all these wonderful publications. You can see there now in the top left corner, I can proudly put Traders Corner there. I was in the IFX Expo last week in Cyprus. I was invited to speak out there as part of a panel discussion. Recently been featured in the Wall Street Journal, the Khaleej Times, which is sort of similar to the Financial Times in the Middle East. So over the years, my message has been picked up, being a big advocate of trend following and moving away from short-term approaches and really focusing on compound growth. And now I'm in a privileged position to share my message across all of these wonderful publications. Now, we apply this process across everything we do. Sublime Trading, this is where the investor education comes in, portfolio training, and we have a copy service as well. And then, as already mentioned, we have a fund, which is a professional fund management built around the same trend following philosophy. As I said, this is incorporated in Luxembourg. To have a fund in Luxembourg is a big deal because you've got to have an audited track record. Everything is legit. You've got to have fund managers. So, the fact that I came from a software engineering, teaching English background, a really regular background like you guys, and now have a fund really shows what is possible if you put the right processes in place. Ultimately, guys, if I can do this, you can do it. So today I'm going to show you why most investors struggle to build real market wealth, how we reduce thousands of assets and stocks into a focused short list of leaders, how we identify the highest quality opportunities before capital is committed, and how a rules-based trend following process turns analysis into portfolio execution. I just want to do a comparison here. Let's say you have $20,000 as a starting amount. That's a really nice starting amount that we expect our members, when they come in and join our community, we expect our members to have at least 20,000 to be able to invest. Let's say you put 20K in a S&P 500 tracker fund, and let's say you put 20K in stocks outperforming the index, the stocks that we like to invest in. Let's say you have a 20-year time horizon. You can contribute an additional $100 a month to the pot. With a tracker fund, let's say you get 11% a year. That's a little bit generous. I would say it's more 8-9%, but let's say you get 11% a year. And as already mentioned in my title, we average over 30% a year. So let's say with the stocks that you invest in using this process, you average 30% a year. Remember, guys, that's average. So it's not, do not target 30% a year every year. It's on average. So some years may be flat, some years may be negative. Other years you make 100%, 200% returns. So you've got to average it out over that period. That's how trend following and investing and compounding works. If you look at the returns, though, the returns are staggeringly different. And remember, you've got to adjust for inflation as well. We are living in an increasingly more expensive world. So if you just leave your money in a tracker fund, yes, it will gain value, but ultimately $250,000 looking at it in isolation is not a bad return, but it's not a lot of money in terms of funding a retirement. And a lot of that will get eaten by inflation as well. But if you look at the returns at 30% a year, you're looking at over $4.5 million. Now, that is true wealth creation. So that is the difference between just leaving your money in a tracker fund and actually learning the skills to invest in good stocks. And that's what we're going to be going through today. So we have a copy service, and you can see that from 2023, February 2023, when our copy service started, up until today, June 2026, our portfolio has grown by almost 300%. In fact, that current running P&L, which is around $55,000, this is based on a 20K account because that's the very minimum. But of course, you may have 100K, you may have $1 million. The returns will be the same. The returns over that 3-year period is now coming up in at 300%, and that's the beauty of compound growth, letting positions run, holding and compounding those positions. The objective is not more activity. It is a repeatable process that compounds winners over time. You guys know the expression, right? The trend is your friend until the bend at the end. Cut your losers short, let your winners run. The part that's often missed out is the compounding aspect. Cut your losers short, let your winners run, compound winners. That is the real process. So let's get into why most investors never build real wealth from the markets. They do not lack information. We live in the information age now, guys. We don't need to go to the library. You remember 20 years ago, you had to go to the library to find information, right? We are in the information age. So information is no longer a problem. What is a problem is filtering through that information and finding the information that actually counts. Execution. The right execution is what counts. So most investors now, they lack a repeatable process that survives noise, emotion, and changing market conditions. Everyone's bouncing between one strategy and another. What you want is a simple, repeatable strategy that you can learn and use for the next 10, 15, 20 years, and then pass it down to your kids and loved ones to continue your good work, because ultimately we're kept in this loop of financial illiteracy. And someone has to break that financial illiteracy loop. That has to start with you. You've got to learn the skills, and then you've got to pass it down to your kids and loved ones. Otherwise, it's just going to remain in that same loop of financial illiteracy. It has to be broken. So mistake number one, they chase tips. They chase tips instead of tracking strength. A tip gives you a name. SpaceX is a really good example, right? Everyone was jumping on the whole SpaceX hype over the last couple of weeks. Look at what SpaceX is doing now. It's a really, really good example. You don't want to jump in on a tip or a name or a ticker. What you want is to be able to look at the performance and to jump in on strength, because strength gives you evidence, and evidence can be scanned, it can be ranked against other stocks, it can be filtered, and it can be acted on. So we have to move away from just tips, and we have to look at what the stock and the performance and the strength of that particular stock or asset. Mistake number two, they react to headlines instead of following evidence. Headlines explain what has already happened. Headlines explain what has already happened. That's it. By the time we see news on social media, in our media channels, on news, etc., it's ultimately old. Particularly the fact that institutions pay a lot of money to get news early. So by the time we get access to that information, it's already old and it's been acted on. So headlines don't really mean anything. They just tell us what's already happened. Price action, on the other hand, shows where capital is moving right now. So if we can understand price action, if we can see strength, if we can understand how to read the charts, particularly on the higher time frames, we can then react accordingly to what the charts are telling us. Okay, mistake number three, they confuse activity with progress. More charts, more alerts, more trades, more opinions. I mean, you always see those images of traders with that sort of cockpit setup. They've got 5, 6, 7 screens, all with more information, all with lower time frames on there. And often it's always free subscriptions, free trading view subscriptions, free news subscription. There's never anything there's no real investment into good equipment. So we want to get away from that. You know, more is not good with trading. Less is more. So despite having more information, more charts, more trades, more opinions, ultimately there's still no edge. And here's the thing, guys, if you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. I'm going to say that again. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. So you've got to know precisely what an edge looks like. And the best way to be able to define an edge is a checklist system and looking at the higher time frames, monthly, weekly, daily. And we'll look at that as we progress. Mistake number four, they buy weakness and sell strength. You see this all the time, right? Most investors are trained to hunt for bargains. We're told about how cheap stocks are good, discounted stocks are good, undervalued stories are good. You know, Warren Buffett is everywhere, right? Well, if you look at Warren Buffett, in the last 3 years, he's remained in cash. And again, that's been kind of applauded. Warren Buffett, he's hoarding cash, yet the S&P 500 has climbed over 100%. So Warren Buffett will always go down as a legend. That goes without saying, but his performance has not been legendary in the last 3 years. So you have to question everything. And remember, undervalued also means falling knives. So if you keep on buying into cheap stocks and it keeps on dropping, you're buying into a stock that is also a falling knife. We want to get away from that. Market often rewards the opposite. Strength keeps getting stronger. Buy strength when a stock is going up, sell when strength fades. So when there's a reversal or a correction, that's when you want to exit. You want to be aligned with the market. You don't want to buy in hoping for a reversal, which is often what value investing is about. Okay, most investors start with the ticker. This is the mistake. A ticker without market, sector, and trend context is just a name on a chart. Again, going back to SpaceX. even Nvidia, looking at Micron Technology, look at all of these stocks in isolation, just their tickers. It doesn't mean anything. We have to look at it in relation to market, sector, and trend context. So our edge starts before the stock pick. So there's a process. An edge is all about stacking the odds of success in your favor, bit by bit by bit by bit. Remember, everything is under your control apart from the outcome. Often I will ask people, what is a good trade? A good trade is one where you follow your plan regardless of the outcome. Regardless of the outcome, because the outcome is completely out of our control. Everything up until the moment you execute the position is in your control. So you want to make sure that you have the odds in your favor. The minute you pull that trigger and you're live in the market, is now out of your control. What happens next is down to the forces of the market. So you continuously want to be taking small positions on high probability stocks. So that's where your edge comes in. And over the long term, this is how you will make very, very good profit. Cutting out of those losers for small losses, holding and compounding winners for large profit. The goal is not to predict the next move. The goal is to build a portfolio around strength and manage it with rules. So we want to start with market, then go into the sector, then we want to find the stock, then we want the setup, then we want the entry, then we add the stop loss, we allocate the risk. Once it starts working in our favor, we compound, and then the exit management comes in. So it's step by step by step by step. An asset is never analyzed in isolation. A strong asset in a weak market is vulnerable. A strong asset in a strong sector has fuel. You always want to be looking for the strongest stocks in the strongest sectors. This is essential. So step one, market direction. Before we care about any asset, we ask, is the market giving us the green light? And the way to do this is to use the S&P 500. I will be showing you how we do this when I move to the charts. But the way to do this is the S&P 500. The S&P 500 is an average. As it's an average, it's an indicator. So if the S&P 500 is moving up, then we know overall the market is moving up. If it's correcting, that means there's a mixture of bullish and bearish factors. If the market is tanking like it did in 2000 and 2008, then we know that there's more bearish factors than bullish factors. And remember, if the market does reverse and we do have a 2000 or 2008 situation, then there's nothing to fear. We simply reverse our stance and we short the market. But right now, we are very much in a bull market. So as long as the S&P, the NASDAQ, the Dow, as long as these indices keep pushing up, that is telling us that the market overall is bullish. And that's why we keep on buying in. Step two, sector strength. The strongest assets, the strongest stocks usually come from the strongest sectors. This is where institutional capital is flowing. Institutional money is essential. So this is the beauty of looking at charts as well, because if we keep on seeing higher highs on stocks, that means institutional money is flowing into those stocks. And what that means is that the institutions are doing all the hard work. All we need to do is jump on their back and piggyback the ride. This is the beauty of being a retail investor. We don't need to copy institutions and pay thousands of dollars for news terminals. All we need to know is be able to identify where they are using simple markers and indicators. This is where the checklist system comes in. When we see where they are, we jump on their back, we piggyback the ride. And to do this, we use a two-tier filtering process. We do not jump from a ticker idea straight into a position. We separate discovery from decision making. So tier one, we use a scanner. This is where we go from 20,000 stocks and assets. So this is US stocks, UK stocks, commodities and currencies. You're looking at about 20,000 stocks. At a click of a button, we program the scanner to meet a certain criteria. At a click of a button, it will go through 20,000 assets in about 3-4 minutes, and it will then give us a list of 50 to 500 candidates. On average, on a daily basis, it's somewhere between 100 to 150. On a quiet day, it'll be less than 100. On a particularly busy day, for example, the day when Trump was elected, there was that big gap up in the market, re-elected, I should say. Our scanner picked up almost 700 stocks on that particular day. On average, it's 100 to 150 to 200 stocks on a daily basis. So it's a much more manageable list. The objective is to find where strength is appearing, which of the sectors are performing well, and then giving us a list of the strongest stocks in those strongest sectors. So that's tier one. And then tier two is manual analysis. What I do is I take the daily list. I do this on a daily basis. You don't have to do this on a daily basis. At the very least, you want to do this once a week. And I would say to do it at the weekend when the markets are closed and you have the time to scan the markets and go through the results of the scan and make your decisions. And then you do that, repeat that every weekend. But I do it every day because it's what I do for my hedge fund, for my personal portfolios, for our community members. So at the end of each day, I do this process, and it can take anywhere from 1 to 2 hours on a daily basis. I then take that list and I tier 2, which is the list from tier 1, the 100 to 150, 200 stocks, and I put them through the tier 2 manual analysis. This is where my software engineering background really came in. I built out all the tools that we use, and I cherry pick. Doing manual analysis, I cherry pick the very best stocks for the portfolio. Only the strongest setups move forward. Step 3, relative strength. Now, what I'm doing ultimately, guys, is I'm not looking for cheap stocks. I'm not looking for popular stocks. I'm not putting any opinions. Remember, one of the first rules of investing is to ignore opinions, including your own. Often I always hear things like, I think this is going to happen. I think this is going to happen. And ultimately, the market just keeps on going higher and higher and higher and higher. Your think is getting you on the wrong side of the market. Remember, that's where risk and exit management come in. Else, what's the point of risk and exit management? Risk and exit management is to protect your downside while you're taking advantage of the upside. So good investing is about milking the upside while the downside is being protected. So we certainly don't want opinions. All we want are leaders outperforming the market. So if the S&P 500 moves up 30% over a year, we want stocks that move up 100, 200, 300% in that same period. And that's how we push our performance from average to over 30% a year. So every stock I invest in follows this pattern. Think of it like a flight of steps. Most people are looking for that undervalued stock, something that's cheap, and then waiting for that reversal. As I said, when you buy something that's cheap, it's very likely to keep on dropping. And we don't want falling knives. What we want are stocks that continuously move up like a flight of steps. So I've called this the 4-phase sequence method. So every stock I invest in follows this pattern. First of all, I want stocks with at least 5 to 10 years of history. If a stock has at least 5 to 10 years of history, I can study that stock's past performance and I can look for these patterns. Now, I don't do this manually or manually. Part of it is done by the scanner and part of it is done by the manual analysis. That's where that 2-tier process comes in. So what am I looking for? I'm looking for stocks with a proven performance history. If stocks have trended well in the past, then they're very likely to trend well in the future. Then I'm looking for a consolidation base. Remember, guys, the longer the consolidation, the bigger the breakout. I'm looking for stocks with at least 3 to 6 months of sideways market. Longer, even better, because if a stock or a commodity has consolidated for 12 months, 18 months, 24 months, and then it breaks out, which is phase 3, then this is a stock that's very likely to continue moving up. Remember, the longer the consolidation, the bigger the breakout. Then it's phase 4, where I get in. Now, I don't get in on phase 3 because phase 3 can be a fake breakout. So we want to wait for phase 4 to start. So I wait for at least 1 or 2 more breakouts to the upside, and then I start taking positions. And this phase 4 typically can last 12 to 18 plus months. So my portfolio is ultimately full of phase 4 stocks. And I like these stocks setting record highs, all-time highs, because stocks that are setting all-time highs have very little in the form of resistance and are likely to just continue moving higher and quicker than any other stock. So this is what I'm looking for. Now, step 5 is the setup quality. Not every breakout deserves your money. We want the strongest assets breaking out from the cleanest setup. So even when stocks are breaking out and breakouts are performing, I'm analyzing every breakout to make sure that I'm not going in on, let's say, an indecision candle, because an indecision candle could cause a reversal. I want strong bullish entry candles for bullish stocks. If I'm shorting a currency pair, for example, I want large bearish candles if entering to the downside. So we assess every breakout to make sure that we're entering on good breakout entry points. Stop loss placement. Now, before we care about how much we can make, we need to know exactly where the idea could fail. This is really, really important. No stop, no trade. People who do not use stop losses are ultimately really playing with their future. It's suicidal. And the reason why people don't play stop losses is because they don't know how to. They either use stop losses that are too tight and then they're continuously getting whipsawed out, or they just don't use them and then ultimately have 100% of their account at risk. You want to have a good stop loss. A good stop loss is one that's based on the volatility of the stock, allows for the natural pullbacks. And then if the stop loss is hit, then it's clearly failed. So you want a nice, well-placed stop loss. So ATR, the average true range, is a good way of deciding where a stop loss should be because it's unique to the stock. Risk allocation, we want enough size to matter without enough risk to become emotional. If you're putting 5, 10, 15, 20% more on an individual stock or asset, you're going to be emotionally connected. A good setup with poor risk is still a poor trade. What you want is to take a position and be completely detached from that position. So I do not risk more than 0.5% to 1% per position, at the very most 2%. And then I can spread my risk. So instead of putting 20% on one stock, I can put 1% on 20 stocks, diversify my portfolio, and then allow that process to take over, where I cut out of the losers, cut out of the break evens, and then hold and compound the winning stocks. Compounding winners, step 8. The real money is not made from being right once. It is made from adding strategically to proven winners and letting trends do the heavy lifting. We add to strength because the market is already proving the idea right. Compounding is an absolute must. And then, of course, exit management. This is where most investors fail. They buy well, then butcher the exit. We use a trailing stop loss matched to the asset's volatility. The exit protects the compounding. So while we keep on compounding, the trailing stop loss is following, locking in profits and reducing risk, and ultimately removing risk as well as the asset moves up. So knowing what works is not enough. Most investors do not fail because they lack information. They fail because they lack a repeatable execution process. Information is everywhere. Execution is absolutely rare. So this is where most investors break down. They start with good intentions. Headlines get noisy. Markets pull back. Confidence drops. Rules get ignored. Profits get butchered. Without a clear strategy, behavior becomes the problem. This is what your weekly routine should look like. Check the index. Check sector strength. Run the scans. We call it the Sublime scans, but if you're using another scanner, run the scans. Review the shortlist. Confirm setups. Then manage your entries, stop losses, winners, and exits. Simple enough to follow, strong enough to matter. And this is what I mean by the fact that you want a process that's simple and repeatable and that actually delivers returns. So let's see this process in action. You've seen the workflow. Now let's apply it to real estate. We'll use TradingView. What I'll show you in TradingView is how I use the market, the sector, and the stock, then the candidates, the shortlist, and then I go through the whole process from setup, entry, stop loss, risk, compound, and exiting. Okay, so if you guys just bear with me a second, I'm just going to share another chart, which will be my TradingView charts. And I think you guys can see that, okay? Yeah, I think you can see that, okay. So first of all, let me show you. I use a different scanner. I use a scanner called MetaStock, not MetaTrader, which is an execution platform. I use a platform called MetaStock. MetaStock is an excellent, excellent scanner. It's one of the best scanners that you will find. And you'll see here that these were all the stocks that were picked up by my scanner from yesterday's close. It's Thursday today. So these are all the stocks that were picked up by my scan from Wednesday. I imported them into TradingView, which is where I like to do my charting analysis. And then I basically go through each of these stocks individually, and I'm looking at whether they meet my criteria. Let me show you what we have here. We have the monthly in the top left, weekly in the top right, daily bottom left, daily bottom right. Monthly, weekly, and daily bottom left, these are my analysis timeframes. So this is where I'm doing my analysis and I'm finding the good stocks. Daily bottom right is my strategy, and this is where you'll find the entry points, the stop losses, the risk levels, and where I put them into TradingView. Hello, is there a question? Okay. I heard some. Were you coming on to the mic? I'll continue. So what was I saying? Yes. So monthly, weekly, daily. Now, what I'm looking for is alignment. I want the monthly, the weekly, and the daily to be all moving in the same direction. This is what I call multi-time frame alignment. If they're all moving in the same direction, then we have a high probability asset. And that's when I go to the daily in the bottom right, and I can then look to execute my strategy and move those levels into the broker account. On the monthly, I have 6 indicators. On the weekly, I have 4 indicators. And on the daily, I have 6 indicators. So there's a 16-point checklist that each stock or asset goes through that must be met. If 15 are met, I stand aside because I'm waiting for that 16th. So it must meet all 16 indicators before I place a position. So let's start with the S&P 500. So going back to the S&P 500, the S&P 500 is a very simple indicator. On the monthly time frame, I said that what I'm looking for is strength. This green line here is the highest point of last year. If the asset, if the stock or the index or any asset is trading above the highest point of last year, that to me is a bull market. And that's all I need to know. If you look at Trump tariffs, this area here, that's been absorbed into the market. If we look at the correction which was put to the situation in the Middle East in April of this year, that's been absorbed, and the market is now setting record highs. Yes, we're having a bearish month this month on the S&P, but that's okay. After every big move, I mean, big move up in April, strong move up in May, there's bound to be a slow month, a correction month before a continuation. So this is all it is. It's a correction. So this is what I mean by always looking at the S&P 500. As long as it's continuing to trade above the highest point of last year, that to me is a bull market. If it reverses and moves back below the highest point of last year, then I need to be more concerned. But remember, the S&P, the indices, they're also weighted. So often it could be big tech that's struggling and it's dragging the indices down, but the smaller weighted stocks are still moving up. So this is why you want to have a more holistic view. You want to have an overall view of what the market is doing. You don't want to be just looking at big tech and thinking, wow, big tech is everything. Big tech is not everything. Big tech is just one market within one sector. There's 11 sectors out there. So we do also want to take what's happening on the indices with a pinch of salt and really let the scanners guide us, because if it's still picking up stocks that are pushing up while the index is moving down or correcting, then we want to be taking those positions. Maybe we reduce our risk. Instead of taking 1%, we take 0.5%. Okay, let's move on to some stocks that have actually done very well for us. Seagate Technology. If I look at the monthly time frame, this is going back to June of last year when we picked it up from our scanner, and it's moved from around $118, $115, and it's now trading at over $1,000. This is what I mean by finding stocks early at the breakout. Seagate Technology gets no attention online, no media attention at all, and it's performed exceptionally well. Weekly, you can see it's been moving up. Daily, you can see it's been moving up. Now, if we go to the daily in the bottom right, and if I just open that up, look at how the trend has developed. Look at how the trend has developed. Look at all these green markers. These green markers, these are entry points. So every time there's a green marker, the scanner and my analysis will pick up these green markers, and this is where I enter. And you can see this is going back to May, June of last year, and you can see how well it's performed. And this red line, this is the trailing stop loss. So if I entered these positions in May or June, and if you had entered in May or June, you would still be holding this stock today because it hasn't broken the trailing stop loss. So you would have made excellent profits through compounding, and you would have locked in excellent profits through the use of a trailing stop loss. Amphenol is another example. If you look at Amphenol, you can see how well Amphenol has performed over the years. There was a big trend from June 23 to July 24. There was a 1 year trend. Then we were stopped out. It went sideways. Then we had the breakout in May 25, big run up to January 26, and then it hit our stop loss in February of 26. So another good trend to the upside. Again, all of these entry points where we held and we compounded, and then the trailing stop loss came in and stopped us out. So we were making profit while the stop loss then locked in profit and protected us from any correction. Micron Technology, of course, has been getting a lot of attention recently, but we want to move away from Micron Technology being just a buzzword and actually understanding when to enter and how to maximize the trend as it develops. We've been in Micron Technology since September of last year, well before all the Micron Technology hype. And if you look at earnings today, it's actually gapped up and it's performing very well on earnings. So again, all of these entry points have done very well for us, and the trailing stop loss has kept us in our positions. Some stocks that you want to be aware of, just a couple of examples of stocks that will be starting new trends. Delta Airlines. So you can see here, it performed very well in 2013 to 2014. So applying that 4-phase sequence I talked about, there was a good trend between 2013 and 2015, went through a massive sideways market, has now broken out and setting record highs. So this is a new stock, and it's a fairly cheap stock that you want to be aware of and that you potentially may want in your portfolio. Another example is General Electrics and GE Aerospace. Very good performance between 1995 and 2000, big 5-year trend, massive sideways market. But since August 22, it's been performing well, and it's now started its new uptrend after a mini consolidation. So this is another stock that you want to be keeping an eye out on. A stock that we were in and it failed, and I'll show you, is BWXT. So how we took a position and it reversed and it stopped us out. So you can see that all we do is basically take positions on stocks that meet our edge. We then hold and compound the winners, excuse me, and then we cut out of the losers. And rinse and repeat. Okay, I'm just conscious of time, guys. So I am quickly going to go to the final slide. So bear with me. Excuse me, that's the wrong one. I think that's the one. Yeah, that's better. Okay, so what you just saw, you saw how the process applies to real charts inside TradingView, market, sector, asset, setup, entry, stop loss, risk, compound, exit. We went through the whole process from market direction all the way through to exit management. So what happens next? Well, you can keep trying to piece the market together yourself. And, you know, it is possible, guys. You know, I did it, but it will take you a lot of time and it will cost you a lot of money. So you can fast forward that and use a structured system built to identify strength, manage risk, and compound winners. And so to that, I invite you to join the APL, which is our copy service, the asset position log monthly subscription. This is where we do the whole process for you, the whole workflow, which is designed to help investors follow high-performing assets with clear entries, stops, risks, compounds, and exits. It's ultimately built for investors who want portfolio decisions, not predictions. So what you will get, you'll get the full APL access and instructional videos, daily portfolio updates, end-of-day position notifications, entry, stop loss, risk, and compound levels, exit management updates, private community as well to discuss everything, and then onboarding support as well. So ultimately, how I manage my portfolio, you will be able to copy as well every step of the way. Now, this typically costs $249 a month. Typically, people pay for the year and they get a 40% discount. So it's normally 1,791 for the year, 1,791 US dollars for the year with a 40% discount. But as we are meeting for the first time, we have a nice offer where you can come in, trial it out for a month at a reduced price. So use the code TC50, that's Traders Corner 50, excuse me. Go to the link apl.sublimetrading.io, come in for the month, trial it out for the month at a reduced price. And then if you want to stay for the year, we can have that discussion and you can then get the discounted price for the year. Now, this is not just a spreadsheet, guys. It's a spreadsheet that records information where the APL turns the process into portfolio decisions. That's the difference. Data is useful. Process is what compounds. So once you sign up, this is what you'll get access to. You can see the stocks, the assets, the sectors, the entry points, whether we're going long or short, the strategy we're using, how much we're risking, how old the trend is. You don't want to be jumping in at the top end of the trend. You want to be jumping in when the trend is just starting. So we'll guide you through that whole process. So this is what you will get access to. Who this is for: investors who want structure, investors who want to stop guessing, investors who want portfolio decisions they can follow, investors who want to build serious long-term wealth and a serious long-term portfolio, serious investors and a serious process. Who this is not for, guys: this is not for day traders, top callers, bottom guessers, signal chasers, anyone looking for a magic button. This is not entertainment. I often find what's on social media and it's just really entertainment. When your and your family's future is on the line, this is serious stuff. This isn't entertainment. And so this is what we do here, guys. We give you guys a process that you can stick to and repeat and that you can pass down and leave to your kids and your loved ones. This is a legacy system. So the APL gives you the process investors are missing, not because it predicts the market, because it gives you a repeatable way to follow strength, manage risk, and compound winners. Edge is not a feeling, it is a defined process. So please go to our Trustpilot and you will see what our members are saying. You can see that 100% in profit growth, outperformed the S&P 500, despite this particular gentleman has compliance rules that he has to deal with, and he outperformed the index. This person also is consistently making returns of over 30%. Since I've joined Sublime Trading, returns in excess of 100%. We've got numerous Trustpilot verified reviews like this. So please check out our Trustpilot as well. So before you go back to the noise, most people will leave with more opinions. You can leave with a process. This is the real upgrade. So again, everything that you will get from the APL to the instructional videos, daily updates, end of day notifications, the whole strategy, the entry to exit management, the private community, and of course, onboarding support as well, with myself included, guys. This isn't just left to some sales team to run. I'm very much hands-on with the community. So there you have it, guys. That is me. I hope I'm just on time. If there are any questions, I'm happy to answer the questions. Over to you, please.
All right. Thank you, Zahir. That was great. Your
Brilliant.
special offer is in the chat. So thanks for being here today. We appreciate you and your excellent success in being here today for your first time.
Thank you very much. Thanks for having me.
Thank you. That was an excellent presentation and a powerful reminder that successful investing is often about discipline, process, and patience. Thank you for sharing your expertise and your generous offer with our audience today. And that offer is also in the chat box, so be sure to check that out. And don't forget to enter the Prop Shop Trader giveaway for your chance to win one of 4 free $25,000 Prop Shop trading accounts. So yeah, thank you. Right. Next up, we have Eric Gebhardt. Eric Gebhardt is a co-founder of AltaVest and a pioneer in automated options trading technology. His company developed Theta Trader, an innovative platform designed to simplify option spread trading and automate many aspects of trade management. Many of us have used his technology, I'm sure. Today, Eric will present automated options trading for the stock market. You'll discover automated risk management, one-touch trade alerts, and pre-built hedge fund style options strategies that are helping traders leverage technology more effectively. So everyone, please welcome Eric Gebhardt. Eric, are you there? I think, Eric, you might be on mute. Okay, we see your slides there.
Yeah, we're good now.
Yeah, that's all yours.
Yeah, thanks for the introduction, Anthony.
You're welcome.
Started. I've got 45 minutes. Is that correct?
Yeah, that's correct.
Okay, let's get the show on the road. We've got a lot of material. Thanks for having me. Thanks for being here, everyone. We're going to look at automated options trading for really any market condition, including non-directional strategies. We'll use automation to help us along the way. So we're not going to be chart watching. And we have one-touch responsive trade alert technology. You're going to like to see that. And with that said, take a look at the risk disclosure. It is important to keep in mind that when trading, only risk capital should be used, and that past performance is never a guarantee of future results, and there's always a risk of loss when trading. You can take a screenshot of that if you'd like to read all the details later on. Okay, a little bit about AltaVest. We've been doing this since 1997 as a registered introducing brokerage firm. We developed our own proprietary options technology, trading millions of contracts along the way. We're registered with the CFTC and members of the NFA. We're located in California. And I am Eric Gebhardt. My business degree from University of Southern California. I'm a co-founder of AltaVest. I've had various securities licenses over the years. Currently have my Series 3 for commodity futures, and then also the Series 65. That's what registered investment advisors would be using. Perhaps you've seen us in some other presentations on the web and even maybe in person. In fact, here's a shot from few months ago in Miami, there was about, I think they said about 1,000 people in the audience. So I presented there, and that was a lot of fun, and met a lot of great people as well. And sometimes we get quoted on various publications and financial journals. Here we are, just a couple weeks ago in the marketwatch.com, asking us our opinion on, I think, gold and the S&P and maybe even treasury bonds. But that's always kind of fun to talk to the press. Okay, with that said, introductions out of the way, why are we going to look at what we call alternatives? So alternatives, essentially, they have performance that has a low correlation to traditional investments, and they may improve diversification, lower portfolio risk. So what that really is talking about is strategies for all market conditions, whether it's non-directional, sideways markets, bull markets, bear markets. And we're not just going to passively buy and hold. If you do, you can sometimes run into some major hiccups. Prices don't always go up. Here's the Mag 7 lost over 5 trillion from their all-time highs here. You can probably feel a little more of that pain today, although I haven't looked in the last bit here. These things change on a dime. Here's what it looks like on a graph over the last month or two. Actually, no, that's 1 month. And even stuff like crypto, highly speculative, had a huge run, obviously, but now Bitcoin is really, I think it's off more than 50% from its all-time high. So the point is, you can't just buy and hold and expect that it's going to be smooth sailing. And we're going to talk a little bit about that and how we try to navigate through, I guess you could say, the noise. And there are really three barriers to trading that we've identified really from our clients. And I think we can all relate to these. So let me know what you think, if we've kind of hit it on the head here. How about information overload? There's just noise. We used that term just a minute ago. Conflicting targets, opinions, narratives. And really, it's a lot of clickbait. And how about this? How about the tweets you get? From 1 minute to the next, you get a tweet that just kind of rocks the market, the headlines, whatever it is. Years ago, you'd have a guy or gal sitting behind their desk and using a graph paper and a pencil and doing charts or looking at balance sheets. But that's really not the way it works so much anymore. It's based on momentum. It's based on flows, systematic trading, a lot of positioning, automation. Totally different landscape, and you end up with this information overload, can hinder your decision making. You get analysis paralysis, and how do you know what is or isn't important? So that's a big problem. This guy here, I think, represents all of us. Too much info. And then what about time? Realistically, it's not really practical for us to spend time watching our screens during the market hours. Even those of us who have some free time probably would rather not, you know, be doing this. All this is kind of funny here. This guy here says he's managing his $180 portfolio with this looks like an IMAX theater system here set up. That was kind of funny. So this is how people envision their trading setup, but the reality is most of us don't even have the time to do it. So you really probably shouldn't be trying to watch your trades all day. You probably find that counterproductive regardless, because why? Well, our emotions get in the way. This would be barrier three. When it comes to making money or losing money, that's a lot of fear and greed gets swirling around in our heads. We end up riding that emotional roller coaster where, as you're doing well, you get euphoric, and you start doing poorly, you raise that white flag of surrender, capitulate, and then you kind of get back on that same ride again. We want to try to avoid that. We want to try to control our emotions. And that's what we're going to help you with here with some of these automated strategies using options. So we think we can jump those barriers and overcome those hurdles. So before we jump into the demo, just real quickly, let's put some options trading in perspective. Remember, the buyer always pays the premium and the seller is collecting that premium. So if you're the buyer, you're said to be long and you pay the premium, whether it's to buy puts or calls. And then who collects that premium? Well, the seller. And you can, of course, choose to be a buyer or you can choose to be a seller. And long option strategies where you pay a premium, those can be called debit trades or debit spreads. Here's an example in a bull market. The market's moving higher, maybe you're bullish. You might want to buy some calls or buy a call spread if you think the market's going to keep going higher. And conversely, if you're bearish, maybe you want to buy some puts or some put spreads if you think the market's going to keep dropping. So those would be debit spreads where you pay the premium. And then there's also short strategies. So you take the opposite side of that. Perhaps you're bullish here. And what might you want to do? Well, maybe you sell some out of the money puts and collect the premium if you think the market's going to keep going higher. Or if you're bearish, you might sell some out of the money calls. Or perhaps you look at the market and think it's going to go sideways for a while. You might sell some calls above the market and puts below the market. That's called a non-directional or neutral strategy. And you're collecting premium, and that's a credit. You receive a credit for making those trades. So we're going to learn 2 letters of the Greek alphabet, and we're going to keep it real simple. You can get really deep into the weeds on this, but we don't need to. Delta, this helps determine probabilities, and it is what is the option value change with a change in the underlying index. So how much does that value change? That's really what the formal definition of delta is, but option traders look at it like the approximate probability of that option expiring in the money. So example, if a delta is 0.2, that means there's a 20% chance of expiring in the money, but an 80% chance it expires worthless. Remember, delta is not static. It always increases and decreases, moves up and down with price movement and time. And it is not the probability of a winning trade. So keep that in mind as well. And speaking of time, we'll look at theta, representing time decay or sensitivity to time. Remember, every option has an expiration date. It runs out of life, has a limited lifespan. So time is referred to as theta. When speaking of options, it's a negative number, and it equals 1 day of time decay. And here's what it looks like on a graph, essentially. Let's say you had 120 days on the option, and you approach time 0, and the value of that time decreases and decreases and decreases. You have theta decay. So basically the clock is ticking, you're running out of time. And eventually the theta decay always ends up at 0 because you run out of time. So that's how that works. And essentially also in the last 30 days or so, the rate of change on the theta decay tends to increase quite a bit more versus when you're further out on the time horizon. And so there are various strategies to use delta and theta, and we're going to look at a few of those. And we want to look at how the professionals trade, maybe an institution or a hedge fund might trade. So what might that look like? Here's a little piece here I found on reasons why selling options is better than buying options. I highlighted a few of these here. So they talk about professionalism in managing risk like a professional. It's a professional approach distinguishing option sellers from novice speculators. So I think I agree with that. What they're referring to there is oftentimes the rookie will just buy a simple call option and hope to hit a grand slam. And while that may work once in a blue moon, over a long period of time, it's really not going to work. But here's another comment here on selling options here. It's often preferred by long-term investors who value consistency over high-risk speculation. And then ChatGPT said this: why do professionals sell options? Well, you take advantage of that time decay. We just looked at that, and you're collecting the premium, and you know that at some point the time will run out on that option. There's a higher probability of profit when the seller that receives the premium up front. They talk about income generation. They look at market neutrality. We mentioned that too. Option sellers, you have ways to trade in sideways markets. And essentially, they say selling options is a preferred strategy for many professionals. And Wall Street pros will trade a lot of option spreads, and they're using theta decay to their advantage. So they collect premium from buyers to offset their cost. So here's what a typical spread might look like, where you collect premium. Here is an example where maybe you're bearish, and for example, you're selling an out of the money put spread and you collect premium. So here's an example here where the market trades, and well, I'm sorry, this is actually a if you're selling this out of the money put spread, then you'd actually be neutral or perhaps bullish. I I need to correct that. Sorry about that, folks. But so you can see here, you collect premium for selling this out of the money put spread, and the market just kind of trades a little higher here, a little bit higher. And then you can see where the arrow is in this blue square under the RTI, and we'll explain that indicator in a bit, but that's where you close out the trade. So you sell the spread down here, you collect a net premium. So the red line is the one you sell, the put, and the blue line is the one you buy, and you have to pay money for that as protection. And then over time here, as time goes by and theta decay works, then you essentially close out the trade. So you sell it, and as time goes by, you're able to buy it back for less than what you originally sold it for. Then here's something called an iron condor. It's non-directional. So you take a call spread that's out of the money and a put spread that's out of the money, and you sell those simultaneously. So you collect premium on the calls and the puts. And then you look for the market to stay within that range, essentially between the two red lines. You can see here it's dropping and dropping and dropping, and it goes back up and so forth. And right here, you get a signal. It turns blue and says close out that position and take your profit and move on. So you place the trade by selling it and collecting premium, and then you wait for theta decay, and then you buy it back later, hopefully for less than what you sold it for. And we're going to show you how to automate this too. So when it turns blue, you don't have to do anything. The order can automatically be placed for you. And then here's a strategy called a dragonfly. It's a variation on the condor, sort of a non-directional strategy. And again, you have the call structure and the put structure here, where this is all done simultaneously as one order, and you collect premium for placing this trade. And you can see the market sort of chopping around, going down, going up. And then again, as theta decay works, then you buy back that position for less than what you originally sold it for. And you can see here the margin of error between those red lines is quite large. So really you have all this room for the market to bounce around and for theta decay to work. It's magic, so to speak. And then there's directional strategies as well with spreads, or even just outright positions, whether you're bullish or bearish. Something we call a bull hedge. If you're bullish, it's a combination trade, and you simply buy an out of the money call spread, and that's a debit spread that you pay money for, but you simultaneously sell an out of the money put spread, and that's a credit spread. So you use the money from the credit spread to pay for the debit spread. So you can often do this for a credit, so it doesn't cost you anything. And if the market moves higher, then this would do well. If it went sideways, it really wouldn't matter because you did it for a credit anyway. And if it even dropped a little bit, it would be okay too. The only thing you have to worry about, of course, is if it really dropped quickly, then you'd have to cover your risk on the short put spread. And we'll show you how to do that as well. And that's automated, just as the profit taking can be automated. And we just looked at a bullish position. Here's a bear hedge where, again, you collect premium by selling an out of the money call spread here, and you simultaneously buy an out of the money put spread, often for a credit. We typically only do these for a credit, or maybe neutral or even money. But that's just an example of some of the directional strategies that you can use that don't cost you anything. So keep in mind, we mentioned it briefly, but rookies do this one thing over and over, and that is majority of small time traders are buying the most basic call and put options, and they have a much lower probability of profit versus advanced strategies like option spreads. So we don't want to do what rookies are always doing. And even here, this gentleman, John Foley, he's CEO of Options AI. He says everybody in the business knows that if you're only buying out of the money calls, you're likely going to lose money over time. So we'll look at professional strategies driven by technology. That's what our Theta Trader software does. Our proprietary algo will create these theta trades, these one-touch responsive alerts, bull bear flat market conditions, and we use automation for risk and profit tracking with that risk thermal indicator. That's the color-coded strategy. So we'll go ahead and let me switch screens while I jump into, let's take a look here. Oh, wait a second. Okay, give me 1 second, folks. Okay, I'm in the right spot. Okay, now you're looking at my screen here for the Theta Trader dashboard. And it'll look really similar to yours. Some of the menu items will be different, but this is a demo account I use for presentations and webinars and so forth. So up top, you'll see active trade alerts, and here you'll see the Theta trades for the day. There are bullish strategies, bearish strategies, or neutral, non-directional, and you'll see the three markets we're focused on. Those are the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And you see all the strategies here are already pre-populated for us, whether you're bullish or bearish or non-directional. And you'll see on the dashboard any open short positions, basically any short spreads, premium collection spreads here, anywhere from 37 to 68 days on these trades here. Any open bot positions are down here. And then this is your account information all integrated with your AltaVest trading account. So Theta Trader works with your AltaVest trading account. So that's just kind of a brief review of the dashboard, but let's look at a couple trade examples here. So we'll look at a neutral strategy and we'll look at the condor. It has 37 days till expiration for the July into month, and see the strike prices are already pre-selected for us. And you'll see your maximum profit potential at expiration, targeted annualized return at expiration. You don't need to know those things. It's all explained, but just thought I'd point it out. And you can see the graph. So here's the current price. You're selling an out of the money call and put spread simultaneously and collecting premium. Here's the expiration date right here. And we'll look at some of the details. Let me expand. That should be good. You can see that okay, hopefully. So you'll see 37 days till expiration, your settlement value, put risk, call risk, commissions, cash required. And the main thing I want to point out here is you're selling a 6,700 put and the delta is 9.03%. So that means there's over, it's just basically a 91% probability that this put you're selling to someone else will expire out of the money. And then look at the calls, 4.77, so 95% plus probability that the calls you're selling to someone else will expire out of the money as well. So again, you're looking at the chart, you look for the market to stay in this range between the red lines. That's really what it amounts to. And then the default is a sell because you're selling and collecting the premium. You can change the quantity up or down here and it changes everything here. And we'll just go ahead and do 6 of these just for the sake of the demo. And it just shows that you're filled and that's it. Now let me show you the dragonfly. Here's a dragonfly strategy. And you can see there are anywhere from 33 days till 68 days of expiration trades to choose from today under the dragonflies. And you can see the calls you're trading here and the puts you're trading here. So again, stay between those red lines. That's what you're looking for. And that purple vertical line is the expiration. And you'll notice again, the same kind of information, but the cash required is higher than a condor because you're trading in increments of 4 puts and 4 calls every dragonfly. And then for each option that you're short, you buy an option as protection. So I don't want to get too deep into the weeds, but see, you're selling 4 of these calls, but you buy 3 further out of the money and then 1 closer to the money. So these are all coverage strategies, never naked, and it's the same structure on the downside. And the dragonfly is a little more risk averse, has a little less profit potential, but still you have these higher probability outcomes with the puts and the calls that are being sold. Over 90% probability and about a 93% probability that these puts and calls you're selling to someone else will expire out of the money, and that's based on the delta. So we'll go ahead and why don't we do 5 of these? And there you go, just that easy to place a trade. And now let me show you, there's also a trade simulator as part of Theta Trader. Let me squeeze this down. I want to show you sometimes the difference between a condor and a dragonfly. You can use these buttons here to go backwards and forwards in time. And this happens to be a trade from, let's see, April 30. And we'll just watch and see what happens here. This was just a trade that was available on the website at that time, this June iron condor for the S&P 500 mini. So you can see here it's kind of trading still below the red line, the short call, but it's turning yellow, turning green, and all these colors essentially telling you that green is good, yellow is elevated risk. See, the trade is a little negative still, just because it's getting closer to this upper boundary here, but still do nothing. Then it turns green again, so the trade is maturing and theta decay is working. And then you get a profit taking signal here, and you can automate this. So when it turns blue, the orders are automatically placed for you. So the nice thing about this is you don't have to watch this day by day. Theta Trader is tracking it for you, and it will place that order for you and manage the risk for you. So that is on June 12th, you close out that position on the condor. But what if you had done a dragonfly? Let's find out what happens. What's the difference? So the market's doing the same thing, obviously. And you have some yellow RTI here that says, well, market's getting a little nervous, or at least the position's getting a little nervous. You're getting orange, elevated risk, but still don't do anything. And look at this, you get a profit taking signal on June 8 with 11 days till expiration. And you compare that to the condor where you had to stay in that trade, an extra 4 days or so before you could close it out. So the dragonfly can sometimes mature more quickly than a condor, which is a really good selling point for the dragonfly. And then there are times where a dragonfly will actually be more robust and will not trigger an exit signal, and a condor will. So that's the trade-off. The dragonfly is a little more risk averse, has a little bit less profit potential than a condor. And then here is, any number of bullish strategies you could use. Here's an example of a bullish bull hedge that we call and the colors are different. They have a different meaning when you're bullish, with a debit spread versus a credit spread. But you can see here, the market rallies. And of course, this trade would do very well because you sell this put spread, you collect money, and you pay that, you buy an out of the money call spread. And then of course the market's rallying, and that would do very well in a situation like that. Here's a bear hedge, just the opposite. Maybe you think the market's going to be bearish, but actually what happens here is really nothing. Even though it drops, the trade still expires, but you were able to place the trade when you started the trade at a small credit. So that's one of those things where it doesn't really go anywhere, but it still didn't hurt you. And of course, if it did run against you, then you'd have to cover the risk on the one side. Now, I want to point out too, we have research available in our Theta Trader platform. You just go under the account section here, you'll see Trade Scope, and it's a daily proprietary research piece we put together. We look at a few graphs and look at the global macro landscape and some other identifying flows and so forth with options flows. But that's just 1 or 2 pages. So it's really convenient for people and clients. They like looking at that. And let me show you how to handle your settings now. So you go under the account section here, you go under settings, and this is important to activate your risk manager. You click that button there, and then you can use the default level of 0.50, which is what we're using here in the demo. Or you can use a different level, 0.38, or a custom level for your risk. You can go anywhere from 0.5 to 0.25. And just keep in mind, if you go down to 0.25, your losses per trade will be smaller versus say 0.38 or 0.50, but you'll have more frequent losing trades. The magnitude of the losses will be smaller, but the frequency will be higher. So I just use 0.50, and you just go ahead and save those settings. And then you can save the settings for your profit directive as well. So you just check that box and save your settings. So what happens is when you reach particular profit thresholds, it will automatically close those positions out for you. And here's an idea here of, you don't have to look at all this right now. I'm just showing you in the glossary. Here's how the color coding works for the risk thermal indicator. It's all explained here. So it's very helpful. And then I also wanted to point out what might be, I think, perhaps the best feature of all. So if you notice, we'll go back to our dashboard here. You'll see these trade alerts that are here. So there's 2 trade alerts for the day. The first one here, you can see it. Excuse me, I've got a frog in my throat. You can see here we're doing a July week 2 NASDAQ 100 call spread, and then you're buying a put spread in the same expiration. Okay, so this is an alert that would come to you in your account if you didn't have any similar positions and if you had available capital. So that's the nice thing about these alerts. They're specific and they're tailored to you and your account. And you can see a brief explanation here of the trade. And I'll point out here the quantity. It's all pre-established for you in your account. Increase that just a little. So you don't have to do anything other than read it, and then you can decide whether you want to place the trade or not by accepting it or rejecting it. But you can lower the quantity if you'd like. You cannot increase it, increase the risk. But maybe you want to do 16 of these for whatever reason, or 14 or 12, and you can certainly do that. And you can see all of the premium numbers and the cash required numbers changing along the way. And then we'll go ahead and just accept that trade. And it's just that simple. Now here's another alert. This is for a dragonfly. This is the August in the month dragonfly. So you can see the structure there. You're trading these calls and you're trading these puts, and it's a non-directional strategy. You look for the market to stay between essentially those red lines. And again, the quantities are pre-selected. We'll go ahead and just take it for the suggestion there and accept that alert. All right, folks, so that's how simple it is to use the Theta Trader dashboard. And I want to show you, let me switch gears again. Let me go ahead and show you how this works with your phone. So we're going to look at these one-touch alerts using your phone. That's how most people use them. So these are, again, these alerts are live. They're integrated with your AltaVest account. All you have to do is touch accept to get that order placed. It's just that simple. So here's an example. You'll get a text message. It's a link. And you'll click that link. And it will take you to the alert page, very similar to what you just saw. So this happens to be an alert for another dragonfly. Those are the calls, those are the puts. There was the market trading. That purple vertical line is the expiration date. I should also point out that all these trades are going to be closed out before expiration date. So there's the quantity. You can move that lower, but you can't go higher. See, it won't allow you to move higher, but you can go lower. And it explains the premium you're collecting and how much the cash required would be, or your margin deposit, essentially. And then you like it and you just touch accept, and it's that easy. So here we go, folks. Let me show you how to get started with Theta Trader. So Theta Trader is the software that we just saw, including all of the Theta trades, the risk thermal indicator, the color coding, the trade simulator, everything you just saw valued at over $3,500. And then that also includes the one-touch trade alert technology. We just saw a demo of that. That trade alert technology is valued at $4,400. And I don't think you've ever seen anything like it. I know I still haven't seen anything like it after all these years. But so you get all the features that we just discussed here, plus you get us, private coaching. It's not just technology where you don't ever talk to people. This is part of what we do is we offer the one-on-one coaching. We're all licensed, we're all experienced. We'll do like a screen sharing session. And I just asked AI a little bit ago about private trading coaching, and they said here packages with experienced mentors range from $5,000 to $15,000 for a 6 to 12 month period of time. And I would suggest that that's probably a little bit low, because I've talked to people that are paying $25,000. So in that sense, I think it's a great deal where you get to work with all the technology and real people. But I think the value here, even at $10,000, is probably undervalued. But we'll be your co-pilot. We'll discuss your trading strategy, your trade history. We can review that with you. You'll develop a relationship with us. We're all, again, licensed and been doing this many years. So everything you've just seen in Theta Trader, the technology, the alerts, the automations, the coaching, valued at over $18,000. And there's always more, right? There's always that infomercial kind of thing. You just wait, there's more. We don't want you to forget about the daily research newsletter, TradeScope, and that's all only available and exclusively available to our Theta Trader clients. And if you've never traded futures or options, it doesn't matter. We've got you covered because we have a futures and options masterclass. So we'll give you everything you need. Futures basics, stock index futures, options reviews, options on futures, spreads, advanced strategies, you name it, it's all covered. It's almost a $2,000 value for that futures and options masterclass, along with the TradeScope newsletter. So that's really the research and the knowledge and the learning that you need. If you need it, it's available for you. It's all part of the Theta Trader package. Then there's online tutorials. I didn't show you that because we don't have a lot of time, but I wanted you to know that those are available within Theta Trader, short video tutorials. So again, just to summarize, you have the Theta Trader software, along with the alerts, along with the personal coaching, all of the information, knowledge, training, research, everything available as well, valued at over $21,000. And of course, that's not what we're going to offer that as. And we used to do this package for $4,000 in live or in-person events. You'd have a table at the back, and we'd have a great time with people, meeting people and presenting, and then people would sign up at the back of the room for $4,000. But of course, we can do a lot better than that. This is our retail price here if you go to the website, but we'll do even much better than that for you for the Traders Corner event. And this is just a one-time payment, and this is a lifetime membership. So I want everyone to pay attention because sometimes people get the idea that, oh, well, this is every month or whatever it is, but no, it's one payment of only $497. So you can use the QR code, you can use the link cf.altivest.com/TT, and that's my number, that's my email. And it does expire though, so we want to get you on board and sign up, and we'd love to have you, join us and on board with us. And really, there's no excuse because let me tell you why there's no excuse. For one thing, you can get a rebate if you have $100,000 or more in your account. We'll rebate that entire membership. 25,000 and above, you get a 50% rebate. And more importantly, there's a money back guarantee. So you have no risk on the membership fee, folks. So really, really the thing to do is you get yourself signed up, become a member, and then you'll receive your login credentials. You'll start getting the trade alerts right away. You can start using some of the Theta trades and the platform yourself. And you've got really 30 days to use it. So if for some reason something happened, you changed your mind, then that's fine. Just ask us and we'll just rebate that membership fee for you. But really the best way to do it is to sign up, get yourself started. And how about some FAQs? How about advantages of E-mini options? Well, there's a lot, but they talk about defined risk, reduced volatility exposure, improved probability of profit, cost-effective directional and range strategies. So we looked at that, directional and non-directional range strategies, better time decay. So you're capturing that theta decay. And they talk about one thing here that we didn't get into, but execution and liquidity. That's really the big reason you want to be in those E-minis. They're so deeply liquid. You can get the execution on those. They call them multi-leg execution, multi-leg combos, multi-leg execution. So that's a big selling point. So I wanted to point that out. When you're doing a trade like the Dragonfly, that's six different option strategies, or I'm sorry, six different options, period. And you trade that all as one order at one price here. And you can't do that with security. So that's why we like the E-minis a lot. Big advantage. And also, if you're doing just a couple markets, you don't have to pay attention to the 6,000 other markets. So you've got these premium collection spreads, so limited risk professional strategies, customizable for any size account, higher probability outcomes, looking at the deltas if you're selling premium and collecting premium. And then these are flexible strategies. Any market condition that we kind of looked at, whether the market's up, down, or sideways, there's always a position or strategy available. Then you have that wide margin of error when you're doing premium collection. So you don't always need to accurately pick a direction. So for example, here's just a trade from yesterday. You're selling these 8,025 calls, that's the red line, and the 6,350 puts, that's the red line here. So you have over 1,825 points between the short calls and the short puts in this particular example. So that's a really very wide margin of error. And so you've got those short option strategies where you collect premium. Again, non-directional. You want the market to stay in those green lines. Or maybe if you're bullish, you might want to sell some out of the money put spreads. You could do that too. If you're bearish, you might want to sell some out of the money call spreads. You could certainly do that. You're collecting premium in all of these cases here. And then there's also long option strategies or debit spreads. They can be useful at times, and they offer limited risk, but they all have a asymmetrical return profile. So they do have a lower probability of outcome. That's because of the delta, of course, on those. But if you do have a winner, they can be a nice winner. So here's an example where even a non-directional long option strategy like a straddle could work. You know, if you're thinking there's going to be a big move up or down, you could certainly buy some calls and buy some puts simultaneously, look for a big move up or down. If you're really, really bullish, you could certainly buy a call spread, a debit spread. So you buy a call spread here, or if you're really, really bearish, you could certainly buy an out of the money put spread. But again, those are lower probability outcomes, but they do have a higher potential payoff. And another advantage, there's no margin calls when trading option spreads the way we do it, because all of our strategies are covered. So we're not doing any naked options trading. These are all covered strategies. So there's no unlimited risk and there's no margin calls. So you don't have to worry about that. And there's tax efficiency when trading on the E-mini options and futures. So what we're talking about is these are called 1256 contracts as identified by the IRS, and you get favorable tax treatment. 60% of the gains are taxed at the capital gains rate versus 40% taxed at your personal income tax rate. So for most people, that's a big tax benefit. And there's no more itemizing as well. You receive a 1099 with your profit for the year, and that's just that one number that you would use for your taxes, and that's all you have to use. But of course, always consult your tax attorney or your tax advisor for details on that. Then people ask us about IRAs. Absolutely, we work with Equity Trust, and you can do a self-directed IRA with us as well. And Equity Trust will actually waive your setup fee. If you come to them and you say you're with AltaVest, then they'll waive your setup fee. So they're great. We've been working with them for many, many years. We've got about, well, I bet they have more than now, but 71 billion as of June of last year. I should get that updated. So they do a great job. But remember, we're full service futures and options brokerage. So we can also do more than what you just saw. So if you're interested in any of these other markets, we can certainly do that as well. And we think it makes a lot of sense to diversify your portfolio with these alternative strategies using automation and what they call non-correlated option strategies. You can speculate or hedge your stock portfolio. So there's that gray slice of the pie there and alternatives. And that's really what this is all about, kind of having an ability to be flexible, go anywhere strategies where you're not just relying on being bullish all the time. All right, so to summarize some of the key benefits of what we just looked at, these are flexible strategies for all market conditions. Professional credit and debit spreads are simplified and automated. Convenience of automation for risk and profit controls. Diversify or hedge with this non-correlation. You know, if you've got a stock portfolio or something, maybe you want to buy some put spreads as protection, you could certainly do that using Theta Trader. You've got the tax efficiency. You have those one-touch responsive alerts. And again, we mentioned no margin calls. We're only doing covered option strategies. So I know that's a lot of information and you probably have some questions. I'm always available afterwards. I might be out of time, a minute or two here to go, but I'll just leave it on this last slide. But again, 30-day money back guarantee. So you don't have any risk on getting signed up, getting your login credentials, and starting to receive those alerts right away. You might like to see what we're doing and kind of take a peek, and sort of, even test drive it in some way by getting signed up and finding out exactly how we do things. All right, I think, let's see if there's any comments or questions. I'm not sure here. Let me see if I can find those. I think I've only got about a minute here. Let's see, do I have any comments or questions? For some reason, there we go. Yeah, thanks for putting up the offer there, Anthony, but I think that's it. I see comments and questions, but I don't think I can get to them all.
Okay.
And the best thing to do is just call me. And
I could say a few of them if you can't see it.
I see now. What time are the alerts sent? Market hours, during market hours. And some Canadians are accepted. You just have to tell us what province you're in. And then win loss, give us a call and I'll tell you how that works as well. We don't have any we don't promote any track record because we don't manage money formally. So from a compliance perspective, everyone has a self-directed account and everyone accepts trades differently or not accept them or modifies them in their own way sometimes. So it's not really apples to apples, if that helps answer the question. Best thing to do is actually just get registered and signed up and start receiving the alerts yourself and using the simulator as well.
All right. Thank you, Eric. Looks like Jim Barker had his hand raised as well. Jim, give Eric a call or email him. We're not really using the raised hand right now for the questions. We're just kind of putting things in the chat. So if you have a question, just put it in the chat. When we go to do the drawing later today, maybe we'll use the hands instead of the thumbs or something later to see, who's still here if your name is called and whatnot. So thank you, Eric. That was a fascinating look at how automation continues to reshape the trading industry. We appreciate your valuable information, generous offer, and your time today. I've posted Eric's special offer link in the chat box, so be sure to check that out or use your phone and just put it up to the screen there with your camera. And don't forget about today's $100,000 prop account giveaway sponsored by Prop Shop Trader. And so thanks again, Eric.
Yeah, thank you. Thank you for having me, Anthony.
Yeah, thanks for being here, man. All right. Next, we're going to welcome Daniel Sinning of Trading Indicators. Dr. Sinning is a professional trader, software engineer, and one of the industry's leading developers of trading indicators.
Yeah,
Hey,
thanks, Anthony.
You're welcome.
Hey, guys.
You're on screen there.
Perfect. Can you guys see me and hear me?
Yeah.
Awesome. All right, guys. Yeah, let's get into today's topic. And I'm going to show you today. First of all, welcome and thanks, Anthony, for putting all this together here. What an amazing event as always. And today I'm going to show you how to find high probability swing trades in just a couple of minutes. This is perfect for everyone who has little time on their hands. We all have busy lives. Many of us don't have time to look at charts and to go through statistics and fundamentals and so forth to find interesting trade ideas. Today I'm going to show you how this can be done in just a matter of minutes using a very systematic process. It's almost mechanical. It's this systematic. It's something everybody will be able to replicate afterwards. I'm actually going to find some interesting stocks which are relevant right now here and today. So that's what we're going to be doing today, but I'm going to lead and build up to it. So first off, to just ease in today, I'm going to give you a use case. So we all know the stock market is very vast. There are thousands of stocks to trade every single day. Now, there's so many out there. However, as the market goes, some will go up, some will go down. So is it really just a coin toss in the end? And we asked ourselves the question, can we do better than a 50-50 than just simply a coin toss? And the answer is absolutely, we can. And this is possible if you use a systematic and repeatable process, which will give you a market edge. Where the market edge lies, we're going to discover together in this webinar. Now, here's some examples. Some of our trade ideas, or we have a newsletter which comes out every Monday, and in that newsletter we have the trade idea, or the swing trade of the week, we call it. So here's some examples of the alerts that we put out recently, just a couple of weeks or months ago. Example number one is a company called Parker Hannifin, and this all takes place in the swings trading space. So what you see here is basically a daily chart on the daily time frame. And this is straight from our newsletter. This is not something I prepared for this presentation. I just copied it from our newsletter, which I think this was published maybe 6 weeks ago, perhaps 8 weeks ago. And what you see here is the typical setup that we are looking for. So typically what we look for is a stock that's trending up for quite some time. You can see it here. Prices have been going up for quite some time, but have then pulled back a little bit. And to us, a couple of things. The pullback just needs to be right. Cannot be too small, not too big. So just in the sweet spot. That's important. We call these the healthy pullbacks. And ideally, the pullback should coincide with a strong support level. And if these things come together, well, we pull the trigger and we announce it as one of our trade ideas of the week. So this is Parker Hannifin. You can see prices came up, pulled back to this red line here, support, and then afterwards, prices jumped up and trading now much higher, probably 10% above where our entry was. You know the example. Similar story. It's all going to be very similar. Amphenol. Long-term uptrend. Condition number one. We pulled back just the right amount, not too small, not too big. We can see it on this indicator here. I'm going to talk about this in a bit. And the pullback hit a key support level. Once again, we pulled the trigger. Long trade alert. And look what happened here. A beautiful bounce off this level towards much, much higher price levels. Worked out beautifully. And one more example, and you can see it's quite mechanical. We're trying to keep trading as simple as possible. Same thing here. Long-term uptrend, pullback, 3 levels down. I'm going to talk about this indicator in a bit, and coinciding with a key level on your chart. And you can guess what the outcome is. The prices bounced up this level towards much higher price levels. That's the key idea. And today I'm going to show you how to find these particular stocks. And I guarantee you, every single day, new stocks will qualify for this particular setup, and some stocks would disqualify, obviously. But there's something new every single day. And this is possible since we are able to scan through a vast universe of different stocks. So we look at the S&Ps, the NASDAQ stocks, the Russell, and so forth. And I'm guaranteeing you every single day there will be a particular stock which qualifies for our criteria. Now, we're trying to be as systematic as possible. And in fact, we have 3 easy steps to follow. First, and this is more like a bit of a homework or educational step. Once you've mastered it, you don't have to do it again. You need to understand what drives the market. So that's important. Now, what are key levels? Where do these levels come from? How will price react to some of these key levels? That's important. But that's more like a one-time thing. You need to understand once you master it, you don't have to revisit this topic again. Secondly, we need to be able to find these stocks. And what we have developed on our end is a scanner, a stock scanner, which can find stocks which fit exactly these criteria. Now, there's all kinds of scanning possible, but today I'm going to show you one of my favorite criteria to find these high probability swing trading entries. And of course, once you have a setup, then we need to decide, hey, how are we going to trade this setup? Are we going to use options? Are we going to trade the underlying outright? Are we going to be aggressive with our trade? Are we going to be more conservative? So that's important as well, because every setup can be traded in many different ways. Some are better, some are perhaps not as good. And this is exactly what I'll be talking today. So if you guys are ready, be comfortably seated, let's get into it. Just real quick, Anthony already mentioned my name. I'm Daniel Sinnick. I am one of the founders of Trading Indicators. And as our name suggests, we specialize on creating innovative trading products. We have written more than 1,000 trading indicators for clients all over the world. We're based out of Canada, but most of our clients come from the US. We work with many trading educators together. We have developed indicators for many influential people out there, but of course also our own indicators. And today what I'm going to show you is a sample of our flagship indicators, which we use to analyze the chart, and our trade scanner, which can find or handpick for you some of the symbols and stocks which qualify right now for some of the criteria that we're looking for. Right. So with this, let's get into it. Just a quick reminder that trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies and setups discussed in this webinar or in this presentation should not be construed as trade advice. These are for educational purposes only. All right, now the legal stuff is out of our way. Let's revisit our systematic process. So knowing what drives the market is step number one. Finding stocks which currently have interesting technical setups is number two. And then planning out our trade is step number three. But let's start with the first one, knowing what drives the market. Now, what we found out, and what many traders out there have found also, is that every single price chart, it doesn't matter what it is. It could be a daily chart. It could be a 1 minute chart, a 5 minute chart, a tick chart, a Renko chart, whatever it might be. Every single chart has what we call landmarks. These are special areas of price which have forward-looking properties, which have relevance moving into the future. And that's very important because as traders, of course, we want to predict to some degree where and when price will be in the future. This is what trading is all about. Most of what we trying to do is to really make a directional bet. Hey, where is price going to be? Maybe in a month from now, in a year from now, or whatever that might be. So these landmarks, they will help us with this. I'm going to give you an example in a second, just to show you what this could look like. So for example, here on this hypothetical chart, we're going to get very concrete in a second. We can see that, all on top here, this dashed line, this is what we call a landmark. And the reason why this one exists is because back maybe a couple of months or years back, we had this historical high here. And sometimes under certain circumstances, historical highs can form a landmark. And what you see later on is a price, maybe many months or years later, came back up to that level, and then just like almost magical, bounced off this level towards higher price levels. This landmark was acting as resistance. Or similarly here, you can see these series of swing lows. Also, these ones have created what we call a landmark. And later on, in the future, that's really important, forward-looking, price came back and down to this landmark and bounced off it, couldn't penetrate, bounced off this landmark towards higher price levels. Now, we are not the first one talking about these landmarks. In fact, there are many different names out there. They may be called swing points or support and resistance. These are the terms I just used, or perhaps liquidity levels or zones. It doesn't really matter what you call them. What's important is that you are able to identify these levels on your charts. And you may wonder, and I don't want to talk too much about this, why is that? Who is responsible for having these magical lines or areas on your chart which have these forward-looking properties? Well, I'll tell you one thing. It's definitely not us retail traders. We don't have the buying power to move the market in that way. It's the big ones, the culprits, the institutions, the big money traders who have the buying power to influence the market in that way. But the good news is, even though the big guys, they're calling the shots, what we can do as retail traders, we can follow the patterns. We can follow the footprints of these hidden landmarks on every single chart. Now, let me give you an example of what we can do once we know where these levels are. So here is a very practical example. Now, this is from an actual chart. So what we see here is how price can react to these levels. Let's say we are able, I'm going to show you in a bit how we can do it, but let's say we already know where these landmarks are on the chart. For example, we could have a support level down here at around 33.60 and a resistance level all the way up here at 44.14, give or take. It doesn't have to be exact, but that's the ballpark where these levels are. Look what happens to price. Now, and the first thing I want to point out is, oftentimes on your chart, you will find price somewhere in the middle of these levels. There's support all the way down here, resistance all the way up here, and price is somewhere in the middle. Typically, what happens next, and there's some trading approaches out there, especially with options, where you can make a bet on this. Price will not stay in this middle ground for too longer, because oftentimes these levels here, they act as magnets. Yeah, when price is in the middle, they act as magnets, and price will be torn just like torn from or pulled from a magnet towards one of these levels. So in this case, price came down towards this support level. It didn't stay in the middle part and went all the way down to support. All right, so now price is down here at support. What do you think may happen next? Well, support is called support for a reason. Oftentimes, under certain circumstances, oftentimes it will prevent price from moving further down. Instead, price will bounce off the support level towards higher price levels. You see this here, price bounce at this level towards higher price levels. And once again, we're back in the middle. And you already know what happens now. We are in the middle, and these two levels will once again act as magnets and draw price either back up to resistance or to support. That's hard to guess which one it is, but the guess would be, or the expectation would be, price will not stay in this middle ground for too longer. And as you can see here now, price subsequently moves up. In this case, moves up all the way to resistance. Okay, so now price is at resistance. What do you think happens next? Well, also resistance is called resistance for a reason. Price is bouncing off resistance towards higher price levels. You can see it here. Bounce lower. Okay, we went all the way from the middle down to support. We bounced all the way up to resistance, bounced again, and now we're back in the middle. We have these two magnets on each side. Price will not stay in the middle for too long, and we're coming further down again. Once again, we are revisiting support, and once again, you could argue, okay, we might be bouncing off support towards higher price levels. And once again, I can see it here, we bounce higher. But in this case, this will not go on forever. Oftentimes it goes on for quite some time, but it will not go on forever. Eventually, each level will be broken. But when this happens, also new opportunities are opening up again. So price now went all the way up. It broke above resistance here. Now trading above resistance. Okay, quick question to all of you. What happens when resistance is broken to the upside? What happens to that level? Well, its role will change. And you probably have heard before, resistance will become support. And this is exactly what's happening here. Now, have a look. So price is now above this level. We could possibly trade a breakout move here to the upside. But oftentimes before we do, the market tries to fake you out a little bit, comes down again. You can see it here. But now resistance is acting as support, preventing price from going further down. And we can expect once again a bounce from this level towards higher price levels. Look at this. We bounced higher again. And then we're higher here. We're retracing once again. Where do we go to? Well, once again, towards this broken resistance level, now acting as support. And once again, we can anticipate a bounce off this level towards higher price levels, and off we go. This is the magic of knowing where these levels are, because we can predict how price will react to them to some degree of certainty. This is exactly what we focus on in our trading. And of course, you will now say, hey, Daniel, how can you know where these levels are? How can we find these zones and levels? Because the whole approach makes it or breaks it by knowing where these levels are. Well, we have written and we have dedicated years of development and optimization and trying and developing to create an indicator designed to identify these key levels on your chart. This indicator is called Liquidity IQ. I'm going to show this one to you in a second. It has become so important to us here at Trading Indicators that we cannot trade without. This is the only indicator which is always on our charts, no exception. It doesn't matter what kind of trading we do. We do a lot of short-term trading too, like from the small time frames. This indicator is on our chart. If we do swing trading, this indicator is on our chart. We cannot trade without knowing where these levels are. All right, so this is our bread and butter. We develop innovative trading indicators. But of course, you may now say, hey, Daniel, okay, it's great to know where these levels are, but I still would need to go through every single symbol in the stock market to see which stock right now has an interesting setup, where perhaps price comes down to a key level and we may anticipate a bounce. Good question. We have an answer for you. We have developed what we call a trade scanner, which will allow you to find symbols which currently, right now, have setups. This is how it looks like. This scanner is called Liquidity View. It's basically a dashboard which has the scanning component on the left-hand side and our charting component with, of course, our Liquidity IQ indicator on it on the right-hand side. So let me show you how this trade scanner works, because it's really fascinating, and it's a tool, hands down, which I use, which our community uses every single day, because every single day you will find interesting swing trading setups. Let me show you how this one works. I'm not going to go through much of theory here, but let me just show you what is a typical scanning criteria. It's a very flexible scanning, can do lots of things with it. Even earnings scanning and looking for options pricing and all kinds of things. But in this particular case, we're going to keep it simple. I'm going to show you my favorite setup right now. And I alluded to the setup in the beginning already. So what do I typically scan for? Well, I'm a trend trader. I like trend trading. I think it's a fascinating way to make money in the market, and a very reliable way, because you've heard it before. The trend is your friend. Yeah, the chances that the trend will continue are simply greater than the chances that the trend will reverse. But of course, as a trend trader, we don't want to enter blindly into a trend. Even though if we know where a trend is and the stock is trending, we can scan for this. We don't want to enter blindly into a trend trade, because there are good moments to enter, and perhaps there are not so good moments to enter into a trend trade. For example, here, of course, hindsight is 2020. Not such a good moment would have been if prices are very extended, meaning prices are very far from the averages. You can see this little green line here. That's an average line, and see how far price is above this average line. This to me is not the ideal moment to enter into a trend trade. Why? Because at these extended times, the chances of a pullback, of a correction, are quite high. What I do instead, or what we do instead, I patiently wait for this pullback. I wait for prices to come down, to come closer to the averages. But of course, also for pullbacks, there is a sweet spot, because I want my pullback to be not too little. If it's too little, it's not meaningful. And if it's also not too big, because if it's too big, maybe there's a chance of an entire trend reversal. That's not ideal either. I want my pullback to be just right, just in the sweet spot. And we have an indicator designed for this. You can see it down here. This little heat map below this price chart, which is predominantly green, meaning we are in an uptrend. But every once in a while, you see these little red patches creeping in, like this one here. 1, 2, 3 levels down. First row, second row, third row. Or here on the right-hand side, 4 levels down. 1, 2, 3, 4 levels down, while, that's important, while the last row is still green, meaning the overarching uptrend, the long-term uptrend, is still intact, but we corrected down a little bit, a couple of levels within this global uptrend. We call this the healthy pullback. It's just right. It's just, it's not too small and not too big. A healthy pullback within otherwise a long-term uptrend. And now the kicker, and you may know this already. The kicker is we want this pullback to coincide with a key technical level on the chart. For example, a support level if we're in an uptrend. So prices are bullish, we're in an uptrend. This is a very simplified example here. We're pulling back a bit, and the pullback coincides with a key technical level on the chart. Now, 3 things are coming together. We are already trending. The trend is your friend, number 1. Secondly, we saw a healthy pullback, not too small and not too big. And thirdly, the pullback coincided with a key technical level on the chart. So now 3 things are forecasting the same future price move. In trading, we call this confluence, where different analysis or different indicators are forecasting the same upcoming price move, which in this case would be a bounce, because also the bounce trade, a bounce of this level down here towards higher price levels. And this is what I look for when it comes to the stock market. And it's a very reliable technique. So without further ado, I know I talk a lot. Let's check out our scanner. So I'm going to go over to now our great trade scanner. Just drag this in here. Give me 1 second. There we go. And what you can see, first of all, is that on the left-hand side, we have our scanning component. I'm going to talk about this in a second. And on the right-hand side, we have our charting component. And if you are saying, hey, this looks very much like a trading view chart, you would be absolutely right, because we have a license to reuse trading view charting within our scanner. It's independent from the actual TradingView platform, but we can just reuse their charting engine with all the drawing tools, all the built-in indicators, and so forth that come with TradingView. So that's really cool. All right. The second thing I would like to point out is that we are scanning through 6,209 symbols right now. That's a huge amount of symbols. That's a big set. And you probably will believe me that it is impossible and completely impractical to go through every single stock manually to check whether that stock, has a good setup right now. All these different stocks here, or the indicators on there, but you can't really just, go through them manually. It would take you the entire day, maybe even longer. Impractical. But of course, we do have a trade scanner. So let's now scan and filter down from this big universe of stocks to a much smaller subset to see what right now, this moment, is of interest in the stock market. Let's do it. So criteria number one, if you remember, I'm going to quickly just open Agilent here. Let's go to Alcoa. It's easier. Criteria number one is we want to be in an uptrend. We want to find a stock which is currently in an uptrend. I'm just going to go to this Alcoa chart here on the daily time frame. We can see every once in a while we have these labels on our chart. You see these ones here? These ones here: bullish, bearish, bullish, bearish, bullish. They're always alternating, and these labels will show us the current or the trend direction at the time. And depending on what the last label on the chart is, in this case, if you go all the way back to the first label you find, this would be this one here, this will give us the current trend direction. And we're trend traders, we're looking for long entries here. We want to find stocks which are currently bullish. Let's find those. So what we can do now is we can go to our scanner here. I'm going to go to this column here. It's called MA Rush. The name is not really important. It's named after the indicator which draws these labels onto the chart. And if you are familiar with Excel, you will notice this little filter icon to the right of MA Rush. You see this one here? That's a filter icon. You can click on it. You can filter for all kinds of situations. For example, if you wanted to, you can say, hey, I want to see all the bullish stocks. I want to filter out the bearish ones. I only want to see the bullish ones. Because right now, it shows both. It shows bearish ones here, like Agilent, or bearish for 64 trading days. You can see it here. We can see that Alcoa is bullish for 169 trading days, and so forth. But I want to only focus on the bullish ones. How do I do it? Well, I'm going to use the filter and click, all right, bullish. And in the blink of an eye, this is super fast. It's instantaneously, we can see that of our 6,209 symbols, right now, 3,449 symbols are bullish. A bit more than the half, as you may expect. And if you look at this column here, every single symbol has the bullish arrow pointing upwards. And the number to the right of it, that's our trend duration. So let me give you some examples. AAL, American Airlines, bullish for 16 trading days, just recently. And if you were to count your candles from the last one here back to the bullish label, you would get to exactly 16. To me, for this particular trade I'm looking for right now, this particular setup, a bit too short. That's not enough. I want to find stocks which have been bullish for much, much longer. And we can filter for this as well. For example, I'm going to go very extreme. I want to only find stocks or symbols which are bullish for 1,000 trading days or more. That's like 4 or 5 years or more. I'm going to use this filter here. Bull signal greater than 1,000. I click on it, and right off the bat, we're now down to only 127 stocks. And all of these are long-term bullish, like Aflac here. Long-term bullish. I'm going to show you on the chart here. That's a long-term bullish trend. It takes some breaks every once in a while, but the overarching trend is bullish, bullish, bullish for a very long time, for more than 1,000 trading days. Okay, so that's criteria number one. Now we have found stocks which are very, very long-term bullish. Secondly, you remember, we don't want to enter blindly into a trend trade. For example, here for Aflac, I don't want to enter right here. We just went up. We just corrected from a pullback indeed. This is not ideal. Also, we are right below resistance level here. This is not perfect. I want, for my perfect entry, the stock to pull, or the prices to pull back a little bit. Just the right amount. We can see it here on the indicator below the price chart. Look at this one here. Now we have these red patches in there. And we can scan for stocks which are in an uptrend and currently in such a pullback, either 3 levels down. You can see it here, for example, on June 17, we went 3 levels down, or 4 levels down, 1, 2, 3, 4, as we can see here. We can scan for this. Let me show you how this works. So back to the scanner, we have a column called pullback here. And I'm going to select now, okay, I want to see only the stocks that pulled back 3 levels down or 4 levels down. I'm selecting both here. These are the pullbacks right in the sweet spot. Now we're down to only 19. Wow. Let's see how fast that goes. Okay, and every single stock now, like Enid, For example, Arista Network. You can see they pulled back. We came down a little bit. Or for example, this one here, ATH.TO, a Canadian stock. We pulled back. From this strong uptrend, we pulled back. And there's one last thing, the kicker for the whole thing to work perfectly. We want this pullback to coincide with a key technical level on the chart. For example, this symbol here, Athabasca Oil Corporation, is this particular symbol right now, this price right now, near a key level? The answer would be absolutely not. We're actually right in the middle of key levels. Support is down here, resistance is all the way up there. This would not be a candidate for this particular setup. So how can we find these candidates? Well, we have yet another scan in our dashboard. It's this one here. It's called the Liquidity IQ Setup Scan. And in there, we have a criteria called long bounce. And long bounce means prices came all the way down to a key support level and may bounce to the long side. So I'm going to select this one now. And you can see once done, oops. Oh, maybe I was a bit too strict here. 1 second. Nothing is. Oh, yeah. I forgot. Okay, long bounce. There's a lot of, nothing qualifies. Give me 1 quick second. Hang on. I'm going to go back here. In fact, I think I was a bit too strict with my bullish for more than 1,000 trading days. Let me just go bullish for at least 500 trading days. So now we have 182 stocks, and now I'm going to select. Give me 1 second. Long bounce here. And for example, we can see here, okay, one stock that's of interest right now is, for example, this one here, XPO. I'm going to skip this stock here. I think this is a French stock, not so important. But this one, look at this, XPO Inc. What do we see here? Long-term uptrend, pullback, 4 levels down, 1, 2, 3, 4, trading right at the support level right now. That to me is an interesting setup. This is something I might be trading today. Yeah, because my expectation would be, hey, we might be bouncing off this support level towards higher price levels. Let me give you another example. This one here, EWU. Now the iShares MSCI United Kingdom. What do we see here? Now we made all-time highs back here in March, then a bounce of support. We went higher. Now another pullback back to this support level here, level 4 pullback. We may see another bounce coming up here towards higher price levels. These are the setups I trade all the time from a swing trading point of view. It's a very reliable setup. Yeah, and there's one variation of it. Let me just show you how this one works. I'm going to go in here and select this criteria here as well. Long break retrace. Just to give you an example. So I selected this one here, and let's just look at the first stock here, Rider System. What do we see here? It's a great stock. Super long-term bullish for many years. Bullish, just one direction of the stock. You can see it here. Beautiful. But what do we see here? Prices on, let's say on June 3rd, broke above this green line here. It's a bit hard to see, but there's a green line here. This used to be a resistance level. We broke above it. And now remember, what happens to resistance when it's broken to the upside? It changes its role. It now will act as support. So what we can see here, price initially went up, but then retraced back to this former resistance level. However, now acting as support. And now we could potentially expect a bounce off this level towards higher price levels. This is based on yesterday's end of day data. And if you look at the live data here, we can see, hey, the bounce is already happening. Yeah, price already bounced up a little bit from this price level towards higher price levels. These are the setups I like to find when it comes to swing trading. All right, so let me quickly go back to my slides. And of course, if you have questions, guys, please don't be shy. Put your questions into the chat box. What did we see so far? Well, we have seen that our trade scanner, it's called Liquidity View, comes with our flagship indicators. Liquidity IQ for finding these key levels on your chart, which are so essential to our trading approach. Because I cannot trade without these levels. If price is not near such a level, I typically don't engage into a trade. So this indicator comes with the dashboard. Also, our trend indicator, it's called MA Rush, the name is not so important, is included. Meaning, this is the indicator which allows you to find stocks which are trending right now, which are, for example, in an uptrend right now. Or perhaps if you're looking for shorts, which are in a short trend for quite some time. And then we have our trend radar indicator, the one that was below the price chart, this one here, which shows us whether we're currently pulling back, and if that pullback is in our sweet spot. This is also included along with all the scans that come with it. So this is a a very effective way to find interesting setups. And what I showed you today was just one way to find setups. We call this the healthy pullback trade. There are many different trades possible as well. I want to show you an easy example today. We have an entire boot camp available for you, which you can go through. It's more than 3 hours long, which explains every single feature of the dashboard. There's so many things built in. You can, fully customize everything. You can create your own watch list. You can get trade alerts. You can even add a trade journal. You can add your trade notes to it, and so forth and so forth. We also have columns for trading options. We can filter for all optionable symbols, which have an options chain, which is liquid. We can filter for options pricing. Where, for example, right now, premiums are very high if you're a short seller of options, or perhaps if you want to go long options where premiums are relatively low. All these things are possible with our dashboard. Now, the last thing I wanted to quickly mention is, okay, now that we found an interesting setup, for example, for Rider, the stock Rider, which we just found, how do we trade it? And that's a really good question, a question that you should always ask yourself, because oftentimes there are many ways to trade a particular setup. It really depends on what kind of trader you are. What is your trading personality? Are you more conservative? Are you more aggressive? Do you think more like short-term swing trading or perhaps long-term investing? Do you prefer trading with options to have some extra risk management included? Are you perhaps interested in cash flow, maybe writing options, selling options, whatever this may be? This is a topic on its own. And luckily, we don't leave our traders and our community members alone with this topic because it's loaded. We guide them through their right approach. We offer multiple times a week webinars, teaching webinars, educational webinars where we tackle exactly these questions with lots of examples. So this is what we offer to our members. So should you think about becoming a member of our trading community, you will not be let alone. So we have a Discord channel where you can ask questions. We have multiple webinars every single week, all led by me. We have scanning sessions where we scan every weekend. We don't stop even on the weekend. We're doing stuff. We're scanning for setups for the next week. We have an options alert newsletter. We have boot camps, master classes, and so forth. Now, you may now ask, hey, I want to try this one out. I would like to give it a try. Well, you can. And we actually have a super special offer for you. So typically, our dashboard costs $9.97 a year, the trade scanner you've just seen, which I personally use every single day. It's essential to my swing trading and option trading approach. Absolutely. But today, you will not pay $9.97 a year. You will only pay half that. You will get a 50% discount for the first 5 users that decide to take advantage of this offer. So 50% off. And also, we will include 3 bonus offers. And Anthony, if you can, please put this link down here, tradingindicators.com/corner, into the chat if you can. Otherwise, I will quickly paste it in there because this is the offer link, which will allow you to take advantage of this offer. So you go to this page here, tradingindicators.com/corner, and you say, hey, I would like to, use the dashboard. And then what you need to do is also explained on this page. Once you go there, you will need to enter the discount code GET50, like get 50% off. So you enter GET50. It's explained on this page here as well. And then you will get a 50% discount for the yearly subscription of our dashboard for the first 5 users. And we will also supplement this offer with 3 bonuses. And bonus of first 10 users, I misspoke. Sorry, first 10 users. Bonus number 1 is our options alerts service. So every week, or every weekend, in fact, every Sunday, we send out a very comprehensive options alert letter where we analyze the market, where we find options trade for you, which are typically in the strangle space, option strangles, but we also have longer term directional plays and credit spreads involved. And these are for you to check out. And the first 10 users will get this additional bonus. It's valued at $197 a month. You will get it for free for the first month. And of course, there's no obligation. You can cancel at any time. So that's bonus number 1. Bonus number 2 is you will be invited to our exclusive live market sessions, which are happening every single Tuesday at 12 p.m. Eastern time. The next one, of course, scheduled for next week, June 30th, 12 p.m. Eastern time. Like clockwork, I think we now had of about 150 of these sessions consecutive. So every single week we have these exclusive live market sessions. A great venue for all of you to ask questions, to learn tips and tricks, and to, I guess, get to know our trading community. We have a very friendly and engaged trading community, and you will be invited to these sessions. That's bonus number 2. And bonus number 3, you will also be invited for our live boot camp for the Liquidity View dashboard. It's going to be a very comprehensive boot camp. We already have one, which you'll get right away, but we're going to re-record it and have it live as a live session on July 9th at 4 p.m. Eastern time. You will be invited to this as well. And the reason why we are having this live bootcamp is to teach you basically every single feature of this dashboard. It has a lot of stuff to offer. You will not need everything that the dashboard has to offer, but you should at least once hear what these features are so that you can pick and choose. Maybe I want to use this for my trading approach. Maybe I look for dividends. Maybe I look for options. Maybe I look for counter trend trades, whatever it might be. You can then pick and choose what will fit and complement your trading approach. All right. So this is bonus number 3. And for the first 10 users, if you go to tradingindicators.com/corner, you can take advantage of this special promotional offer where you will get our dashboard for a 50% discount. Instead of $9.97, only for $98.50. In fact, it's even 50 cents less than this for the first 10 users, including these 3 bonus offers. All right. So now I do have some time for questions. Anthony, I don't see any questions. Maybe I don't have the permissions for this. Could you perhaps read out some questions if you can?
Yeah.
Just checking if that. Oh my goodness, that link is not working.
Not working.
The link is not working. Anthony, while you are reading out the question, let me just fix this link. Oh my goodness, what did I do? Oh, the link is not. Give me 1 second. I'm going to show you guys while you're reading out the questions. I'm going to fix this link real quick. Sorry for that. This was the registration link for this conference. I made a mistake. Give me 1 second for this.
Yeah, take your time.
Yeah.
All right, everyone. Dr. Sitting is here. So if you have any questions, ask him now. Take advantage of it. This is a great opportunity. He's worked very hard on this presentation. You could tell him.
I'll try. We use this dashboard. And we so every Saturday, for example, we have an open scanning session where we invite all our members to join me using the dashboard to scan for the most interesting swing trading setups for the next week. For example, you can create watch lists in here. These are all the different watch lists that we put together, and you can see like clockwork every single week we're having these. And the ones, for example, from last week are these ones here. Yeah, Steel Dynamics. We have Targa. I love Targa. What a great company that is. We've traded this many times over and over again. Had to set up right down here. Look where prices are right now already for the week. So I encourage you guys to at least check it out. All right, so I'm quickly gonna fix the link, and then we are good to go. So good thing I checked. Any questions so far? Or not yet?
Yeah. So we got AI wants to know. It's AI Gooson. Wants to know. Are you able to? Have you been keeping statistics on their swing trades at all?
Statistics in a sense that, hey, we don't have, we publish our track record for live trading them. No, we don't, because there's always a bit of discretion involved. So we don't, but we always put our money where our mouth is. So when we take a trade or we announce a trade, we show exactly where to enter, where to exit. And of course there would be a retrospective afterwards. In that sense, and we live trade all the time with our own money. So we never just demo trade, we live trade both when it comes to shorter term trading or longer term trading. So but no statistics, no. And the link has been fixed now, by the way. So tradingindicators.com/corner to get or take advantage of this offer.
What about what are some of the other common questions that people usually have that other people might be afraid to ask right now?
I get a lot of questions. For example, most questions actually ask you how can I, is there a commitment with the special offer? The answer is absolutely not. You can cancel at any time. And in fact, we don't advertise it, but of course we also have a money back guarantee. So yeah, you can try it out for 7 days completely risk-free, and then you can, ask for money back. This is typically enough for you to get a good glance of, hey, how does it work? How can it help me? Is it actually useful for my own trading? So that's part of it as well. We are, we are part of the Better Business Bureau. We are well recognized. We have, good feedback, and we have a very loyal trading community, in fact. So, yeah. Okay, well, I guess that's brings me pretty much towards the end of this session. Maybe real quick, let me just show you a few more trades which we picked in our scanning session last Saturday. You can see it here from June 20th. So we had Targa, for example. We had XPO, the one I mentioned today, had a really cool setup when we came down here. We also had, I believe, the stock down here, and the American Electric Power Corp. Look at this one here. We called this one out on Friday. Prices came down here to the support level. Look where prices are right now. Yeah, this is what we do every single day, every single weekend, publicly, but every single day internally. We look for these setups, and you can imagine how you can trade these either outright by investing into the underlying, or perhaps with options, maybe buying some calls if premiums are affordable. If they're more expensive, perhaps selling some premiums. In this case, they're quite cheap for AEP. The only cost, you can see this column here, for example, heat index at 2.52. That's a column related to options pricing. You can see, hey, right now you would pay for options with 30 days till expiration at the money, only 2.52% of the underlying stock price. So that's quite cheap. This heat index can be as big as 15% or 20%. And then, of course, perhaps you want to consider option selling instead of option buying. So all these things are included, and we'll walk you through in our sessions, should you decide to join our community. All right, perfect. Well, here's the offer again. It's tradingindicators.com/corner. And Anthony, remind me, please, I only have until 2:15. Is that correct?
Yeah, that's correct.
Okay,
yeah.
perfect. So this brings me to the end of this presentation. Thank you guys so much for being here. If you have any questions, you can always write to me directly at info@tradingindicators.com as well. With this, guys, have a great show, and talk to you or see you next time.
Hey, thank you, Dr. Sinning. That was an incredibly valuable information and great demonstration of how traders can improve efficiency while identifying quality opportunities. Thank you for your generous offer and for joining us today. I've placed a special offer link in the chat, and Dr. Sinning had corrected it for us.
Yeah.
Yeah.
Sorry for that. A little mess
No,
up.
that's okay. It was quick. It was quick. You did it like right there in front of us. So that was great.
Yeah. Thank you, guys. Have a nice show. Bye-bye.
Thank you.
Yeah, bye.
And remember, we'll be drawing 4 winners of the free $25,000 prop trading account later today. So make sure you fill that out. I'll put the link in there again, and it's there in the chat, but I'll put it up for those who might have missed it. Next up is Dan Gibby of Master Trader. Dan, I'm making you a presenter right now. Dan has more than 30 years of experience trading equities and options and is a co-founder of Master Trader. Today, he'll review how to generate consistent income selling short-term options. You'll learn how professional traders use weekly options, short-term expirations, and Master Trader strategies to systematically generate income while managing risk. So everyone, please welcome Dan Gibby.
Yeah, hi, thank you. Good afternoon.
Hi, Dan.
Here, I'm trying to share my power. And it's open, and it's not giving me the choice to share just this. I've done these. Oh, there, finally it popped up. Got it. All right, are we good on your end?
Yeah, we can see it.
All right, cool. Let's get started. Yeah, welcome everybody. We all have different approaches to the market. Ours is a techno-fundamental based approach. And I would say most of us, and we have that bias too, we're looking for directional patterns. We want to pick your instruments that you decide to trade to make money based on your bias. It could be stock, options, futures, ETFs, any tradable instruments, but you have to, you got to say, Well, what's my reason for wanting to take on a speculative trade? Ours is technical. And when we do that, we can, as a directional trade, we can buy stocks, ETFs, options. Today, we're not going to focus on buying options, although we do them all the time as directional trades. But selling options is another tool for making money in your trading toolbox. And you're going to find out. I don't care what your level of knowledge is with this particular subject. You're going to learn today with me and the allotted 40 minutes time here. And I'm either going to escalate your understanding of it, or if you're new to it, I'm going to prompt you, and you're going to get so excited with hopefully a desire to learn more once I show you how it works. So let's go. This is everything we do starts with this slide, so to speak, the master trader technical strategies approach. Price is king. We look for the specific arrangement of candles and certain trends on support and resistance. Is it showing relative strength or weakness? What about multiple time frame? Are they in agreement to increase the bias of our trade on the time frame that we're trading? We look at the broader market and the sectors, and hey, what are the market internals doing, whether you're day trading or swing trading? Because you're going to see that today's topic, that we love selling options for weekly income on 0 DTE. And what that means is the options that we're selling based on a turning point are expiring in a few hours. Now, there's some people out there that don't understand options fully, or they don't understand our technical approach, and they run and scream saying, "Don't ever do that, it's so dangerous." And my immediate response is, "Really? Then you don't know what you're doing." But let's continue. And then you'll see my charts, how simple they are. We throw some volume and a couple moving averages on there just to speed up the analysis. This is just a little checklist here to get us warmed up. This is our approach to trading options. I need a high probability setup based on that prior slide. If it's a directional, I have, I ask traders to rank it, and we only want to focus on the 8, 9s, and 10s quality. But the benefit of selling options, which you'll see in the examples, is that even though I wouldn't buy or short it because it's not a quality directional, all we're doing is collecting money, predicting that the underlying stock or ETF is not going to violate that strike price for X number of days or hours. That's the simplified method of what selling options is. So directional or income, I just described that. Pick the proper strategies. I get into all this in the full option course, but that's a checklist. I don't know the sophistication of our attendees today, so let's just start with some background here. I won't dwell on it. But what is an option? Well, it's a contract. It gives you the right to buy or sell the underlying. If I'm buying calls, I have the right to buy the underlying. If I'm selling them, I have an obligation to deliver. For a specific time, that's what I refer to as days to expiration. Once the days to expiration ends, your contract expires. It's either going to expire worthless or at a profit for an agreed upon price. When you look at the quotes, that they're quoted in per share. So one contract's 100 shares. So if you see a quote of, let's say, 25 cents, that represents $250. directional. We'll get into this because we're selling options today, and I'm not going to cover selling naked. But when you sell naked, you're taking in money, and you have an obligation to either to deliver the stock if you own it. If you don't own it, well, guess what? You got to deliver it because that's the contract that you signed. And we do this at bearish turning points. But I'm going to focus on bear call credit spread, so just hang tight. So that's if you're buying them, which we're not covering today. Here's the opposite. Puts. If a contract allows for the right to buy or sell, if I'm buying a put, I think the stock is going to go down. I have a bearish bias. So what we are going to focus on today in both selling puts and selling calls and spreads is we are looking at the charts, which is our edge, and we're saying, I will take the option buyer's money. I don't know why they're buying a call or a put. It ain't my problem. But I will take your money because I think you're wrong based on my chart analysis. These are what I call just master trader bullish setups. We have many more, of course, but every one of these are bullish and is a starting point for selling naked puts and bull put credit spreads. Why? Because they're all pictures on whatever time frame you're looking at of suggesting that the underlying stock or ETF is at a short-term bullish turning point. Now, this is the starting point, and you go back to slide number 1, where we then overlay those other concepts. So where are these pictures let's just focus on daily chart for now. So where are these pictures on the daily chart? What trend is it in? Is it on support and resistance? Is it showing relative strength or weakness to the broader markets and sectors? So I know I'm throwing a lot at you, but once you have the knowledge, which is our course, whatever you learn, whether it's being an engineer, a basketball player, a technician like we are, you need to start with objective information that you can then internalize over time through practice, through seasoning. Once you get that seasoning, even though it sounds like a lot when I talk about all these concepts, it is instantaneous. My conclusion when I can scan as fast as a computer will allow me to hit the down button. And so I kind of say 1/8 of a second. So as soon as my laptop populates, I can tell you if I like that pattern. I don't expect to do that after taking our course because you have no seasoning. But you do have, and the psychologists, once you take our course, the psychologists call that conscious incompetence. Now, what that means is well, it's more like conscious competence, and we're trying to get to the stage of unconscious competence. Unconscious competence is level 4, where you're like flying the airplane, you got 40,000 hours under your belt, and things just internalize naturally and flawlessly. Once you have the course, you have the knowledge, but you're gonna be clunky, and that's just seasoning. That's just another way of showing you now what I'm going to be teaching you today. So a bull put credit spread. I'm finding a pattern. I just showed, these are derivatives of what I just showed you on the other slide, right? So this stock moved up. It's in a trading pattern. I have a beautiful gap reversal here on support, the bottom of this trading range. And then I'm going to show you my checklist. So once having a pattern is step one. Step two, go to the option table and make sure the options are liquid. If they are not, move on. Don't mess with illiquid options, because when you even if you get a good fill, if the volatility increases and you want out, you're going to be kicking yourself when you don't get filled and the market maker just widens the spread to 25 cents to 480. You're going to be kicking yourself. That's SOB. Just stay away from it. So this is a beautiful candidate of a put spread. We're going to profit. So here's another key of selling options around technical points like this. When you buy or short a stock or ETF, I call that one-dimensional. Meaning, you are only going to make money on the long for every penny it goes up, on a short, every penny it goes down. When we do this, we are making money in 2 out of 3 directions, and I'll explain to you, it can even go against us. So if the stock goes up, I make money on a put spread. If it goes sideways, I'm making money. It can even go down all the way to my break-even point, and I still make money. I'll show you this funny email I got from somebody, Roger, and he sent us this, emoji guy, and it's like, I can't believe this strategy. I made money and the stock went against me, and I love hearing that. Bear call credit spread the opposite. Here's a topping pattern, a little breakout failure. Once it breaks down, I am immediately going to my option table. How much are you going to pay me for taking this risk? Because remember, some guy's buying or gals buying a call option, and it doesn't have to be a person. Meaning, there's a market maker there to provide a market. So even though there's not Mr. Smith down the street selling you this option, the market maker's job is to sell you that option, and the market maker will then hedge that position with stock. So, you will get filled. Some people say, oh, Dan, I'm following what you're saying, but what idiot is going to sell you this call up here? Answer, the market maker will, if there's no individual. Here's just another pretty way of showing what we're going to do, and then we're going to get into as many slide examples as I can in the time. So again, these are all bullish patterns, every single one. So the green line is where I'm going to be looking to sell a put, because I don't think this is going to go under this level in X amount of days. Now that would be called just selling a naked put if you stop there. So if I did that, that's just selling a naked put, and you manage per your trading plan, which could be, if you don't mind taking assignment at an improved cost basis, then it's an absolute no-brainer trade. You're either buying the stock at wholesale, or you're making the premium at full profit. But we rarely do it to take assignment. We're doing it as traders, what I call an income trade. And so for risk management and catastrophic gaps, and it also to minimize the buying power requirement at the brokerage firm, we just recommend spreads for people. Now I do a bunch of nakeds myself, but I can handle it. And so we're going to take some of that money that we received from selling a put, and we're going to buy a further out of the money put. And the difference of those two numbers is called the net credit. Okay, I'm going to show you many examples. So if you do one contract, you remember per share, you multiply it times 100. 10 contracts, multiply times 1,000 per share. These are all beautiful patterns. Let's now jump into as many patterns as I can. And you know, I don't even care about the stock symbol. It does not matter what I'm teaching you here today. So this thing I got, all right, so here's my daily chart. Look how clean and simple it is. People, you know, in this webinar and others, because that's just life. You know, my partner Greg, he calls them indicator salesmen. They're trying to sell you some magical mystery something that they created, and you will never hear us use the word proprietary. Never. We teach you everything. There's nothing proprietary. We use only objective data, which is price and volume and market internals. These squiggly lines and trend lines and I can't even pronounce it, Ichikume clouds, they put you in this rabbit hole of making incorrect, lazy decisions. All the information is right here on the screen. I got a big old trading range with a flat 20. So the blue is 20, green 50, red 200. It broke out here. My 20 is starting to rise. This is bullish price action at resistance. Let's say when I talk through the charts, I'm talking technicals before I talk about the option strategy. Why? Because we don't enter an option trade without having a technical bias. So in this particular example, which I'm not getting into today, once you had a wide range closing breakout, nothing to the left, this is what we call a price void. There's nothing over here to stop this issue from moving higher. So we actually recommended 2 trades on this. We bought in the money calls, and that's taught in my course. I kind of roughly like a delta of 0.80. It's just a good compromise between the time decay and the money that you make on the move. So that was a good pattern for that. But all directional setups are also credit spread candidates if the spreads are tight and we get good premium. So what we did on this one on the put side, which is today's discussion, is we sold the 345s right here, this green line. Once this bar is closed, I have so much confidence that it is not going to turn around here, look, for 2 days. So this one was only a 2 DTE. So we're selling the 345, taking some of that money, and in this case, we did a $10 wide, and I'm not showing you the net premium on this one for some example, but I'm showing you the pattern. And as long as it closes above the short strike of 345 in 2 days, I make full profits. I mean, let that sink in. Bullish pattern. We like shorting. Our weekly options trader only shorts things that are 10 days or less, preferably just a couple days, couple hours, or even better. So we're taking very little risk on a compelling pattern and getting paid for it. It's a wonderful strategy. Here, this thing blasted and it's you know, resting after this explosion. Look, I got rising 20 above the rising 50. It went up. It's stabilizing here, so that's a bullish turn at the 20 MA. Wide range igniting. This is what we call a bullish 1, 2, 3, 4 continuation. You have an igniting bar from consolidation. You have a bullish inside bar in the upper third. And if it's a 1, 2, 3, 4, well, then you have another inside bar that just trades under the prior bar. That's even better. So we sell a put spread under support, manage in between. This one was full profit. You know, I have numbers and a bunch of the other ones. So in the weekly options trader, that's what I just mentioned to you. So what's going on in this trade? Well, I have flat 20, flat 50. I'm in a trading range. Bottom of the range, 50% retracement. There's a lot of evidence here saying I cannot go any higher. Once we had this topping tail and then come way back down here, that was, you know, we use the term the tail, similar to a poker player. It's like, I got you. I'm watching, I got you. And so once it traded under this bar, here are my strikes. We shorted this one, the 1230s, but the 1240s is long. So this is clearly shows you what I showed you on the other chart, that I don't care what this stock does. It can go down and I make money. It can chop around like a crazy man and I make money. It can even go against me. So let me just eyeball this. Let's say we entered at 1190, okay? I call this cushion. So if I entered when the stock was 1190, as long as it stays under 1230, and this one also, look, 2 days. Once you have confidence and understand our technical approach, which is Greg's Master Trader Strategy course, I have so much confidence that when it trades under this bar, it ain't going up here in 2 days, but I have $40 of cushion that I could be wrong and it could go against me and I still make full profit. Let that sink in. That does not exist when you buy or short something. That's why I say shorting options gives you an edge to be wrong. It's a defined higher probability of profits. It doesn't mean you'll make more, because they're different strategies. Your maximum gain. Look, on every one of these, I say max gain. Why do I say max gain? I mean, it should be obvious, but let me make it clear. When you sell options, the maximum that you can make on that trade is the premium received if it expires worthless. So, you know, I got a lot of slides here which we aren't going to get through, and I do that on purpose because it's the same but different. So this is the same but different than this. It's the same strategy, same breakdown, same weakness, same selling and out of the money call spread for a couple of days. This one was 4 days. So it was on a Tuesday that I put this trade on. Look, deep retracement, bearish price action, breakout failure, red bar. Under this red bar, I don't think it's going up above this $95 strike. So we did a $3 wide. Now I'm giving you the math here. So we took in on a $3 wide. So here, I'll do the math for you. We took in 65 cents a share on the credit spread. If you sold one contract, $65 would immediately hit your brokerage account. On this example, if we sold a 10 lot, and so $650 hits your brokerage account immediately, and then you just manage in between. We manage as it goes down, because you know we view these like your insurance company. You have exposure while these trades are open. If this thing gaps up against you at $106, well then you're at max loss, close to max loss. So when it falls and accelerates lower and then has a little gap up the next day, even if it's not expiration, we recommend closing it and booking your money. Big old W bottom with a new low reversal. This tail, this green bar was our tail. Then I got two bullish inside bars and it gapped up. Are you kidding me? And you might say, well, what? I don't understand what you just said, Dan. That's because you may or may not have the technical confidence that I do. This is a beautiful W pattern with the big old price void. And we sell this 1090 put. If it's, oh, right here, my bad. I was looking over here. So we sold at 1095, bought the 1090s, took in 70 cents a share. And so max gain $700 if you did a 10 lot, or, you know, you've got to calculate position size based on your own trading plan and manage in between. This was a 4-day risk. Uptrend, this red bar suggested lower prices. Bullish gap up, then this, once it trades over this, this is a downside shakeout. We sold this. This was a six day. We did, looks like a $5 wide. Another example. This broke down, little bear flag, sell setup, bear flag, you know, multiple names. Breakout failure. Once it closed like this and traded under this bar, I have confidence that it is not going above this red bar for a couple days. Rinse and repeat. Go to the option table. Are they liquid? What strike do I sell here that I feel confident technically? And it would be, in this case, the 56s. So what am I going to get paid to do an out of the money call spread? Our green room, this is our live trading room. We talk about all kinds of trading. And if you go to YouTube, actually, we broadcast it for free, our pre-market analysis. Greg and I do starting at 9 a.m. So just go to YouTube for a free analysis, Master Trader. And then this is our green room. We're there all day where I say, look, we're walking the talk. Instead of just talking about patterns on a PowerPoint, we're doing this every single day. We're finding the pattern, we're answering questions, we're trading together. You know, we did 2 credit spreads on the Qs today. When they gapped up and took out a 10-minute low, we did a 0 DTE call spread. And then when it came crashing down, had a reversal bar, we did a put spread. I'm just showing you the pattern. It's rinse and repeat. Look, I got declining 20 and 50 and 200. This is evidence it can't break out. I have a closing range expansion breakdown. Rinse and repeat. How much are you going to pay me for selling an out of the money call spread? That looks like, what am I doing? All right, let's see, this one I would not buy. It's sloppy, but it broke out and I'm like, hey, I wouldn't buy it, but I don't think it's going below here for 2 days. So, you know, we have different services. I mentioned the weekly options trader, which I'll give you the code here in a second. I know, let's see, we've got 12 minutes left. And we also have education. So it's for people who they want to learn, you know, the old saying, teach me how to fish, because Dan, I see what you're doing, but I want to do it myself. That's taken our credit spread course. And, you know, Greg and I we've been doing this 30 years full time. I don't count the 20 years before that of trading, whereas standing in the Schwab office at a little teller machine in the lobby, placing my trades with no technical charts. I'm not counting that. But we have thousands and thousands of testimonials. People are like, I wish I found, we get so many people, I wish I found you years ago. You would have helped my learning curve and saved me emotional damage and dollars. But here, I want to get into some zero DTEs. Look, remember I told you 1/8 of a second, I can see the technical charts. As soon as this page populated, my brain immediately said, no brainer, M reversal top. And that's exactly what I'm typing here. It gapped down from an M reversal. My eye could see that it's up a lot already. So what am I going to do, folks? You've been with me, whatever, 25 minutes. Got it, Dan. Pattern. I'm going to go to the option table. What are you going to pay me? Are the options tight? We did it 425, 430. Sold them for $1. We closed half for 40% profit in one day, right? Because we did it here and it fell, and then we just, took some more gain in trail mode. Here's our guy Roger. He's been with us for a number of years. But look, he sent me this. This wasn't me. This was him. I still made money and the stock went against me. This is an absurd strategy. Sarcastic tone. Greg and I have been working together 25 of those 30 years. You just got to check us out. We get so many of our clients by word of mouth because we're not really. I'm horrible at social media. I just don't enjoy it, and there's so many snake oil tip people that I just don't want to be in the swamp with them. But check us out on YouTube. We give a ton of free education. We give chart of the week. My partner Greg does amazing educational blogs. Get on our email list and you get all this free stuff also. I mentioned the YouTube for free. And so this weekly options trader, we had 2 offers for you. I'm not done yet, but this one is here. The weekly options trader, we sell options that expire in 10 days or less. Exactly what I'm showing you. We have a detailed report on the weekend. During the week, we use Telegram. We send you the charts. We send you the date, the symbol, the technical strategy, which option we're doing, and we send Telegram updates. So from open to close, we're in there monitoring it with you via Telegram. So we're giving you 2 months for the price of 1 on this, mastertrader.com/weekly 2-1. Here's the monthly plan, but we also have this great annual plan where it's like 40% off or something. You can go to mastertrader.com, weekly options, read about it, email me. All right, so now in the remaining time, it's the same strategy, but 0 DTE. So it's not 1, 3, 8 days to expiration. It's hours. Getting paid to predict where something's not going to go for a couple hours. And it doesn't mean you got to stay in it all day. Like today, we were in this Q's call spread for 15 minutes, I think. And it's like we're watching it just crash on the support and reverse. I'm like, take the money. Take the money. Go to the gym or then put on the put spread as we did. Gaps and so earning stocks are marvelous for this, but trade management, that's you've got to manage these things. Don't get excited on what I'm showing you. It's like, oh, this is free money. It's not free money. Don't let anybody tell you that. It's calculated, purposeful, tactical money based on the chart, and then we manage in between. The beautiful thing, I should have added a thing over one more bullet here, I forgot. But the spiders, Qs, and Russell, they have 0 DTEs throughout the week. marvelous. Why do the diamonds not have it? I have no friggin' idea. But recently, a couple months ago, and I don't know what the whole list is, but they have 3 expirations during the week for some of the FANGs, Qualcomm, even IBIT. I discovered the other day that's a Bitcoin ETF, IBIT. They have Monday, Wednesday, Friday expiration. So what is wonderful with that is that we have more 0 DTE candidates. It's wonderful. I love it. So here's again just a little check sheet of what we're going to do. I'm going to show you as many charts as I can here in the next 5 minutes. But I'm looking for turns. But it doesn't even have to be on the daily. But the 60-minute, 15 and 5 could be your focus point for 0 DTEs. Same thing. I'm looking for put spreads on bullish turns. Again, I always emphasize you better stick with liquid ones, and that's why we love Qs, spiders, fangs. They're very, very liquid. All right, what do I got here? So I got on the daily chart, I got a climactic sell setup. It's climactic. Then got crazy far from the 20, and now here's my 15-minute chart. So the first, you got to look at the dates down here. So this was a Friday, 4/17, and then 4/20 is a Monday, obviously, because of the weekend there. And so look, the morning that we entered this thing, it's breaking down on the 15-minute chart. So would I sell a call spread on this pattern for, let's say, a week out? No, because I don't trust the chart to be a short-term high for 5 days. But Dan, wait a minute, do you trust it being a short-term high for a couple hours? Yes, I do. Why? Bearish gap from a Climo, big old topping pattern, lower highs, breakdown on the 15-minute chart. My stop's over the highs. So look, this high is 650. So we went $1 higher. We shorted the 651s. Give me $1, that cushion, that word I mentioned to you. On 0 DTEs, I do them naked a lot, but I typically just go out as far as I can where I'm not paying much for the further out of the money option. And then again, it makes it, you can get filled on the midpoint pretty easy, and also it's less buying power. So we took in 53 cents a share, so 10 lot, 530 bucks. And all it has to do is stay under 651 for a couple hours. These are all going to be same but different, like I said. So this one, a rally near resistance. Look at this topping pattern on the 15-minute chart. Look, 15-minute chart. So this was bullish. This was an inverse head and shoulder until the gap down. So I got this arrow here to help you decipher this. So I got a bearish gap under all this, what we call an end of day base. We waited 15-minute low. So, could this thing have gapped down and ripped up? Of course it could. So we wait, put it on a 5-minute thumbnail, I call it, a little chart. I see that it's neutral after 15 minutes, but when it traded under the low, now I'm confident. Here's my 445s. I shorted those calls. Went, in this case, $7.50 higher. 660 profit as long as it closes under here. But, look, this was another example. Like I said on the Qs today, it collapsed. Take your money. Go to the gym. Go to play golf. Be done with it. That's how we manage. When you get a quick gain, we're, rinse and repeat. All right, so this one was actually a gap up in a downtrend. So would I do a $5 day put spread on this? Nope. But look, it gapped up, came in. I got a bullish retest. I got a 180 reversal. I think I can sell a put under the prior day's low for a couple hours. Rinse and repeat. Gap and crap. This was probably an earnings stock, is my guess. 5-minute topping tail. You know, and it depends how aggressive you want to be, particularly on earnings stocks. Usually I like to wait 15 minutes and then rinse and repeat. I sell and out of the money. Look at the cushion I had on this one. The high was 680. Just, you know, I'm eyeballing. We sold $40 higher. So I had a $40 cushion from the high of the day. And look, this was very easy management. Just stair stepping down, stair stepping down. Closing breakdown. No, you know, no brainer. Here, I want to show you this. I'm running out of time here. This is what McGraw, this is his trading station. He specializes in only doing SPX 0 DTE. And look, I've had a much higher winning. He was trading for 25 years before he found us. And I've had a much higher percentage. And I love this line. This old dog has learned new tricks. And I nicknamed him McGraw, like Quick Draw McGraw, because he's just quick at entering into things. All right, let me just end with our second special here for you. So this was the one I mentioned earlier, 2-for-1 weekly options, earn weekly income, just exactly as I've been showing you here. The mastering it, well, this one's actually a comprehensive course with other courses also. You get 2 courses, trading volatility, live coaching, and we're also going to throw in a year of this for free. And so the link on that one is mastertrader.com/spreads bundle. And that's it. Those are 2 amazing specials. I hope you learned something, whether you're new or very experienced in this. I hope I escalated your understanding and appreciation and excitement for wanting to implement this in real time. Come check us out in the green room. Take advantage of these specials and watch us walk the talk. Email me, dan@mastertrader.com, with any questions, and have a great afternoon.
Hey, thank you, Dan. Would you? I'm putting in your link right now. What are the other links that you wanted to include as well?
Well, it'd be this one right here, mastertrader.com spreads bundle, and then the other one would be the 2F-1. Right here, mastertrader.com/weekly 2-1. 2 months for the price of one, and then the other one was what I explained.
Okay, I'm just putting that in right now. Just want to make sure that the link works first. Okay.
Yeah, just email me any questions, dan@mastertrader.com, and good trading, everyone.
Thank you so much, Dan. We appreciate it. You are just so battle tested and still doing great. We appreciate you. That was an outstanding presentation and a great lesson on how educated options traders can generate consistent income through structured strategies. We appreciate your valuable information, generous offer, and your time with us today. I've posted Dan's offer links in the chat, so be sure to check them out. Next up is Jim Simmons. Our next presenter is also Jim Simmons of Prop Shop Trader. He is also the sponsor of today's $100,000 prop account giveaway. Jim Simmons of Prop Shop Trader will be discussing one of the hottest topics in trading today, prop firm opportunities. His presentation is how to generate $11,000 in payout potential with a $50,000 account. Jim will explain how the sprint account model works, how traders are scaling through account stacking, and why the industry's new payout structures are attracting attention from traders worldwide. So everyone, please welcome Jim Simmons and check out the link that I put in there to sign up for the free account.
It was muted, I think. Can you guys hear me now? Everything coming in clear? Give me a yes in the chat box if you can hear me. You can see the screen. Are we all good? All good? Excellent. All right. Good stuff. Hey, Trifan. Good to see some familiar names here as well. Welcome to everybody. Thanks so much for tuning in for this event. Thanks for having us. Glad to be here with you. We're going to be looking at really what is Prop Shop Trader, what's available to you, what is the opportunity for you as a trader. So let's go ahead and dive right in. First, we're going to start with our disclaimer. As always, can't guarantee results. Not here to be your trading advisors or your investment advisors, anything of the sort. We're not here to give you signals and things like that, okay? So if we are all good on that, let's keep going. So what we're going to look at today, again, it's all about the opportunity available to you as a trader. And how does this differ from some of the other prop firms that are out there, or of course, versus trading your own money? So why are traders moving to Prop Shop Trader? What does it look like to scale that opportunity? How do you go next steps? Then we're going to look at payout structures, which I assume is why everybody is trading, is to get paid. And then we'll look at what is the opportunity beyond sim payouts? What does real prop accounts look like? So let's get into it. First off, why are traders excited about Sprint? What is this Sprint account? Well, Sprint accounts, as a spoiler, they're best in class payout velocity with only 3 days required between payouts. Best in class account scaling, up to 10 sim payout accounts. We're going to be looking at trader flexibility, algo trading, news trading, the whole gamut. We'll also look at simplicity, things like 1 day to passive valuations, 90-10 profit splits, and the strongest payout to cost ratio in its class. When we compare this against other similar models and similar accounts, the best payout to cost ratio. Why should that matter to you? Well, I'm pretty sure all of us as traders would like to maximize our ROI. Although, if you ask some traders, they say, what ROI, right? So here's the thing. That's what it's really about for traders. How much do I have to spend and how much can I get paid, right? So that's what we're after. First, let's look at why are traders moving to Prop Shop in general. Prop Shop Trader has trader-focused models with 1 day to passive valuations. We have direct to payout accounts available for traders who don't want to do any evaluation. They just want to go right to the trading account for payouts. We allow news, algos, copiers. They're all allowed. In fact, your copier is included. No rushed transitions to live. I've heard from many traders that they've gotten moved to real prop or to live accounts, and they just weren't ready. They just got moved over prematurely. They weren't ready. They bombed the account, and then they had to go somewhere else. So we're not interested in that. We want to move traders over when they're actually ready to move over. Makes sense. Clear rules, really comes down to, do the rules make sense and are they transparent? One, are they easily found and are they easily understood? Okay. Attainable targets. We're not asking you to swing for the fences. We don't want you to swing for the fences. If you do and you're successful with that, great. But let's get you making money first rather than scaling for the heavens. When we talk about speed and opportunity, we look at payouts available any day. It doesn't matter. There's no payout windows. There's no, you can only qualify on this day or that, or you have to send your payout, between the 1st and the 15th, and you got to have, no, none of that. Okay. There's no payout windows. There's only 3 to 5 days required between payouts, 3 to 5 trading days. So very short time frames to be able to get paid. Large profit splits, one-time billing on all of our accounts, whether that's an evaluation or real prop, doesn't matter. Scaling, you can scale up to 10 sim payout accounts for futures, up to 10. That is very, very aggressive. It's very competitive. Okay, and yes, we will look at that, Patricia. Absolutely, we're going to cover that in just a minute. Trade copiers are included on the desktop application, on the web application, and on mobile. We're going to talk about that a little bit here in just a moment. We offer futures and stocks trading programs. So most of you, when you hear about a prop firm, you think, oh, this is futures, I'm going to tune out. If you're already a stocks trader, you go, there's really not an opportunity for me. Well, not so fast. We have you covered. We have stocks programs available for traders as well. Day trading and swing trading. So you can have up to 10 sim payout accounts for futures on day trading and stack another 5 accounts on top of that for swing trading. So tons of opportunity there. Fewer restrictions, more opportunity, faster payouts, and a greater flexibility to trade your style, to trade your markets, and transparency across the board. This is what it's all about. So that's what we stand for. That's why traders are moving to PropShop. When we look at what have we done, we've reached over 12,000 traders. We've paid out over $5 million. And in the process, we've earned over 1,000 5-star reviews. We also have 0 contractor turnover. What that means is that when our people come to work with us, swing trading futures, yes, we got you covered. When our people stay with us, which creates a good environment and a good experience for our traders. So let's take a deeper look at the sprint account. And Patricia, I got you covered right here. So the evaluation phase, there's 2 account sizes. Keep it simple. There's 25K, there's 50K. Right now, the cost on those accounts is $55 and $85. So very inexpensive to get started. Profit targets on your evaluation, you have 1,500 on the 25K, and you have 3,000 on the 50K. Your drawdown on those accounts are going to be 1,000 and 2,000. They are end of day drawdowns. Okay, these are day trading accounts. But end of day drawdowns, 1,000, 2,000 with 1,500 or 3,000 profit targets. You're going to notice something about our firm. Everything that we do, for the most part, is very linear. We believe that when your account size doubles, your drawdown should double, things like that. So very linear across the board. So you're not penalized for choosing a smaller account, a larger account. It's up to you. Whatever you decide is right for you. The evaluation can be passed in a single day, or it could take longer. You could take as long as you want or as quick as you want. It's up to you how long you want to take to get there. Consistency rule, there is none in the evaluation, okay, because it's a 1 day to pass. And take as long as you need. Let's talk about getting paid. That's what we're all after. What do you have to do in order to get paid? Well, the first thing you have to do on any sort of prop trading account is to cover the drawdown. Now, what does that mean? That means you make enough to get above your drawdown, above the starting balance. So if you have a 25K account, that means getting to 26,100 or $1,100 in profit. And on the 50K account, that would mean 2,100. Okay, so very simple. So that's your first goal, is to outrun your drawdown. At that point, your minimum balance becomes fixed and you no longer have a trailing drawdown. It's static at that point. Okay? Next, your goal is to have 3 trading days that are over the daily target. That could be 125 for the 25K or 250 for the 50K. So you have 3 trading days over these amounts and have a payout target reached of 500 on the 25K or 1,000 on the 50K. So let's look at the 50K for a second. First goal, get to 2,100. Next goal, get 1,000 in payout to get your payout target. So, excuse me, that puts you at 3,100. Odds are, by that point, you've already covered the 3-day requirement on the 3 days over 250, right? That's pretty simple. At that point, you can request a payout, or you can scale more profit and get a bigger payout. That is up to you. The consistency rule on this account is 50%, which again is best in class compared to similar account models. So very good opportunity there. One thing that is unique to this account, or that we haven't seen a lot of, there's some other prop firms that do this, but one thing that we are big on is positional risk. Wouldn't you guess it that the number one reason traders, we'll cover that in just a second. Patricia's like ready to go. knows all the questions to ask. So that's awesome. Thank you. Position risk. Let's talk about position risk. That is the number one reason traders fail prop accounts. They fail evaluations. They lose their payout accounts. Worst of all, they get to real prop and they lose real money. And oh, by the way, it's the firm money. And well, as the head of risk, that's not a fun environment for me. So our goal is to help traders adopt the right sort of the right sort of habits to become a better trader. I don't know about you, but a lot of our traders have felt like through some of the other prop firms, they came as one type of trader and they left with some bad habits. Maybe it encouraged some gambling type tendencies. Maybe they've become something as a trader that they don't really like. And our focus as a prop firm is to help traders do the opposite. So we have positional risk metrics in place. Now, of course, you can limit your positional risk and you can set parameters that limit you from hitting that throughout the day through some of the different risk parameters that are built in through the trade copiers. But the idea is, look, we will give you up to half of your drawdown as a positional risk. Most traders, if I ask them, can you make 250 for the day without risking 1,000 on a position? Most of them are going to say, absolutely. Can you make 250 with 2,000 in drawdown? Yes, absolutely. That's all we're asking. We don't need you to make $1,000 or $2,000 a day or nothing like that. But we also don't want you to risk more than up to 1,000 on your positions. Makes sense, right? I would tell you the fastest way to fail your account is to risk half of your drawdown on a single position. So daily loss limit, there is a daily loss limit, 625 or 1250 on these accounts. Daily loss limit is a soft breach. What that means is if a trader hits the daily loss limit, they won't fail the account unless, of course, they hit the minimum balance in the process. But they won't fail the account for daily loss limit. That'll simply turn that account off for the day, and they can resume trading the next day. Okay, but it's not a failure. The max position risk is a failed account. Okay, that is very important to us as a firm. We are here to find talent for real prop, and it is required that traders trade within the appropriate risk limits. Okay, max contracts 2 and 3, on the minis or the full size, and then 20 and 30 on the micros. So pretty straightforward there. So that is how the account works. There's no upgrade fee, to answer your question there, Patricia. No upgrade fee on these accounts. So 55 or 85 end of day drawdowns, no upgrade, and you can scale up to 10 of these accounts. Amazing. Let's talk about payouts. What are you going to get paid when you get there? On the 25K, you start at a max payout of 1,000. And then when you get to your 4th and 5th payout, you can scale up to 1,250 for your payouts. On the 50K, it's 2,000. So you can do 2,000, 2,000, 2,000, and then your 4th and 5th payouts are 2,500, up to 2,500. You don't have to request that much. If we look at the math, I'm going to see if I can draw on the chart here. Can I? Can you guys see that drawing? Let me make this look a little better as well. Let's go to medium. Let's try. Whoa, that's big. Normally I am in Zoom, so this is different. Okay. There we go. All right, now let's figure out how to erase it. Cool. Got it. What is no upgrade fee? Yeah, what no upgrade fee means, with a lot of firms, you pay an entry fee to get into the evaluation. And then once you pass the evaluation, they have a upgrade fee that you have to pay to get your payout account. We don't do that. So with this account, you just pay the entry and there's no cost to upgrade. So when you pass the evaluation, you just move right into your payout account. Okay, so pretty straightforward there. Let's talk about the payouts. So we know that going back to this 50K account, we have a 2K drawdown we have to cover plus $100 buffer, and we have to cover a 1,000 payout target, and we can get a payout. Well, if you're doing the math, that's $3,100. But your max drawdown is 2,000, and you have to keep 2,100 in the account as a buffer after the payout is paid out. And that's pretty typical, right? So in this case, that trader would be able to request 1,000. If you wanted to keep going, then you just get to 4,100, and now you can request your 2K payout, okay? All of the payouts on these accounts are 90% split, okay? So whatever you request, you get 90%, and life is beautiful. Now, if you're doing the math across the board, we add up these numbers. First payout, $2,000, $4,000, $6,000, $8,500, $11,000. You can get up to $11,000 per account, up to 10 accounts. If you're doing the math, that's $110,000. Okay, so huge ROI, massive ROI on these accounts. If you do the math, it's $12,941 if you want to be exact. How many of you want to make 12,000% ROI? In a matter of less than 5 weeks, mind you. So that is the opportunity on these accounts. Let's look at forge accounts. What is a forge account? So Sprint is an evaluation into a payout account. Okay. The forge account is a direct to payout account, meaning there is no evaluation. You pay to enter, you start working toward your payouts from day one. Pretty similar. There are some differences in terms of the risk. You've got a trailing drawdown or an end of day drawdown, whichever you prefer. The end of day is a little bit higher. You've got 11.25 and 22.50. Same daily targets across the board. Payout targets are higher. So these are 1K and 2K for the payout targets. Max positional risk. Again, it's 50% of your drawdowns, just the same as the other accounts. Daily loss limit is actually the same as the max position risk. And this is also a soft breach on these accounts as well. And the same contracts. Okay, so same as before, breaching the max position risk will fail the account. Daily loss limit will not. Okay, of course, all of this is on our website. So if, obviously we're not going to expect anybody to remember this, but if you want to take a screenshot, you can, but everything's on the website, of course. Let's talk about the payouts on these accounts. Payouts are a little bit lower to start, 1,500. Here's the big difference though. This is a 100% split, goes to the trader. I don't know why that's not working. There we go. 100% split. You don't have to split anything with us. Here's the other thing on these accounts. They are automated payouts. This is something different. Automated payouts. What that means is when you hit your daily targets, which is a 5 times daily target instead of 3, you hit your daily target, you hit your payout target, the payout's automatically going to send to you for 1,500. And then when you do it again, you're automatically going to get 1,500 again. Let's look here. These are the totals. But then when you do it the next time, it's going to be 2,000 and then 3,500 and 3,500. So these are scaled to reward consistency and the ability to trade in the same account. Okay, so those are very heavily set up on the back end. Now, here's the thing. When you look at 1,500 versus 3,500, that's a pretty big difference in terms of what you're getting paid out. But there is no difference in what you are required to do as a trader. Still $250 a day times 5 and a profit target of 2K. Now, why is the profit target 2K versus smaller? That's based on the payouts, right? You're getting some pretty large payouts there. So a little bit different on how these work, but larger payouts, direct to payout accounts, and pretty solid ROI on these as well. You can see ROI is a little bit less because there's a higher cost of entry because there's no evaluation. However, you can earn up to 12,000 per account on these, or 6,250 on the 25K. On the Forge accounts, you can have up to 5 accounts. So 5 on the Forge, you can have 5 of these, and that counts toward your 10 day trading accounts. So if you have 3 Forge accounts, you can have 7 Sprint accounts. If you have 5 Forge accounts, you can have 5 and so on. But you cannot have more than 5 Forge accounts, the direct to payouts. Okay. So that is the Forge accounts. When it comes to the rules across the board, if we look at firm rules, the Sprint account, again, just to highlight it, 1 day to pass, payouts any day, only 3 days between payouts. The Forge account, there's no evaluation. You go direct to your payout account. They're automated payouts. You don't have to request a payout in those accounts. And it's 5 days between payouts, 5 trading days. So here's what you don't want to do as a trader. Here are your rules. It's super simple, very transparent. What you don't want to do, max position risk, don't breach it. You will fail the account on either one. Don't breach your daily loss limit. It's not a hard fail, but you will get shut off trading for that account for that day, and you could begin trading it again the next day. Don't breach your max drawdown. That's the case on every prop account ever. Don't hedge positions. What that looks like is you can't be long an NQ on one account and then short NQ on the next account. That won't fly. CME regulation, so you can't do it. You cannot also be long NQ and short MNQ. That is not allowed. We don't allow that. But you can be long NQ and short ES at the same time. That is fine. Okay. So good to know how hedging works. Don't hold positions into the close. You can't. We won't let you. So the account will, it'll just close the positions. It won't fail you, but it'll close the positions, and so they'll just close out. So just close them before you get there. What is allowed? News trading, no rules against it. Algo trading, no rules against it. Copiers, knock yourself out. We include the copier. No dollar cost averaging rules. Here's the deal. If you're going to dollar cost average, please know what you're doing. I have yet to see a dollar cost average trader show me tons of profit consecutively and consistently over a long run. Because the problem is, it's not that the trader doesn't have a good intention. It's that what happens when you add to your position, it becomes harder and harder to understand what the risk is on that position. So we don't have a rule against it, but be careful because it can trap you up. It can trip you up as a trader. So no scalping rules. So those of you that want your 5-second hero, you're in the game 5 seconds and out, and back in the game another 5 seconds, totally fine. We don't have rules against that. Okay, trade how you trade. No contract scaling. You could start with the max contracts from day one. You can go to 1 contract the next day and then 3 contracts the next day. It's up to you. All right, let's talk about real prop trading at Prop Shop Trader. So first of all, we are a real prop firm. Okay, so there is a path to real prop into live, and that is where all roads lead. So as you prove your consistency and your ability to scale profits in your account, we will look to bring you over into real prop. Again, the goal is not to bring you there early. The goal is to bring you there when you're ready. Okay, so let's talk about the benefits. First off, static drawdowns. There's no trail of any kind in real prop. If your drawdown is 2,500, your drawdown is 2,500. That's what you got. And it's no different. If your drawdown is 5,000, it's 5,000. It does not trail. There's no payout caps in real prop. So Patricia, this one's for you. No payout caps in real prop. If you make 10K, great. You can take a payout for the whole amount, and then you get 80% split on real prop. There's no consistency rules at all in real prop. If you make $10,000 in a day and you make your 250 times the other 4 days, great. You got a really nice payday coming. You get 80% of that. So life is good. No payout thresholds. And remember, we talked about before, you have to cover your drawdown and make your payout target, and then you can get paid. In real prop, it doesn't work that way. If you have $1,000 in profit in the account, you can take a payout and you get 80% of that. So you don't have to cover this, cover that. What you do need to do is you need to cover 5 profitable trading days times the daily profit target. So if your daily profit target was 250, as a spoiler, it's actually a little lower in real prop, it's 200. Okay, so that's it. There's no profit targets though. So before you had to hit like 1K or a 2K profit target. In real prop, you don't have to do that. The other thing about these accounts, your profitable days do not need to be sequential. So they don't have to be consecutive. You don't have to hit 200 and then another 200 or 250, whatever the case might be. They don't have to be in a row. Okay. You can take days off of trading. You don't have to trade every day. If you don't have any trades that day, please don't trade. I'd rather you sit on the sidelines than go lose money because you're forcing your trades, right? So the days don't need to be sequential. The other thing is this: if you have your 5 days covered, you're good to go. So even if you have, let's say you have 5 days times your 200, but you happen to have a losing day in that mix, you still got 800 in profit and you get 80%. Okay, so real prop is where our traders want to be, and this is where every trader should want to be because it's real trading with real opportunity and uncapped potential. There's no extra rules. It's straightforward. What you see is what you get. Unlimited scaling opportunity. What does that mean? I want really good traders to trade with us in real prop. If you're a really good trader, we want you. We want you to come and trade with us. And if you're really good in real prop too, we're going to put more money behind you. So you might start with 2,500 in drawdown, and we like what we see, and you're killing it, and you're doing great, and you've gotten a payout or two, and everything looks awesome. Cool. Let's bump you up to 5,000. And you're at 5,000. You kill it for another couple of weeks, and you're doing great, and just risk is on par. Great. Let's scale you to 7,500 or 10,000, and let's scale you beyond that. The sky's the limit. We just need good traders that we can scale. So come and trade with us. Uncapped earning potential, uncapped scaling potential, no artificial ceilings, and you can grow with performance. Okay. So that is the progress. You start out in an evaluation, or you go through the Forge account and you trade with us. You get some payouts. We move you to real prop, and there you go. That's the process. As for tools and resources, extra bells and whistles and so on, we give you everything you need to succeed. So top tier platform and data. If you need scanners or templates for stocks, we've got you covered. We've got them. We'll send them to you. Education and strategies. We routinely do boot camps and different events, either in-house or through our partner, the trading platform partner. Everything is included for the most part. Okay, there's also additional tools that you can purchase and things like that. Asset class diversification, futures, stocks, day trading, swing trading. You can stack 10 day trading accounts on futures, 5 swing trading accounts on futures. You can stack 5 day trading accounts on stocks and 5 swing trading accounts on stocks. If you're doing the math, that is 25 accounts. Maybe all crypto wise. We have Rise and Revolut. Those are going to be the primary. I don't know what happened with Wise. I don't know. We had them for a period of time, but I'm not sure. Crypto, you can pay in crypto, but I don't know of yet if we are paying out in crypto. I know the team's working on it though, so we'll see what comes of it. Let's talk about TickBlaze. Anybody here familiar with TickBlaze, the trading platform? It is a fantastic platform. There's a lot you can do with it. There's floating desktops. There's pinned desktops, and where you can drag and drop functionality. All of that. There's desktop trading for PC, but there's also browser-based trading, web-based for if you're trading on a Mac or anything along those lines. We have you covered there. There's also mobile, which is coming very, very soon. From what I'm hearing and what I've seen so far, the mobile trading app is ridiculously cool. The major advantage to this is there are trade copiers on every desktop platform, web platform, mobile platform. So I think about trading 10 accounts with a trade copier on a mobile, and I start to sweat a little bit, but the functionality, the capabilities there if you like it. So that is all available. Okay. Let's see, additional indicators, strategies, trading tools available through the TickBlaze marketplace. And then obviously we talked about trade copiers. There's also tons of algos. If there's any of you that are algo trading, there's a lot available for you there. So As for deals, we have some major deals going on. You'll want to use the Traders Corner links, which they'll put in the chat box for you. But really, the sprint evaluations, we've got 50% off from the get-go, and then bundles of 3 and 5 are discounted even further. So if you wanted to get 10 accounts, you're going to get 60% off. So you can certainly do that. And then on the Forge accounts, to give you an idea on what those costs are. By the way, the sprint evaluations are 55 and 85 to give you the actual numbers. That's your starting point. And then if you get 55% off or 60, you'll get bigger discounts. Forge is roughly about double that, potentially triple, depending on if you do the end of day or the intraday. So you've got 125 and 200, or you've got 150 and 250 for the direct payout. So save you some time. You know, instead of having to do an eval and then go cover the drawdown, you just cover the drawdown and start making money. So good deal. How do you get started? Which account do you want? Day trading, swing trading? Are you trading futures or stocks? And then are you trading sprint or Forge? And then you can get started. You apply your discounts. I think they posted the discount in there. Just use PST bundle is what you want to use for the account code, and then start trading. Start working toward getting everything going. So help in training is available. Prop Shop Trader, you just go to support@propshoptrader.com, or for platform support through TickBlaze, just support@tickblaze.com. Here's the cool thing. How many of you are trading other prop firms? Maybe you have a rhythmic prop firm or something like that. You can trade your TickBlaze. You can trade with TickBlaze. You can trade your Prop Shop Trader account and trade your rhythmic prop firms or your live account or your stocks account. Any of these, you can do that all at the same time in the same platform with multiple connections at the same time. It's insane. There's so much you can do. So anyway, lots of capabilities there. And then as far as FAQs and things like that, they're all available through the Prop Shop website. So if you are an affiliate, if you want to get involved with Prop Shop Trader, you have a following, you have a community, you have a Discord, whatever the case might be, reach out to our team. We would love to hear from you, hear more about your setup, and look at partnering with you with some lucrative opportunities. So I've finished early at this point. We'll go back and answer some questions. I think there were some questions that came through, so let's take a look. Yeah, wealth charts we are very familiar with. Rob, great guy. We are looking at potentially expanding into different platforms and things like that. So it is on the radar. We're looking at some options there. So very cool. But glad to hear that you're using wealth charts and you like it. That's cool. For the 500 MAE, it's a 5-point stop for 2 ES contracts. Yeah, it could be, but at the same time, and the question is that a little restrictive? It could be if you're trading 2 ES contracts, but the thing is, with a 500 MAE, you're really only required to make 125 for the day. So most traders that are looking to make 125 for the day, they're not trading 2 ES. They might be trading 3 to 5 micro ES. So in that sense, no, it's not really restrictive there. So how do you do taxes? So we are based in Estonia in Europe. So for that, we don't issue any 1099s, nothing like that. It is all done through self-reporting on the sim side. When you get to real prop, we issue 1099s because it's the real prop arm is based in the US. So you'll get 1099s. But on the sim side, it's all self-reporting. Okay, good deal. What other questions do you guys have? What else can I answer for you? It could be trading related, could be based on prop shop, different accounts, rules, scaling, anything at all that I can answer for you. TickBlaze, even the platform, I can answer that. Since we have a little bit of time, let's check out the web platform. Let me show it to you while we're at it. What would you report sim trades for taxes? So good question. Richard's asking, why would there be reporting for sim trades, right? So there's sim trading payouts. So the traders, when you're in a sim payout account, you actually get paid for trading on simulators. And so obviously, if you have income coming from that, you would need to report. Well, I can't tell you what you need to do, but odds are you need to maybe look at potentially filing that and get with your tax person and see. Evals are, and so they're asking, is it 55 or 85 per month per account? It's actually a one-time fee. It is per account, but it's not recurring. So if it takes you, you pay that once and you're in your payout account for 3 months, you pay that once. If it takes you 2 months to pass the eval, it takes you 2 months. You're good to go. Just a one-time cost. Here is the web platform. Really, really cool. And you've got, they should look awfully familiar, right? You've got your trading view charts, second charts, which is an upgrade in trading view. Ticks, you've got all those as well. Here's the other thing. You can have as many charts as your heart desires in here. That too is an upgrade in trading view, and it's built into your prop shop trader account, so you don't have to pay anything extra for that. The other thing that is really cool is if we go new panel, hit new chart, and let's say we want to trade MES over here, and we want this to be on a 5-minute chart. We can click 5 minutes, and now I have multiple charts, and I can drag this wherever I want this to go. So let's say I want it over here, and maybe I want it over on the right. I can move this wherever I want. It's a docked workspace, drag and drop. You've got your watch list over here. You've got two options, watch list or chart. When it comes time to trade, you hit the trade panel right here, and you can click between your charts, and it'll automatically switch. Then you put, how many contracts are you trading and so on. If you want to enter and scalp, you just hit the buttons, right? If you're trading on a market order, you just put how many contracts are you entering, and it's going to enter. Limit orders, let's say you want to put a limit order up here, and you put 3 contracts, and you want to do take profit, stop loss is all here. You want another take profit, that's fine. You can do, you want to do 100 ticks, or you could do this based on reward. If you want to do, percent reward percent balance, and there's a lot of options in here, but I think for the most part, traders are going to use ticks and then move it around as needed. Stop loss, again, you've got ticks, percent price, risk, so on. A lot of options as far as that goes. So this is all built in. You also have the DOM available if you have level 2 data. I currently don't have that enabled, but yeah, that is the TickBlaze web. Very cool. One thing that you'll also see, I haven't traded these accounts. I think I took 1 test trade on this, but if we go to trading stats, this is very, very cool. You see, I think I only took 1 trade or something like that. But you've got a performance matrix. So you've got profit factor, consistency, recovery, win, loss, drawdown, win rate, profit and loss, profit factors, all these things in here. You've got your trading calendar, which shows you what did you make, what did you lose, all that's in there. And then trade history, you've got your summary, open positions, and so on. Performance and risk, what's your best performing highlights and things like that. They'll populate in. All of that's in here. So when you think about this, I've paid for TradingView for months and paid for a trading journal for months, and they're not super expensive, but they're not cheap either. So save yourself some money. All this is built in. If you trade on the desktop and you want to see the performance, just go into the web trading platform. You'll see everything. Even if I enter this on the desktop, it's still going to be in here. So really, really cool. We have that built in. You also have community and the video playlist on how to do everything's in here. Really cool. Trade copier. Trade copier is right here. So you just enable it and you put which account's going to be your leader, and you would, you got to grab it over here, move it there, and then you move your followers into position. Oops, there we go. And then move your follower and another follower and just drag and drop. And then when you're ready to go, you enable it. Put your multipliers. Do you want it to be multiplied up, down? Do you want it to be micro to mini, so on? And then you also have a max gain and loss for every single account that you have in here. So you can set max gains and losses. If your leader is set to a max gain and it hits it, it's going to liquidate all of your followed positions too, obviously. But if this has a max gain, it's going to detach as a follower, and it's going to let your leader keep trading, which is really cool. So logs if you have, all of your info on what the copier's doing, and then global settings, you can say, when disabling a leader, what do you do with the followers? All that's in here. So really cool. I mean, this just does not exist on web platforms that I know of anyway. You got all your accounts and orders and positions and everything's down there too. So really, really cool. So check it out. I think, traders will love trading on this. And so far that's been the case. So let me answer some more questions. Risk per position is new, but I used to enter 3 positions and close 3 at once. We'll work with daily drawdown in mind. Yeah. Positional risk is very important for the survivability of a trader. So there is resets, Al. Yeah, absolutely. There's resets. If we go to the site, and if you go to pricing, I'll show you real quick where you can find the reset cost. So if we go to intraday futures and we go eval, it's automatically going to go to sprint end of day. And then when we scroll down, you can see the reset fees are right here. So 65 and 100. I believe these are actually changing to be more in line with what these costs are. So that could be changing. Don't hold me to that, but that could be changing. But that's where the resets are. In this case, you'd be better off just buying a new account versus reset. So, but on some of the other ones, like if we go to the Forge, like these are 125 and resets are 100. So that's pretty nice. And then on these, they're 200, but your reset's 175. So, so yeah, everything's right there for you. Let's see. How long can I trade in sim and still be paid before moving live? Typically, after 3 weeks of payouts, 4 weeks of payouts, we start watching and to see if they're, if the trader's a good fit for live. If the trader is getting to about the 5-week mark, that's probably when we're going to start looking at bringing a trader over. But that said, if the trader's not ready, we'll have that conversation with the trader directly. So yeah, these are futures accounts. We do have stocks accounts though. So if you go to stocks, you got intraday, you've got swing trading accounts. They're all in here. Yep. Let's say, okay, so Patricia, 1,100, 600, 1,000 running positions. You want to close 700, but 1 position, bigger loss than 1,000 if you fail. So it's each position would be, if you're down at any point in time on a single position, then yeah, you would end up hitting the MAE. But I think it's, if you, I'm trying to understand the scenario a little better. So maybe if you want to elaborate a little bit on it, but it's per position. Do you need a pretty high data plan to use this? No, not at all. I mean, the latency might be a little bit greater if you're not as fast, but I don't know how that works. But I don't think you need anything special. Does the ATM entry or stop strategies include auto break even? On the desktop, yes. On the web, I don't believe so. I haven't seen it yet, so you would have to do it manually. You'd have to just move it manually. But on the desktop, absolutely. The trading platform is TickBlaze. There's currently no option, unfortunately, to integrate with Ninja. We are looking into some different options to be able to do that. So it's something we're looking into, but right now it's TickBlaze, which TickBlaze is great, but I get it. If you have all your tools and stuff in Ninja, then that's a thing, right? Yeah, mobile app, there is, I don't think you need, a very high trading plan or data plan for that. Yeah. Yeah, TradingView would be nice. We do have the TradingView charts, but of course the functionality as far as getting the orders in, it's all done through the trade pad over here versus TradingView itself natively. I know some of the traders have tools that they love using in TradingView. Here's the deal on that. I'm going to show you guys something. How much time do I have, by the way, Anthony? Am I at 3:45? Am I over, or do I have till 3? I don't remember. If you're there, I must still have time because they're not they're not waiting for me.
Yeah,
So.
no, there's no rush. Sorry, I was on mute. So yeah, Go ahead. Yeah, take your time. Yeah, thank you. Also, we got spots available. So for this giveaway. So make sure you sign up. I see people asking
Yeah.
questions that I haven't seen sign up for the free account yet. So make sure you do that. It's getting close.
Yeah, absolutely. Get your freebies. So what you see on my chart here, this is the TickBlaze desktop application. Aside from these levels, which these are really cool too, these are options levels for futures. So those of you that are geeking out on the options stuff from our last presenter, these are 0 DTE options, open interest levels. So a lot of traders love using these, and you can see how they respond. I'm just scrolling through. There's a bounce, there's a bounce, there's another bounce, there's a bounce, and it finally breaks through. And what does it do? It trades the other side. I mean, this is just textbook stuff that we see as traders, right? There it is again, bounce, bounce, bounce. These are killer levels. They're built into the platform. They come with, it's free. Like, it is free. So sign up to win the free account. We're giving away 4 25K accounts. So be sure to get in on the draw so you can get in. But these indicators that you see with the zigzags and the boss lines and the, the trend change lines, all of this, I built this myself, and I'm not a coder. Like, I know some, very little, but I did this with AI. Like, no joke, AI did this with me. So I had to tell it very specifically what to do, but all that's built in. And then down here, I put divergent signals on volume delta. So, and I built a bunch of stuff in here. Point of that is, if you have something in TradingView that's like open source that you want to put into TickBlaze, it's pretty darn easy to just take that and run it through AI coding and say, put this into TickBlaze. Let me know, what do I got to do to get this done? And it'll take you a little bit of time. Once you get used to it, though, it's pretty easy. So all that to say, if you're coming from TradingView and you have specific tools you like using, you can code them in here. Now, the other thing is, let's say you're only web-based and you want to use a specific TradingView tool. You can code it for the desktop, and then this is above my knowledge level and pay grade, but there's something called a wrapper, and it's not like you think wrapper on the microphone, but it's a wrapper that somehow takes the code from C#, which is the language of TickBlaze, and it puts it into the web TickBlaze, into Java. So again, above my head, I don't know how that stuff works, but it works, and so it's coming very soon. So that is a possibility as well, that you could code it into TickBlaze and then use it on the web. So anyway, just different ideas, things that you can do, and all that good stuff. So rightio. What else? What other questions do you guys have? What else can I answer for you? Anything? Anything? Here is my encouragement to you. I have two things that I'm going to encourage you to do. One is go in and grab a Sprint account. 55 or 85, super inexpensive. I know you've all spent far more than that on stuff you don't even use. So come in, get an account with the opportunity to get some serious payouts, again, up to 1,000 to start and 2,000 to start on these accounts. Go in and grab your account, get started with us. Definitely enter to win a free account. Do that. So get in there, check it out. And if you have any questions or need anything, let us know. But otherwise, I think we're pretty much good to go. I think we've mostly answered the questions. How much experience do you need? Technically, you don't need any experience. Although I would say, if you're looking for experience, we have tons of free education that you get access to as part of Prop Shop Trader through our partners at TickBlaze. They give you access to an entire academy of trading info. So here's the thing, guys. The Trading Academy itself, the on-demand videos that are in there, I mean, there is hundreds of hours worth of really solid trader education in there. So if you're looking to get educated as a trader, grab an account. You don't even have to trade the account. You do have to trade it once every 30 days so it doesn't deactivate. But you can go in and go through the entire academy just by getting a Prop Shop account. So for what it's worth, there's tons of education, and it's really, and I'm not saying this because I'm biased, which I am biased, but there's really good education in there. So does TickBlaze only run on Windows? Yes. As of right now, TickBlaze Desktop only runs on Windows, but we do have the TickBlaze web traders available as well. So good deal. Awesome. Well, you guys have been great. I appreciate all the questions. It keeps things interactive and makes it a little more interesting for me as well. So I don't feel like I'm just talking to a computer screen. So very cool. Can you flash available day trading strategies? You could trade. Yeah, you could trade whatever you like. If you want to see more on the Academy side, just reach out to support. We can maybe send you some insight on what's in there. Platform is TickBlaze. TickBlaze. So you want to go to tickblaze.com if you want to check it out and learn more about what TickBlaze is, the platform, what's available, all this good stuff. So there you go. I think this is more for like B2B partners and stuff. But if you go to, I'm a retail trader, then it'll give you all the details on that. So cool. All right. Well, I think we covered it. I will go ahead and hand it back over. Last question we will answer. Let me get that for you. Let's go to prop shop and I'll tell you the cost right now. Now stocks works a little bit differently. Because of the regulations in stocks, there's no sim payouts. What happens is you trade on the stocks account, and then when you get through certain benchmarks, you get moved to real prop and you earn a signing bonus, which is pretty lucrative. So it's 3,000 and 6,000 per account, up to 5 day trading, up to 5 swing trading. And so the cost is pretty inexpensive for these two. But yeah, so $60, $100 for the stocks day trading. And then for swing trading, it's 60 and 120 for those. So same signing bonus, 3 and 6. So yeah, so those are your stocks accounts. So load up. But yeah, let us know if we can answer any other questions. Otherwise, thanks for hanging out. One thing I'll leave you with, starting, I believe it's July 10th. July 10th. So after we get back from the holiday, we are going to be doing a weekly free trader education session every Friday, 10 a.m. We're going to review risk management, trading strategies, psychology of traders, foundations of trading, charting and platforms, and the whole gamut. We're going to do a little bit of each every session, and we will spend time doing live trading as well. It is completely free. We're doing that through TickBlaze. So you definitely want to check that out. So keep an ear out for TickBlaze. It's called Tradecraft. Tradecraft. It's completely free. It's our way of giving back, and I'll be actually hosting those myself, and we are going to have an absolute blast. 10 a.m. Eastern, starting July 10th. So keep a lookout for those. You are all welcome to join. Invite your friends. We're all going to get in there and hang out as traders. It's going to be a blast. So very cool. Awesome. Well, traders, have a good rest of the day. Enjoy the rest of the week. Go US. We're playing tonight. Get a win, and hopefully your team wins. If you're not rooting for the US, that's okay too. But enjoy the rest of the week. And if we don't catch you, have a safe holiday, and we'll catch you later. So thank you, everybody. Take care.
Hey, thank you, Jim. Thanks for your patience and answering all those questions and going through everything in such a manner for us to easily understand. That's very important, because these things could be very confusing, but you did a really great job setting it out for us. So thank you so much.
Okay, awesome. Thank you.
Yeah, thank you. That was an incredibly informative and you provided tremendous insight into today's prop trading landscape. Thank you for sponsoring today's giveaway and for your generous offer to our attendees. So check out the offer, sign up, for the chance to win a free account. And I've placed Jim's special offer link in the chat, and now we'll conclude today's educational session with one of the most anticipated presentations of the summit. But before we do that, make sure you guys sign up, because this is going to be our last. This is going to be your last chance to sign up for the giveaway. So it's there. It's the last thing on the chat. So if you haven't signed up, be sure to do so, because after this last presentation, we're going to do the giveaway, and we have 4 $25,000 accounts. So please make sure you do that. So without further ado, please welcome David Wise of Right Line Trading. David has become one of the industry's leading options educators and is known for helping traders identify explosive opportunities with defined risk. Today, David will reveal small risk, explosive upside. You'll learn about the UMCAT strategy, which since November 17th has produced a win rate of 86%, a profit factor above 5.0, and more than 42,000 in profits, risking just $500 per trade. Unbelievable. David will discuss how institutional money flow, volatility, high volume Hakanashi candles, and the SPY super system scanners work together to identify high probability options opportunities. So everyone, please welcome David Wise, and don't forget to sign up for that account if you haven't already. David, are you there?
I am, Anthony. Thanks for the introduction. I appreciate that.
No, thank you. I appreciate it too. I apologize. I think I left you hanging last time. I had taken my headphones off.
Oh, that's all right.
And I didn't realize. I'm so sorry.
No, don't apologize. It's no big deal.
Okay.
I wrap up. I just try to quietly slip out.
All right. Sorry about that.
All right. Thanks a lot, Anthony.
Yep.
We get started here. I appreciate that. Again, good afternoon, everybody. And if you're in this time zone, my name is Dave Wise, and I'm with the Brightline company. We do. I have a piece of software called the SPY Super System that we're going to talk about today, which is what I use to drive all of my strategies and methodologies for day trading and swing trading. We do also day trading and swing trading. We're going to take a look at the software. I have a trading room that I'm in every day, market open to market close, with a little bit of time for lunch. But other than that, I'm there all day long, talking to traders, going over setups. We keep these SPY Super System set up so everybody can see it, and you can ask me questions. And we talk about. We have a lot of hundreds of members, and a lot of our good trades come from them. And we also have a text alert service, which you can sign up for. So we're going to get started on this and get through this. Again, I think you're going to find this very interesting. First thing I've got to do, of course, is the obligatory disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And that's important. And neither myself or Brightline Trading are licensed financial advisors, so we won't be giving financial advice. And the bell just went off, so the market's closed. Crazy day in the market today. If you didn't see it, we had a big gap up this morning. Looked like we were heading above the 50-day moving average, going to take a big move up in the market, and it turned around and headed right back down again and closed pretty much close to it. All right, so let's get started. If you have any questions, I'll keep the question box open so I can see any questions you put in there. If you have any questions that I can't answer, Rory from Brightline will give you a call if you just put your name in there with your phone number or your Teams username, and he can get a hold of you that way. And there's his number right there, 786-732-4656. And he will. You can call him if you have any questions. All right, but I'll monitor that, and I'll display this again at the end. All right. So in the room and on the in the text alert service, we have strategies for intraday trading and strategies for swing trading. And I'm just going to go over them briefly so you know what we use. Typically, I use options. I do trade some stocks sometimes, but mostly options. We do straight calls and straight puts. We just had a really nice trade yesterday on a stock called Circle, CRCL. We get in for $6.20 yesterday afternoon, and we closed it out this morning for $8. A pretty nice trade. And then we also do straddles to strangles. If you're not familiar with these are non-directional trades, and you don't care which way the stock moves. You just want it to move a lot. By the way, all of the trading strategies we do are what's called defined risk. You can't lose any more than you risk when you put the trade on. You don't. It's like with futures. You have leverage. You can actually get. You can get if you don't manage it correctly, you can get margin calls, etc. With these, whatever you risk is what the most you can lose. So we have. It's called defined risk, which is that way you can control your risk very carefully. You don't put any more money into a trade than you can afford to lose. We do debit spreads using weekly options expiration. I do sometimes time spreads. I haven't done a lot of these lately. Time spreads over earnings. This is a non-directional trade where we capture premium based on the volatility of the stock. quickly, what happens is before earnings come out, the market makers jack up the premiums on the puts and the calls, the options, because they don't know which way the stock's going to go and how much it's going to go. So they protect themselves by increasing the volatility on the option premium, which pushes the cost up. Then when the earnings come out, those premiums then start to drain out of those option premiums, and there's a way to take advantage of that, which is called doing a time spread. Basically, what you're doing is selling this week's calls and buying next week's calls to take advantage of that time spread and all volatility crush. I have a strategy called the weekly ATM strategy. This is a strategy where we take a stock that's neutral to bullish, you sell puts on it each week. It has weekly options, and at the same time you hold on to another put, a longer dated put that you're long on at a lower strike price to protect yourself in case the stock moves down. And in the room, by the way, I have videos on all of the strategies that we use, as well as all the indicators that we use in the service. And we do credit spreads to capture premiums over a few weeks. Now, on the intraday side, and I'm going to talk a lot about intraday trading today. Swing trading is tough in a market like we've got right now, which you have these big ups and downs. But we do a lot of intraday trading, and we have two methodologies basically. One's called the SPY Super System, which is the same as the name of the software. But the SPY Super System is a methodology of catching high probability trades in the SPYs, the Qs, the IWM, futures, or even in stocks. And these all use in the money puts and in the money calls. Always using in the money puts and in the money calls for the SPY Super System. Recently, I've developed a strategy called OMCAT, OMCAT. This stands for out of the money catalyst. And basically what we're using here is we're using out of the money calls and out of the money puts. Now I have to say that this is something you should never do unless you have a very specific setup. If you take out of the money puts and out of the money calls generally on any trade that you take, you're going to lose money on it. Swing trade, day trade, you should never be taking out of the money. But there is a strategy that you can use out of the monies for high momentum trades with high volume that would make really big returns when they work. But you've got to, you have to manage them. You have to be fairly nimble because they're quick trades. You get in and get out. And I'm going to go over the results I've had with this. I put this in effect on November 17th and been trading it ever since. And it's really had some really outstanding results. And one of the things you'll see here is that the returns on the normal trades that we have in the room, swing trades and longer term intraday trades, typically run for about 25 to 40%. These OMCAT trades can easily run to 75 to 200%, and because you got low priced options. So we'll talk about that. But that's what we're going to talk about as far as intraday trades are concerned. So here's the two systems we use for that. Basically, just trading SPY Super Systems and OMCAT trades. Okay, and the reason that I did this OMCAT strategy was because if you're not aware, there had been a rule that's been in effect for years and years called the PDT, and that's meant pattern day trading, which means typically if you're trading intraday trades, in other words, trades that you're day trades where you're putting the trade on, taking the trade off in the same day, unless you had more than $25,000 in your account, you could only do 3 of those in a 5-day period. Then you had to wait, right? So they've changed that. In fact, in April, April 14th is when they made the change. And now the platforms are switching over, and most of them have switched already over to where there really is no more PDT rule. If you've got $2,000, $2,500 in your account, you have a small account, you can now trade day trades. Intraday trades, you can take as many as you want. Obviously, you can't take more than you've got money for, but you can do that. So now the traders, the intraday traders, day traders who wanted to be day traders and couldn't day trade, now they can day trade where they couldn't do it before. They can take as many trades as they want. So if you have a $5,000 account or a $10,000 account, you can get out of a trade. You can intraday trade for as many as you want. You can take 10 a day if you want. I usually do about anywhere from 2 to maybe 5 or 6 a day, depending on the market setup. Obviously, you have to have a market setup for that. Okay, and the reason I did this was because I knew that when this PDT rule changed, you were going to have lots and lots of people coming in to do day trading that hadn't been able to do it before. Bringing in lots and lots of retail traders to day trade now. And the unfortunate thing is most day traders don't really have strategies or understand strategies or have the information available to them to actually do this successfully. So it's a good thing for us as basically traders with good methodologies. We have an edge over the market. We have an edge over the other retail traders. It helps us because there's a lot more people that we end up taking money from. I mean, you have to be blunt about this when you're trading. You're trading against other retail traders, and it's a zero-sum game. Somebody wins, somebody loses. So this, I assume, was going to bring in a lot more traders, and it has, and it gives us a better opportunity. Okay. Hey, Patricia, for zero DTE, better only trade in the money and take profits at 80% of risk amount. That's if unless you've got this. What I want to mention, I'm going to talk about this these UMCAT strategy because taking for basic strategies, for strategies that you usually use, and even on zero DTE, you can take in the money, and I usually do that because when I'm trading zero DTE, I'm usually trading the SPY, the Qs, the IWM, something like that, or some of the stocks that allow options to expire Monday, Wednesday, Friday. But on UMCAT trades, and I'm going to explain this to you, you can take out of the money because your ROI on out of the money is a lot higher if you have the correct setup. But for any kind of zero DTEs, for most time, you should normally do them in the money. And any swing trades should always be in the money. You don't take out of the money options on swing trades. Okay. All right. We also have a text alert service. We call it Compass. It's actually SPY Super System. The Compass system is what the SPY Super System used to be called when it was first started. It's been changed and modified and improved since then. But I still call it the text alert service. And we send out text alerts on basically swing trades. I can't do quick SPY Super System trades or UMCAT trades on alerts. There's no time. It's much too quick. But I do call them out in the room as I see them. All right. Now moving along here, one thing I want to cover, and I do this in all my webinars, and you've heard this before. I'm sure you've heard it, but this is just meant to explain what moves the market. It's very important to understand what moves the market. The market is moved by the institutions. This is the big money groups. We're down here. We're these little marbles. We're the retail traders, and it's important to understand that when there's not a lot of institutional activity. When I say institutional activity, I mean you don't have a bunch of institutions all pushing a stock or an index in the same direction, because the institutions are always in there trading. But I mean, you could have Bank of America trading Microsoft long, Goldman Sachs trading Microsoft short, and somebody else trading a hedge on it. That doesn't help. What we want to know is when there's a group of the institutions all moving a stock in the same direction at the same time. All right, up or down, whether it's stock or an index. So the institutions are made up of four groups, the way I look at it. You have the investment banks, Goldman Sachs, JP Morgan, Morgan Stanley, Wells Fargo. Everybody knows all the investment banks, billions and billions of dollars to trade with. Then you've got to remember there's also hedge funds. Hedge funds are another big player in the institutional environment, right? And mutual funds are also a big player. Lots and lots of money there. And then pension funds. Pension funds are very big as far as institutions are concerned. They have a lot of money to trade with. So those four groups are what makes up institutions. And our job is to find out when the institutions in force are moving a stock in one direction or the other, or an index. Could be the SPY, could be the Qs, could be Microsoft, could be gold, could be anything. We want to know when that's happening. Right, and that's what the SPY Super System identifies. And that allows us as retail traders to basically ride the coattails of the institutions, because that's the only way we're going to make money. We're not going to make money just trading against other retail traders, because retail traders do not set the market. They don't set a trend. So we're just causing chaos and mayhem when we're in here, chaos and chop. So when the institutions are in there, we want to know about it, and that's when we take trades. Okay. Now it's also important to understand one other thing about institutions, and that is most of their trades are done by algos. Algos being computer programs that they write, call algorithms. They call them algos, and if you've heard of algo trading, these are the programs that the institutions have written to look for specific setups in the market or news. They read the news. If you've ever watched the market react after the jobs report on a Friday morning, or after the FOMC comes out with their interest rate, whether it's going to be raised or lowered or kept the same, when they come out with their blurb, their note on the what the interest rates are going to do, the institutions have programs that read that immediately. So if you ever look at the market like the SPY, the S&P 500 on a 5-minute chart, if you look at it, when that report comes out at 2 o'clock on a Wednesday, you'll see 2 o'clock in about a tenth of a second or less, you're going to see this huge spike in volume. That's the algos from the institutions that are trading it based on what they've read. You can't even push your mouse that quick to even do it. So this is all algo trading that does that. And this is there's some really insidious stuff here, because institutions they can identify stop losses when people put stop losses in. If they find a level that has a lot of folks with stop losses in, they'll have algos that'll drive the price down to that level, and then pop it back up through it again once they take you out. And if you've ever had that happen to you, you probably think they're coming to get you. But basically, they only do it when there's enough volume at that level to justify it. And they'll take things like MACD crossovers, which is a lot of traders use, a strategy that a lot of retail traders use. They can break that. They can create them and then take them right back. So they have algos to do all that kind of stuff. And that's why it's important that we follow what they're doing. Okay, so that's what institutions are. That's what moves the market. We as retail traders just want to know when that's happening and take advantage of it. All right, quickly here, this is a blackjack table. And this is kind of curious. Why do I have this on a presentation about trading? Well, I used to be a blackjack player. I was a card counter a long time ago. I was a card counter, and I made my living doing that. This is a blackjack, ace jack of spades, couple $100 chips. And the reason I put this on there is because people always say to me when they're thinking about trading, or when I started trading, I told them what I was going to do. They'll say, you're just gambling. This is fixed. You can't beat it. You're wasting your time. Okay. And I had been a blackjack player from a long time ago. Patricia, institutions paint patterns with huge capital. Yeah, they do. I mean, when there's something going on in force, you'll notice it on the volume and on the price action pretty quickly. They try to confuse us with everything. You know, they say that the main objective of the market is to take the most money from the most amount of people as often as possible. Okay, so when I was much younger, I played blackjack for a living. I lived in Las Vegas. I did what's called counting cards. Just briefly, counting cards is not actually counting cards. It's keeping track of what the remaining deck, what the composition of the remaining deck is. Simply, when the big cards are removed from the deck, the ace, 10, jack, queen, kings, and aces, as they're removed from the deck, it swings the advantage to the house. And when the little cards are removed from the deck, the 2s through 7s, that swings the advantage to the player. And the method of card counting was to understand, by keeping track of what cards are removed, what the composition of the remaining deck is, whether it's in your favor or against you. When it's in your favor, you can bet more money and take more hands, and when it's against you, you just bet the minimum, right? So that's how I got the edge, all right? So what I'm trying to be aware of here is that trading stocks and options can be exactly the same. It can be gambling. If you don't have an edge, you're just gambling. That's what you're doing. So without knowing what the institutions are doing, the trader doesn't have any edge. You have to have an edge to become consistently profitable. So in essence, you're gambling. It's exactly the same. The SPY Super system, I consider my card counting system. It gives me an edge over the other retail traders because I know something they don't know, and we have strategies that are better than what other people use, right? So again, the SPY Super system, in conjunction conjunction with identifying the best high probability trades can lead to consistent profits, which I feel what everybody wants to achieve. That's what we're all here for, to make money. I mean, I love trading, but you know, it's you just don't do it for fun. You're really trying to make money. Now, I want to point something out. When it comes to trading, and this applies to playing blackjack too, but both of these require discipline and emotional control. And this is probably the most important thing that sinks most retail traders. They are not able to maintain discipline and not able to maintain emotional control. Discipline means having strategies that you know work. Ours work 85 to 90% of the time. So you've got to have those strategies and you stick to them. Don't read about something on X or on Bloomberg or on CNBC, or read about something in the paper, or get a stock tip from your brother's uncle's cousin's brother-in-law about a stock. What you're doing is you're looking to actually stick to the strategies that work, that we know work. We've proven them that they work. You stick to that. So don't go off the reservation, so to speak. And then the last one is, the second thing is emotional control. Now, this is really important, and this is really a difficult one to manage. One of the first things I tell folks who happen to come into my room to talk about it for training is, please don't watch your P&Ls when you're trading until you get ready to get out of the trade. Don't watch the P&L. You should be getting into a trade on technical setups based on your charts, right? And so you don't be looking at your P&L, because as soon as you start to look at your P&L, you're impacted by whether it's red or it's green, and you start to change your trading. If you're in a trade and it goes green for you, you're up $200-300, and it moves back down, and now you're down $100, and then it comes back up and it goes up to 100, and then it slips back to 20. You're up 25. Traders will bail on that because they feel relieved, because they had a loss and now they got a profit. They take no attention to what the stock price looks like or what the chart looks like. So when they're bailing on these trades because they're relieved because they're not down money anymore, they probably should be adding to the trade to increase their edge, because they're still in a very high probability trade setup. So that's important. But an emotional control also comes in. Trading is fear and greed. I mean, it's fear and greed is what drives the market, obviously. Fear of missing out. You see a stock take off in the morning, you start chasing it up because you figure everybody's making money on it. Finally, you can't take it anymore, and you get in, and of course it reverses on you, right? So that's fear of major. And then there's greed. When you stay in a trade too long, you're in a trade, you're up 100% on it, and you think it's going to go higher, even though it's run right into resistance. Technically, you should be getting out, but you stay in because you think the trade can make more money for you. Again, that's greed, and that's because you're looking at your P&L. Now, one other thing that to be aware of is the emotion of the kind of the elation you get when you win 4, 5, 6 trades in a row. Right? When you have a win when you're trading stock, your mind gets a dopamine hit, just like it's a makes you feel good that you won, and you get 2 or 3 of those in a row, and all of a sudden you start taking trades you shouldn't, because you think that now I've got this all figured out, I can win, and you start to get away from your discipline, right? And you start taking bigger edges, you bigger trades. You think you're taking more risk because you feel as though you can't be beat. If you feel like that, any kind of emotions like that, you need to step back for a minute and not to trade, because this is really can hurt you. And then there's another thing that would be anger, and that would be like a trade that you wrap money on and you end up losing on it. You thought you should have won, and now you get angry. So now you start doing revenge trading, and usually it's with the exact same stock. The stock has beaten you up once today, and it's not going to beat me again. I'm going to get in. I'm going to get in and get my money back by using that stock. There's no need to use that stock. There's plenty of other good stocks out there, but that's revenge, that you're angry, and that's an emotion, and you've got to stay away from that. So anyway, those are the things that can hurt any kind of a strategy like with trading stocks and options. It was obviously a big problem when counting cards. Okay, I'm going to move along here. Hey, Hardy. Okay, so this I'm going to show you right here. I'm going to show you the SPY Super Systems software setup. All right, now this is running on Thinkorswim on TOS. but I don't know. But you don't have to trade on Thinkorswim. I trade on Tradier. You can trade on any platform you want, but this is where the indicators are going to be displayed. Okay. Patricia, fulfilling consistent rule is dangerous as well. Going for a specific dollar amount. A very good point, by the way, that Patricia just made. I don't have any set goals for day, week, month of how much money I should make. It's how much the market's willing to give me. If you say you want to make $1,000 a week, and you're up $900 on a Friday afternoon, and now you start taking crazy trades to try to get up to 1,000, it's a very bad thing, right? Very, very bad thing, because basically you're putting yourself in a position where you're not taking high probability trades anymore. You're taking crapshoots to try to get even or try to hit your profits. What difference does it make if you're up 950 for the week or 1,000? But if you force yourself to take a trade and all of a sudden your $950 profit drops down to $700, now you're going to be kicking yourself, right? Now you're mad at yourself. You don't want that. Again, it creates emotion, right? So this is what the SPY super system looks like. And everything that I'm seeing here on the 5-minute chart, this is a 5-minute chart. This is all I need to tell me whether I should take a trade or not take a trade. This is it, right? It's very, very important. And I'll go over them pretty quickly here. This is an oscillator called the Laguerre oscillator, but it has the divergence stripped out of it. Most oscillators measure momentum and divergence. This just measures straight momentum. That's what we're interested in. What's going on with momentum? Now, this information here is reflected here in this current time frame momentum. This can be green or blue for bullish and red and yellow for bearish. Current time frame momentum on a 5-minute chart. This represents what's going on in the current 5 minutes. Right? This is multi-time frame momentum. This is in the 5-minute chart. This is 5, 15, and 45 minutes looked at together. And this is a long-term trend. Typically, I only use this for intraday trades, SPY super system trades, UMCAT trades. I only use the current time frame momentum, right? Multi-time frame I need when I'm doing swing trades. When I'm going to do a swing trade, when I'm looking at a daily chart, this has to be bullish and this has to be bullish. Don't have to be the same color, but they need to be either green or blue for long, red or yellow for short. They need to align, right? And then the long-term trend. If this aligns, it helps with giving you some more more probability. But I don't have to have this to match these. Right now, up here on the 5-minute chart, this is where the important stuff is for intraday trading. Right, very important. These are the 3 levels that I have on here. Right, this pink line here is called the VWAP, the volume weighted average price, and this is something that all the institutions have on. Right, volume weighted average price, very critical. It's basically a fair price. This is typically when institutions are getting in and getting out, they try to use VWAP, a volume weighted average price. This shows the price where most of the volume is coming through. It's again, that's why it's called volume weighted. This is, if somebody's buying 100 shares at a price and somebody's buying 100,000 shares at a price, obviously that 100,000 shares is more important, and that's going to impact the VWAP. Right, so that's the volume weighted average price. Then we have the 15 exponential moving average right here. And I'm going to get into this a little bit as far as how we use this to trade. 15 exponential moving average right here. The 8 exponential moving average right here, the white line. And the green line is the 15 EMA. A couple of ways we use this. When the 8 is above the 15, the trend is bullish. When the 8 is below the 15, the trend is bearish. So that helps you determine what your current trend is on a 5-minute chart. Now, on a daily chart, I still use the 8 and the 15. The VWAP does not apply to a daily chart, but I still use the 8 and the 15 on a 5-minute chart, on a daily chart to determine a trend, and also support and resistance levels. So those are your 3 support resistance levels that if we're entering an intraday trade, we're going to try to take it at one of these levels, the VWAP, the 15, or the 8. Okay, so those are the 3 key things that we need, obviously based on what's going on down here with the current time frame momentum. Now, one of the things that's really, really important is these are the candlesticks that you see right here. Okay, now if you notice, I've got green and yellow. Green and red. These are normal bullish candlestick and a bearish candlestick. But look at these. These are white, right? These are high volume bullish candles, right? This is really important because high volume, you see how the stock is breaking through the VWAP right there and the 8 and the 15? See how it's doing it on big volume right there? And then you get more follow-up volume like this. This tells you that the likelihood is this move is being done by institutions with some big force here. And that right there is a whole, that would be a whole UMCAT trade. If I took the, this is the SPY. If I took the SPY right there as an UMCAT trade, and I could actually take, because it's white, I could take it out of the money, right? Normally I don't on SPYs. I usually use in the money, but this would be an out of the money catalyst trade. What's the catalyst? The catalyst right here is two things. It's breaking through the VWAP, and you got high volume candlesticks, right? And this is flipping back and forth, but you notice it went blue, and now even though it went yellow, that's just because it went flat. But this is, when I look at this, I still look at this as bullish, because this is not dropping down, it's still moving up. So that is a bullish setup right there. Those high volume candlesticks, and then you've got high volume bearish candlesticks. So if you're in this trade, as soon as you flatten out like this, you take it off. All right. And I'm gonna look at some live charts on these things so you can actually see what these look like. So there is your key things on the 5-minute chart for trading intraday trades using the SPY super system. And I'm going to go over some of the details of this as we get in. I also have one other thing in here. This is the VOLD. This tells you what the overall market's doing right now on a 5-minute chart. It's just colors, green, blue, red, yellow. It's going to tell you whether the overall market, this doesn't apply to the SPY. This is, what are the 6,000 stocks in the US Stock Exchange? What are they all doing, right? What's the trend? And that helps you to try to join the trend and go long if the market is bullish, and go short if it's bearish. Okay. And Patricia says, just ignore the P&L. Absolutely. The first thing I said when we started was, the first advice I give everybody is don't watch your P&L. Okay, so this is the SPY super system. All right, now this goes on your Thinkorswim platform, right? If you buy it, Rightline will put it on there for you. They'll set it up. It'll look exactly the same as mine. It's got some scanners I'm going to show you in a bit, but I just want you to actually see the layout here. This is all you need to trade intraday trades. That's it. You can find them. This is what you need to find them, and this tells you whether institutions are in there, and this is telling you if they're in there with force. All right. So I'm going to show you a couple of samples of some UMCAT trades we took, just so you can see how they're structured and how they're set up here right now. Right. So this was one I took, and these are just some random ones. This was Oracle that we took. Now these are out of the money. This is why I'm emphasizing how if the setup is correct, you can use out of the money, because you get cheap. You get into them cheaply. This was a trade in Oracle that we took, I think, in February for an UMCAT trade. We get in for $72, and options, by the way, are in pennies. 0.72 is what the option will show in your option chain, but you have to. It represents 100 shares, so it's $72. Okay, so we get in for 72, out for $1 to 125, 74% profit. This is where we get in. Now this is the key thing here. What's the institutions doing here? Okay, they're selling Oracle. We can see across. I mean, it's not hard to see that they're selling Oracle here, right? Selling it hard. And I'm looking for an entry. And I typically don't get in too early in the morning. I probably shouldn't see this entry, but this is where I saw it. It came up on my scanner. It's coming across. You notice it's right on the 8. Notice the 8 is below the 15. Bearish trend. Look at the high volume candlestick right here. Breaking off the 8. I'm getting in right at the 8 exponential moving average, and I'm getting a high volume candlestick when the institutions are selling, and they're selling like crazy, right? So I grab it here, and I get them for $72, and I write it down, and I get out right here. The candle gets small. I get a green candle here. I can see the momentum starting to wane. I take it off right here. So that was 1, 2, 3, 4, 5, 6. That's 35 minutes for 74% profit. So that's why I'm talking about how you can make money in these UMCAT trades if you're able to find them. Now, all I can do when I'm in the room is I can mention when I see one. But we have a couple of really good videos on that. And to really use these effectively, you have to learn the strategy and manage the trade yourself. I'll do some. I mean, I called a couple out today, but there's a lot of trades, and sometimes it can be extremely quick. Okay. Randall, is this recorded to you later? Yes, it is. Yep. Everybody who registered will get a copy of it. All right. So there is Oracle. This is a UMCAT trade in Oracle. This is one on Frog, and I point this out. This is not a normal UMCAT trade because this is not the normal kind of returns that you get. But I do want to point out that this is a trade I took, and it was trading about $45. I took a $39 put, way out of the money put on this, right? $39 put. So here it is trading right here. What's the institutions doing? You see it's chopping around a little bit. You see the momentum indicator? Selling, selling, selling. Starts to move up. So it's a little bit of buying coming in, then immediately goes to yellow as the oscillator turns down. And not only that, it's sitting right on the 8 exponential moving average where I want to get in, right? I want to, when it breaks below that, that's my level. And the reason for that is if it goes against me and turns around and heads back up again, I'm not going to lose a lot of money because there's not much distance between where I get in and where the 8 exponential moving average is. Okay, so I take it here and I pay $30 a contract. I mean, it's shocking, but I mean, I was $6 out of the money. But this stock really moved. And you can see the high volume, high volume, high volume. Look at these high volume candles, one that's stacked on top of the other. By the time I was 3 candles in, I was up 100% already. Right, so this moved down pretty quickly. That was like $1.50. And I stayed in it and stayed in it and stayed in it. And then I started getting these little candles, and I basically I got out because I hit my profit target. I was in at 30 cents. I was out at $2. Right, that's $30 in, $200 out per contract. Right, 10 contracts would have cost you $300, and your profit would have been $1,700 in about 40 minutes. So this is what I'm looking for to catch. Now that this kind of profit is not going to be normal. 100%, 80, 100% is fairly common. 500% very, very unusual. But this was a beautiful trade, and we had this in the room, and we caught it right when the institutions switched back to selling, and we got it with the volume that confirmed it. Okay, so now I'm going to go a bunch more charts here as we move along. What is the strike and what price was I buying it at? In this case, typically what I'm looking for, Richard, there's a little bit of subjectivity as to which strike you take. If I'm taking an UMCAT strategy, I'm taking an out of the money, in this case, an out of the money put. So which one did I want to choose? Well, you kind of want to choose one that you feel like the stock has a chance, the stock price has a chance to get in the money before it's over. So did I think it could get to 39? We're looking at the price action. I did think it could get to 39 because it started up quite a bit higher. So I took the 39, but you could have taken the 40. You could have taken the 41. They just could have cost a little bit more. So what I do is I look at the options. I don't really look at the delta on them, but you can look at a delta. But typically what I look at is obviously the expiration date is going to be the closest expiration date I can get. So that way they got to be at least weeklies. So I'll have a Friday expiration date. Then I look at the option activity at the particular strike price. That being, what's the bid and ask spread? Because I'm trying to get a tight bid ask spread here. And how much volume is there? Is there enough volume to justify it? And then I'll look up and down the option chain to find that. Okay, and it doesn't take but just a second to do that. All right, so there's the UMCAT trade on Frog. Okay, so the rules to trade by. Let's talk about what rules we trade by in the room. Right. Well, we got a couple. Trade the best and skip the rest. This sounds pretty easy. It's not. What's the best? Well, the best is A, you've got to have institutions in it. If you don't have institutions in it, you're not trading the best. You're taking a big risk. You're trading with retail traders for the most part. Trade the best, skip the rest. And this skip the rest is really important because think about something. When you're trying to make a trade, what are you trying to do when you're trading? You're trying to make money, right? What's the best way to make money? To take the very highest probability trade setups. What does skipping the rest do for you? You don't take trades that end up being overall losers over time. So this is just skipping the rest is just as good as trading the best because this puts money in your pocket. When you actually take a trade or don't take a trade and it would have gone against you, that's just as good as taking a trade. Trade the best, skip the rest. And our objective, and I point this out in the room every day, our objective is not to make trades. Our objective is to make money. And this is meant to focus retail traders on the fact that Taking trades is not how you make money. Taking high probability trades is how you take money. A lot of traders, when they're sitting in front of their computer, they feel like they got to have a trade on all the time. I mean, I'll sit there sometimes for 3-4 hours without taking a trade. And I got people putting trades up. I'm taking this trade, I'm taking that trade. And I'm looking at the trades. Why are you taking that trade? Well, this seemed pretty good. No, it doesn't seem pretty good. We don't want to take seem pretty good. We want really good trades. We want one that's going to give us an 86 to 90% win rate. So again, our objective is to make trades, not to make trades, is to make money. And I point this out in the room. This is meant to keep people out of taking too many trades. Retail traders make too many trades. Over trading is a very big issue for retail traders. Okay. How does the indicator identify if the volume is coming from institutions? You can't tell exactly where it's coming from, but with the volume strategy, with the volume profile that I've got in there, as far as when they're turning colors like that, for that kind of volume to be coming in, it almost has to be from institutions. That's the indication, because some of these things, some of these are going to be 150, 200, 300, 400% of 50-day moving average on the volume. And that's no way that retail traders can do that. Even big retail traders. Some people say, well, big retail traders can move the market, can't they? No, they can't. I mean, a lot of retail traders have $10 million accounts, $20 million accounts. The institutions are trading with billions, hundreds of billions of dollars. So that's how we know. Could it ever fail? Yeah, of course. You can get situations where, and I'm going to talk about how we identify which ones are the most likely ones. Okay. All right. Maintain discipline. Learn and follow the process. Learn the strategies. Learn that using the SPY super system. Learn the strategies. Get in at support. Get out at resistance. Take a trade when it breaks through the VWAP, etc. Don't trade when you're going to run up right against resistance. These are all fairly simple rules, but you'll need to learn that process and stick to it. That's important. All right, and remain patient. Again, all of this is meant to keep retail traders from overtrading. Please don't overtrade. Please don't take trades on something that you heard about. So many traders will trade stuff that they read about or heard about, and they have a bias on the market based on something that they read, and now they're trading what they think and not what they see. People ask me all the time, what do I think the market's going to do this week? I don't have any idea. I only care about what it's going to do when I'm trading it. That's it. All right. I'm looking at the technicals and basing it off that. I'm not basing it off of what somebody else said or what somebody wrote. Because let me tell you something, analysts, and I'm sure you see all the analysts, they put in all their blurbs. They get paid a lot of money to tell you about certain stocks. They're looking at fundamentals. They're looking at technicals. They don't know any more about predicting what the market's going to do than you do. Your guesses will be as good as theirs, because that's what they're doing. They're guessing. Havato, when the institutions entered, usually gets swept. Better wait until the market comes down again. I don't know exactly what you mean by that. It usually gets, when the institution enters, you get swept. They'll sweep you if they're coming in at the opposite directions. Yeah, bias. Patricia makes another good point. Bias is dangerous. You shouldn't really have a market bias unless it's a short term based on the technicals that you've got. Stock breaks up through the VWAP. It's got high volume. You're going to have a bias that the stock is likely to go long. That's a technical bias. It isn't really a bias. It's a technical indication of what the market's going to do. Okay. Profitable traders, we need an edge. As retail traders, we need an edge. My edge is I feel that like the SPY super system software is what gives me a big edge, right? Knowing what I just showed you, and I'm going to show a lot of these charts, knowing that makes a big difference, right? Knowing what the institutions are doing. Not very many traders have the SPY super system and have this information, right? So obviously it gives you an edge. Also, this is something most retail traders do not do. And this trading relative strength and relative weakness is not RSI. This is how is a stock trading in relationship to the SPY or the Qs. The SPY is moving sideways, and your stock is stacking green candles moving up. It's got relative strength, and vice versa when it's have relative weakness. These stocks are going to outperform stocks that don't have relative strength and relative weakness. So we want to try to find stocks that have relative strength and relative weakness when we're trading. We want to trade with the market trend if there is one. Today we had a market trend. We gapped up in the morning and we headed down for the afternoon. Then we just chopped all day. Buy near support, sell near resistance. Very important. I mentioned this, why you want to get in at support and get out at resistance or sell at resistance, because it minimizes any losses you take when the trade doesn't work. Okay. Patricia, fundamentally biased is exactly right. And I don't look at fundamentals. Day trading and intraday and short-term swing trading, fundamentals don't mean anything. Fundamentals take much, much longer. If you're doing an investment type service, then yeah, you've got to look at the fundamentals on the stock. Am I the same? David Wise on Real Day Trading? Yes, and that's on Real Day Trading Reddit. Yeah, yeah. I put a bunch of articles in there over the years, and yep. And Harry's a good friend of mine. Okay. How do we get an edge over the retail traders? All right. We only take trades that are being driven by the institutions. That's important. Trading stocks that have relative strength and relative weakness, and trade in the direction of the overall market. If you just do these three things, you'll be head and shoulders above about 95% of retail traders, right? How does it give us an edge? Our stocks will be supported by institutional buying and selling. We keep hitting this, right? Stocks will be outperforming the SPY, and stocks that are moving in the direction of the overall market. Those are the ones we'll be in. That gives us an edge over the retail traders. Okay. Okay. This is kind of just the logo that I use for the SPY Super System. It's two things. It means the software, and it means the strategy I use for trading indexes mostly. I do use it for stocks as well. All right. And the SPY Super System is used to trade the SPY, the Qs, IWM, as well as futures, and I use it for stocks as well. And when I say that, something called the Institutional Momentum Stock System. This is basically the same thing, except it's only for stocks. And the reason it's for stocks is because it has relative strength and relative weakness. You don't have that when you're trading the futures, right? You can't really use relative strength. I mean, you can compare one futures to the other, but it's not the same as trading stocks. So these are both exactly the same thing. But the institutional one, when we're trading the institution movement on stocks and we're having relative strength, this is the one where I would be using out of the money if I had high volume. That's what's going to make the difference. All right, I'm just trading in the money normally, but out of the money if it's a UMCAT trade. Okay, color codes in the system. We talked about this. Green is bullish strong, blue is bullish trend, red is bearish strong, and yellow is bearish trend. That's all the colors we need to see on this chart. There it is again. I'm going to show you a few of these as we move along here. Then I'm going to actually do some live charts. And if you're interested in having some stocks looked at, either day trade dice or swing trade, I'll put them up there for you. I'll show you some of the UMCAT trades we've taken in the last few days so you can actually see them. Right? But there it is. Same thing. This is what we need. Right? The daily chart's going to be a little different. It's going to have the same exact information, except current time frame will be based on the daily, one daily candle. The multi-time frame will be based on 1 day, 3 day, 9 day, and the long-term trend will be the same. All of these will be the same, except the VWAP will be gone. And I'm going to add the 50, the 100, and 200 simple moving average to the daily chart on the Thinkorswim here. All right, so there's the codes again. All right, now we're going to talk about the chart layout. I just put this in quite a while ago when I was doing the UMCAT trade. I added the 8 EMA because to me, it's a really important indicator. I've used it all my trading life. And then I created the high volume candles on the SPY Super System to show when stocks had high volume bullish and high volume bearish. All right, so this is a very big help as well. All right, so yeah, high volume candles, white for bullish and yellow for bearish. And we're going to use them in conjunction with the SPY Super System indicators. What we're looking for is institutions coming into a trade and coming in with force. That's what we're looking for. Sometimes you go several hours without anything coming in with force. Right, so there's again, you're looking at the same thing here. Now, how do I find these high probability trades? I've kind of alluded to this, all right? SpaceX, MSTR. Yeah, I can't post them yet. I need to get into the regular platform, the live platform before I do that. So just you can post those again, and we'll take a look at those. MSTR was a terrible, really a good short today. Okay, so this is the thing I tell all of my traders. When you look at a trade, now this is whether it's a 5-minute trade or a swing trade. You want to look at the daily chart first. Why do you want to look at a daily chart first for an intraday, a quick intraday trade? You want to see if there's any major resistance level nearby. That would be the 50-day moving average, 50 simple moving average, the 100 simple moving average, the 200 simple moving average. If the price is close to any of those and it's going to run into it, like if it's just above it and you're trying to go long, you don't want to go into it. The resistance is too close, right? So, but for swing trades, you've got to look at the daily chart. The daily chart for a swing trade is what's going to guide your trade. When you get into a swing trade off the daily chart, you should only be getting out of it on a daily chart. In other words, you get into a daily swing trade and you've got a nice support level down at the VWAP, not the VWAP, on the 8 exponential moving average or the 50-day moving average, and that's offering support. You're going to stay in that trade until that support is broken, right? Because that's only on the daily chart. So you stay in the trade. If you get in on the daily chart, you get out on the daily chart. On an intraday trade, you're getting in on a 5-minute chart, you're getting out on a 5-minute chart, right? Trade with the trend, both the stock and the market. Obviously, the best condition you can have is a stock with relative strength on a day when the market's moving up. Get your best of the stock and you're trading the trend. Then the SPY super system has to align. All the indicators have got to be telling you that the institutions are in there. All right, this is really important. You've got to have the current time frame momentum on 5 minutes, and on daily chart, you got to have the current time frame and multi-time frame momentum have got to be telling you that institutions are in the trade. Then we look at we take relative strength and relative weakness because maybe we find 6 or 7 stocks. Then we look at relative strength and relative weakness, and then we try to enter near support and sell near resistance. Sometimes you got to put an alert on or something to identify that. Let me just take a sip of water here. Get a little dry. Been trading all day, so. Yeah, I do talk in the room all day long, so I might get a little hoarse occasionally. Okay, so there's a probability trade funnel. This is the process we're going through. And we're going to talk about the UMCAT here now. This is the UMCAT logo. Basically, it shows a stalking cat on an up chart here. Could be a down chart, but it's basically just meant to indicate that you got to be quick, right? Cats are quick. You've got to be quick when you take these trades. You know how fast they strike out at something. This is what you've got to be when you take an UMCAT trade. You got to be quick trade. You got to be fairly nimble. But I'm not using tick charts, and I'm not using 1-minute charts and 2-minute charts. I'm using 5-minute charts. There's too much noise on lower time frames. Okay, so these are the results. I just kind of want to go over this. This is something that I started these in November 17th, and I wanted to track it. I track them easy, and these are all trades that I take. Remember, I can't call these. I can call them out in the room, but I can't post them. I can tell you what I'm taking. So I never include any of these results in my profit and loss for the room or for the alert service. These are all mine, but I can show you how it's performed, right? But when you see the results from the room, and I'm going to show you those, don't think that any of this stuff's included in there. It's not. These are completely separate. All right, so I had 170 wins and 27 losses, 86.2% win rate from November 17th to February 11th. Profit factor of 5.21. If you're not sure what profit factor is, you can Google it or look it up on AI, go to Copilot or whatever, take a look at it. That is a huge profit factor. Anything over 2 is a really high profit factor. Most of our normal trades that we take in the room run about 2.6 to 3 as far as profit factor is concerned. This was running at 5.2, and this is pretty hard to maintain. And so the profits on those trades are $17,900 based on $500 per trade. Right? That's all. These are low trades because we were taking out of the money puts, out of the money calls. Now, I did have a couple of trades in there that I had to pay like $600 because one contract was $600. But for the most part, it's $500. If it was 50 cents for the contract, you know, then I could get 10 of them. All right, now this was moving it back up from November up to April. I just want to show you the progression here. 333 trades, 286 wins, 47 losses. Again, 86% win rate. Profit factor was up to 6.11. This is, to me, this is almost impossible to maintain for a long period of time. And it's dropped down now to about 5.1, but still huge. So 5,000 invested at this point produced 30,000, a little over. Okay. This was up through May 10th. This from November to May 10th. This is a little AI that Rightline did for me, just showing the profits of 38,178. Again, risking 500 per trade, 86.5% win rate, 550 profit factor. Right. That's basically what it is. Now, again, these are very specific trades. You have to be all of these have to meet the conditions. All right, and this is that was if you did 2,000 a trade. Somebody asked me for this because when I do my results for the room, I assume $2,000 per trade. You've got to have something that you use. So I use 2,000 per trade for all the posted trades and the alerted trades. I say, okay, it's $2,000 per trade. And you know, we had the circle. It was like 620. So there was 3 contracts, right? And we made like 180 per contract. So you make 180 times 3 on that because you were risking 2,000. It was a little bit less than 2,000. It was about 1,800, but I used 2,000. This is what the UMCAT trades would have been if I put 2,000 per trade in there. I did not do that, right? Because I was trying to test this to see how this worked with keeping it low, keeping it $500. But that's what it looks like. Just all you do is take this and multiply it times 4. Okay, and this is up through June 16th. This is the latest one I've got. I didn't include the last few days. Again, 533 trades, 455 wins, 78 losses, win rate 86%, profit factor 511. 5,500 invested at 42,311. Notice this 86% win rate hasn't changed since November, since I started this thing. All right, so very, very impressive. All right, and there is a same kind of thing, same thing, 42,311 through June 16th. That's quite a long test. And anything I try to do as far as putting services in the room, as far as methodologies and strategies is concerned, I try to test them at least a couple of hundred times before I talk about it. I talked about it in the room, but I didn't start posting any of these or calling them up in the room until I had over 100 trades done. Okay, now this is something I want to talk about before we get into the specific trades. Okay, is the SPY super system and UMCAT trades different? This is how they're different. The SPY super system is typically when I say the SPY super system, I'm talking about using in the money puts and in the money calls. All right, that would be used for the SPY, for the Qs. If you're trading futures, if you're trading or even trading stocks. If you don't have the catalyst and the really high volume candles coming in, but you have a nice setup, then you're going to take in the money puts and in the money calls. That's the SPY super system. The UMCAT trade would be the same type of setups, but with high volume and a catalyst driving this thing up, right? So that's the difference here, right? And that's the 2 differences. UMCAT is basically using out of the money on very high probability trades, and they're very quick most of the time. And you typically only want to have one on at a time so you can manage it. All right, so I want to talk about the intraday and swing trading indicators. I'm not going to go into a huge amount of detail in this. I'm actually putting an additional video together on this for the room to go over all these. But if you're going to do intraday trading, here's the indicators we use. And we just talked about all of these, right? The SPY super system current time frame, momentum, right? That's the green line at the bottom, or the red line at the bottom. The VWAP, the volume weighted average price. That's a support resistance level. The ADMA, a support resistance level. The 15 EMA, a support resistance level, and high volume candles. Those are your indicators for doing intraday trades. That's it, right? I mean, that's really what you're going to be doing for intraday. You don't really care about anything else, right? That's it. Now, for swing trading, you're going to do a swing trade. Obviously, you're going to be looking at the daily chart. The SPY super system current time frame momentum and the SPY super system multi-time frame momentum have to match. They both got to be bullish or both bearish. Don't have to be the same color, but you either have bullish green or blue bearish, red or yellow. These need to match when you're doing a swing trade. Then you have on the daily chart, you have the 50 SMA, the 100 SMA, and the 200 SMA. Right? These are the three major moving averages that all the institutions use. Every single institution has algos that identify these trades. And that's why if you looked at the SPY today, it gapped up from this morning from the 50, came down through the 50, came back up to the 50, came down through the 50, went back up to the 50. And I don't know where it closed today, but I can feel it. I feel it probably closed pretty close to the 50-day moving average. And the 100-day moving average is another one like that, and so is the 200. Why do we use these? Because the institutions use them, right? We use these because the institutions use them. We use these because these are being displayed based on what is likely the institutions are doing, based on volume and trend. That's what's doing that. Then we have the 8 EMA and the 15 EMA on the daily chart as well, right? These are important, the 8 and the 15, and then high volume candles. And I'm going to talk about how we use these in trades, okay? Right, so these are the swing indicators to use. Using these key indicators for intraday and swing trading, for intraday trade indicators, SPY super system, current time frame momentum, right? First thing we look at here must be green or blue for longs, red or yellow for shorts, right? That's pretty easy. The VWAP, this is a key support resistance level. Price must be above the VWAP to go long, must be below the VWAP to go short, okay? Because the institutions, if you're above the VWAP and you're going short, the institutions are going to be coming in buying when that gets back down to the VWAP again, and you're going to be left holding the bag, okay? So it must be above the VWAP for long and must be below the VWAP for shorts. The 8 EMA, this is also a very key support resistance level. When the 8, and I mentioned this already, when the 8 is above the 15, the trend is bullish. When the 8 is below the 15, the trend is bearish, okay? This is important, right? Because if you want to know what the trend is, whether I should take a trade, is the market long or short right now, just look at how the 8 EMA and 15 EMA are lined up. When the 8 comes up and moves back up through the 15 again, it's likely going bullish. All right, now, again, this is more intraday indicators. This is important. And I don't know hardly anybody else that talks about this. The 15 EMA, right? This 15 exponential moving average. Okay, when the 15 EMA is below the 8 EMA, the trend is bullish. We just said that, right? When the 15 EMA is above the 8 EMA, the trend is bearish, right? So we know this. This is what's important. When the price breaks below the 8, right? And the stock is in an uptrend. In other words, the 8's above the 15. When the price breaks below the 8 in an uptrend, the 15 often acts as support. In other words, if you're in a trade and it comes down and breaks below the 8 and you're tempted to get out of the trade, wait to see what happens at the 15. Because this bounce off the 15 when the stock breaks through the 8 is very, very common. Very, very common. And the same thing when the stock breaks above the 8 in a downtrend, it hits the 15, it'll turn around and head back down again. It acts as resistance. And this is something I don't usually talk about in webinars because this is something I usually save for the room. All right, we talk about some of these specific strategies. This is very specific. And I don't know hardly anybody else, retail trader wise, that does this. But I can show you hundreds of examples when it works. Okay, and high volume candles. Bullish high volume candles are white, bearish high volume candles are yellow. High volume candles can indicate strong institutional buying and selling, and it's critical to have the high volume candles for UMCAT trades. You can't take UMCAT trades. You should not take UMCAT trades without high volume candles. That means instead of using out of the money puts and out of the money calls, you would use in the money puts and in the money calls. Okay, and this is what we're talking about here is more than just a webinar. This is actually a training exercise, and I'm going to go through some of these things when we look at them. But I want you'll be able to see this again. If you're in the room, you'd have a video on it. But for right now, I just want to introduce this to you. And I think some of this stuff is going to be news to a bunch of retail traders. All right, entering intraday trades. Enter longs on a price break over the VWAP or 8 EMA if the trend is bullish. Enter shorts on a price break below the VWAP or the 8 EMA if the trend is bearish. Okay? And high volume candles on the break indicate strong institutional involvement and increased probability of success. That's what this means. This is. This really isn't that complicated to do. It's just complicated to wait and get these setups. All right, so I'm going to show some examples of some Mooncat trades. Then I'm going to go to the live charts, and I'm going to let you tell me about trades you might want to look at. Right? All right, so here we go. This was an Mooncat trade. This was on SanDisk. I get in here. I get out here. You can see it green, right? So we can take an Mooncat trade. High volume, big high volume, coming above the 8 right here, right? Notice the 8's above the 15. We're above the VWAP. That's a long. It's been compressing. We take it right there. And the SPY Super System also puts these little arrows in here. These are called pop symbols. They indicate a break of compression to the upside and a break of compression to the downside on the blue ones. Okay? It gives you more impetus to take the trade, as the compression break is a good indication of a likely long trade or a short trade to the downside. Do you have any more questions here? What is the edge that the SPY Super System indicators has? Let's see. Can the trades be made without it? You shouldn't be taking the trades without the SPY Super System indicator. All right. If you're getting high volumes, for example, but the indicator is not, if it's getting white candles, but this is red, there's too much likelihood that that's just a one-off as far as those high volume candles coming in. So you're not having institutions. You don't have confirmation that institutions are in the trade. Could they work? Yeah, I mean, they could. But the point is, we're not looking for something that might work. We're looking for something that most likely works, right? Very, very important. Okay, and Patricia used the 9 and the 21. Yeah, I know a lot of people that use the 9 and the 21. I like the 8 and the 15. I think the 21 is a little bit slower. If you use like the 9 and the 21, and you try to use the 21 as a support level, like I'm using the 15, it's too far down. There's too much. There's going to be too much lost revenues as you wait for it to get all the way down to the 21. So it's at that point you might as well just take the bounce. You might as well get out after it breaks through the 9. All right. Yeah, the EMA to it. Yeah, you can do it, and there's nothing wrong with that. You can have the 21 on there as well. That way, if it breaks down below the 15, you got the 21 as support. But I'm out of the trade if it breaks the 15, and I'm in a bullish trade. Which time frame is better for this indicator? 5 minutes. 5 minutes is better for intraday trades. It's only one I use. For swing trades, daily chart. You have to use daily time frames. Very important. Hey, Patricia, checking it out because of me. Okay. Okay, so that was the trade here we took in 94% profit in SanDisk. This was expensive. This was not a $500 trade. SanDisk is you look at how much it was. I probably paid $2,500 for this thing, and made a good amount of money, but it was a big investment. Okay, this is the Intel here. I'm not sure if we looked at this one, but here's where I bought this right here. So green, high volume candles, but tiny high volume candles, breaking above the 15, breaking above the 8, breaking above the VWAP, pop out of the box, compression break, take it right here, write it up. I'm watching the VWAP to see if, and the 8 to see if it holds. It does, and then I took my profits. I got in right here. This is where I probably should have got in, but I didn't. This is where I actually took the trade right there. As it broke above the 8 with a pop out of the box, and I get out of it right here as it broke down. I didn't make a lot on that one, 13% profit, but I just wanted to show the trade, because you're going to get something like this as well. Netflix, beautiful one here, and Netflix was nice. In for $35, out for $70, out of the money. It was trading about $95.50. I think I took the 97 calls for about $35. And again, current time frame momentum right here. Institutions in blue, pop out of the box, compression break, white candles, up it goes, get out right there, right, for 100% profit on that. It doesn't sound like much, but that's a big deal. 100% profit is a big deal on these trades. All right, this is AAOI. Again, you can see it here. I won't have to go over all these. I want to go to some live charts. Get in for 208, out for $4 here. 93% profit. That's really nice trade. And Oracle, I think we looked at Oracle. Yeah, we looked at Oracle earlier. And we looked at Frog earlier. That was a big one there. All right. And this was one on Meta. I didn't show where I get in and get out. I just want you to see it. Obviously, we're going to go short. Look at this current time frame momentum. Everything's red. Institutions are selling the heck out of this thing. Where did I take it? This is likely where I took it right here. As it breaks below the 15 and the VWAP and the 8 right here, and I'm getting a blue arrow. That's where I would take it, and I would write it down, and this is where I would get out right there. Right, stays red. Notice it will switch back to bullish right there. Okay, so I'm going to look at some live charts. We're going to talk about how these work, and if you want, you can give me some stocks. We'll take a look at it. This was a circle trade. I just wanted to show you this is a circle trade we took yesterday. It's the daily chart on circle right here, I think. Yeah, circle. See, circle is a new stock. They've only been out, well, too short a time for these things to be developed yet. But the reason we took the trade on circle, as you can see, with yesterday, this is a daily chart right here, right? This is where we took it. You see how it's with this big candle here. It's not yellow. I wouldn't take out of the money, but we took it right there, and we get out to today. That little drop right there gave us from 6.20 to $8. All right, let's go back to the 5-minute chart. We can. I didn't trade this intraday trade today at all. Okay. Any specific risk reward rules? The videos I do on these UMCAT trades, I don't set risk reward based on percentages of dollars, right? If you're saying, okay, I'm going to take this trade off if I'm down 20% on it, what you're doing is you've just taken what was a good technical setup, right? And you've limited yourself to making money on it based on what your dollar's telling you. So you are trading your P&L when you do that, right? You got to be trading off of the technicals. Sometimes it works against you, but you've got to be able to use the technicals to make the trade and not your P&L. Okay. Yep. Here's a doubling in 30 minutes. Okay, Richard, you want ICE, AMD, and Microsoft. Okay, so let's talk. You want these on 5 minutes, right? Yeah, 5 minutes. Okay. All right. So let's take a look at ICE. I almost traded ICE today. ICE was a good short today. Right. So this is the end of the day. Go back and look at how it traded today. This is it this morning. Pulled right down with the rest of the market early on. This is where I was going to take it here this afternoon. I didn't take it, but I could have. You notice we went from right here, from buying to selling right there, and you see how we get a high volume candle right there, and it broke down below the 8. This is where I was looking to take it right here. It was 320. I had to do a webinar at 4, so I didn't take it. But you see how nicely that worked. Right, went from 126 down to about 124.50. You could have made some nice money on an UMCAT trade. And this is UMCAT because these are all yellow candles. You've got high volume on ICE. Okay, AMD. It was AMD. Here it is, the end of the day. I don't know if you wanted long or short. It was green for the day. Here's a big gap up on AMD. Pull down. I would never touch this here, right? Because you see, you got the 8 is above the. Everything's bullish here. You get bullish. You wouldn't want to take it here because you've got too much resistance level. You got the 8, you got the 15. This is a pivot point, so I wouldn't have touched it there. And it was very green for the day, so I don't want to go short. I'd be looking to go long on this. I didn't touch it. And I wouldn't. Any trades in here would have been SPY super system trades. There's no high volume, and you get a little bit of high volume at the end of the day. Okay, and Microsoft, yeah. Microsoft was a pretty good short trade today from this morning. Broke down early, right there. I don't take trades at 9:30. I usually wait till at least 10 o'clock. So this is where I probably, if I was going to take it, I would have taken it here. You got a breakdown here when it goes from green to yellow, breaks down right there. You could have taken it right there. You got this white candle, but remember this white candle, even though it looks bullish, it's not bullish because you notice it hasn't even gone above the previous candles open. And then you've got more candles, and this is where you would have got out right here in Microsoft. That was probably the best trade to take in Microsoft today. Okay. Hey, what's the trigger? The actual trigger for the signal? Break above, break below the 8. Well, break above the 15 or break above the 8, 15 or the VWAP. Mostly the VWAP and the 8, those are the ones I use. You have to look at the price action. Am I actively scanning for opportunities? Yes. Yeah, I've got a couple things. I do have scans in TC2000 that I have running, but this is the scan I use mostly for looking for these here on here. This is a cascading up scan. This is a cascading down scan. This is showing stocks as relative strength. This is showing stocks as relative weakness. This last one, these are potential long swing trades. And I've got with this for using daily charts and daily charts as well. If you want to look for swing trades that are cascading up. Cascading up means 3 green candles, 3 red candles. All I do is click on these and it brings them up right over here. And I can see at that point in time whether these are decent setups or not. I can see all the information. So I pop through these and I can find during the day. Now, in the end of the day, you're getting a lot of high volume candles, but you would just look through here and I have this sorted by the percentage change. You can sort by volume if you want. And this shows you what those look like. Here's ones that looks bearish. The space is Chewy. Chewy was a pretty good short here today. There's ICE that he just mentioned. Nice to see it pop right up there. Your ICE, you would have picked it up right here. Sony, CME. Okay. Okay. Anybody else want me to look at ones? I know it's running late here, so I want to move along because I do want to show you some of the results we've had with our trades. But I wanted to focus on this UMCAT trade and the SPY Super System trades for intraday trading because so many new people are going to be doing this thing. All right. Okay. Let me go ahead and nobody else wants me to look at a chart. I think I'll look at that MSTR because that was mentioned earlier. MSTR. All right, so this is MSTR today. This is a 5-minute chart in MSTR. Look at this. This is this morning. This is right at the open. I wouldn't take it on the open. It's too much risk. But it was pretty much bearish all day long. But because of this, if you took it here, see the big candle here, and it's going bearish. You've got to take in the money puts on this. You can't take out of the money puts. There's too much chance of the time decay killing you if you take, because you don't have the yellow candles on it. Okay. Do I think it's best to wait for a pullback before entering a trade? Generally speaking, Lakshmar, I do. But on UMCAT trades, you don't have to have pullbacks. You might have a move up, compression, and then some high volume candles that they're not really a pullback. But you do want to try to get in next as close to the 8, the 15, and the 45 as you can. Right? That's important. I'm going to look at something here. I want to look at silver. I traded silver short yesterday, and I'll show you why. All right, so here's silver today, and here's silver yesterday. All right, so here's the trade I took, right here, right in the afternoon, right there on silver. Coming down off the 8. Everything's red. The institutions are selling. So you see what it looked like earlier in the day. It was red for the day yesterday. And this is where the trade was. High volume candlesticks, breaking off the 8 with a pop out of the box and the institution selling. Perfect place to take it. I took it out of the money put. This, it was like 50. I took like a $51 put or something, and it moved down, and it made about 70% on the trade right there. And as soon as I get a hammer, that's called a hammer. When you get a candlestick that looks like that, that's a hammer. That means there's likely going to be a reversal. I get out, and you see they went to high volume candles, and notice it went right to buy right there. Which you wouldn't want to touch for long because you're still below the 8, below the 15, and below the VWAP. But that was silver. That's one I took yesterday that worked really nicely. NVTS was another beautiful one. So I'll just quickly show that. Right, this was NVTS just yesterday. I'm going to get these charts aligned. There we go. All right, so this is today. Here's NVTS yesterday. Right, Thursday, yeah. This is today. That's today. Yeah, we go back here. All right, so this was the NVTS trade yesterday morning. I took it right here about 9:50, pretty early in the day. It was after 9:45. It was okay. It broke below the VWAP. It broke below the 8. The 15 was already down here. The 8 was trending below the 15, so that's a bearish setup. Took it right here and wrote it down right to there, and that was good for 70%. on that NVTS trade. Now listen, these trades don't always work. Sometimes you'll get a candle or two and then it'll pop right back up again, because institutions are not in the things they're in and out, and you just don't know how long it's going to last. But then when they're coming in with volume, you notice that most of the times you get these big candles, you get some continuation on them. Okay. Laxam of the 45. I don't know what you mean by the 45. Richard, NVIDIA. All right, let me speed it up here. Again, I want to get through the rest of this, so I think I'm just trying to show some examples here. This is NVIDIA today. NVIDIA was weak today. Is there anything here? Only if you want to take a trade early. I don't take them early like this. First of all, you typically get a lot of high volume right out of the gate. Almost early in the morning, you almost always get high volume. And you can get burned or something like this. This happened to work. The rest of the day when NVIDIA was bad, something like this would be okay, but in the money, no yellow candles, right? These are regular candles in the money as it went red right there, and red and yellow. Okay. Looks like a signal shown usually after a flag pattern. Yeah, I mean, yeah, it has more confluence to support the entry. Yeah, and the flag pattern with a compression break is a good one as well. That's why that helps a lot. Sorry, I said to get in at the close the 8, 15 on the VWAP, not the 45. The 8, the 15 on the VWAP. Typically, the 8 and the VWAP are your key levels for entering these trades. As close to them as you can get. All right. Okay, I'm going to move along here because I know they want to wrap things up here. Let me just. I'm going to run through some results of what we traded in the room quickly, but I'm not going to spend a lot of time on them because our kind of results kind of speak for themselves. Okay, so let me pop through here. These are some more trades. I'm not going to go over there. This is what happens when people trade with emotion. You're looking at your P&L. This is what you look like when you jumped into a trade when it was way up too high. Now it's just turned against you. This is what it looks like when you've got a nice piece of software that'll tell you what's going on. All right, and okay, and the alert service, just so you know, it's designed for day trades and short-term swing trades. Day trades would be longer-term day trades. You're not getting UMCAT trades or SPY super system trades on the alerts, but you're getting a lot of swing trades and maybe trades that we get in 10 o'clock in the morning and get out at like 3 o'clock in the afternoon. Okay, these are only the highest probability trades. You don't get as many, obviously, trades in the alert service as we do in the room, because I can call them out of the room. This is the performance on the 2025. These are all the trades I posted. If you took the same trades as I posted them, this is what you would have done in 2025. Okay, about an 80-something% rate. All right, so these are the results in 2023. The room had entering 2,000 per trade. Now these are posted trades. These are not UMCAT trades or SPY super system trades. A little over 60,000. 2024, 55. 2025, a little over 55. It stays around the same. Typically at 2,000 per trade, this is what you're going to get for results. And it depends on how the market is. Trending markets will generate more profits than choppy markets do. This is this year, January through March 2026. Not a lot of trades. 35 wins, 8 losses, $5,800. That's not a big deal. This is below normal for the first 3 months of the year, right here. But I mean, obviously, it's still profitable. But this was April. April here. This was the alerted trades. We had 5 wins, 1 loss, $3,220 if you put 2,000 per trade. In April, we had 17 wins and 2 losses, 89% win rate. 2,000 invested in each trade produced 88.33. And this was May. Again, only just 13 trades, a little over 5,000. It was tough months trading, but you can see the percentages. This is what I want to point out, that you're getting 24, 25, 53. That's pretty high. 13, 15, 20. These are the kind of percentage you're going to get on your intraday, longer term trades and your swing trades, right? Because you're always in the money on these things. All right, and this was June. I've only put the last 4 trades, just 4 and 0, just $2,500 so far this month. It's a little bit different now. I've had a couple of other trades. We closed that. The one I told you this morning, we closed Circle for that was, we had 180 times 3, so whatever that is, about 500 and something bucks, right, to add to that. All right, and this is alert service trade through June 5th. This is just to show you the difference here in the alert service. It produced $7,664, 13 and 1. You're going to have losses now. You see losses. Believe me, please don't think you're not going to have losses. You are going to have losses. Okay. January, February, March, and April 2025. I'm not going to go over all these because I want to chop the time down a little bit. Just needless to say, you can see what the percentages are and what we do every month. Last June, I was on vacation, only had 11 trades. In July, I had a lot of trades. That was our best month last year, 16.8 for 2,000 per trade in the room. All right, so I'm going to zip past through here and just kind of get down to the offer so you can see what we're offering here. This is a SPY Super System trades. This is when I developed it. These are trades that I took on the SPY Qs and IWM. Back when I first started this 2 years ago, I wanted to post the results of what I was getting. These are my results. Everybody in the room can do it, but I can call them out, but I can't post them. They're too quick. Okay, and these are just some more trades. More trades again, you can see. So I don't want to take up the whole day here, so I want to zip through this. I think you've probably seen enough to get the idea. Is the trade room a separate service and the alert service? No, same thing. Now you'll see it right here. Right, so this is the live trading room and the text alert services here. That's me. I don't think I look that good, but anyway, that's me. Quarterly, if you get a 2-week free trial if you want to do the quarterly. I don't think 2 weeks gives you any kind of an indication of whether it's going to work for you or not, but that's what it is. And then after that, $5.98 a quarter. That gives you the text alerts. It gets you in the room every day. Room's open from market open to market close. You get all my options. I've got about 32 videos. I'm going to be adding another one on those indicators that we just talked about today, how to use them together. And then you get the Discord chat room. We have 2 other professional traders in there. That's the quarterly. The annual membership, obviously, is a lot cheaper, $17.98 a year. You get all exactly the same stuff for the annual membership. And then lifetime, if you want to get in and just don't have to line up again ever, sign up again ever, $24.98 gives you all that. Right, so that's the text room, the trading room, and the text alert service. Right. Any questions? Call Rory. Now for the software, SPY Super System software. That's the software we just talked about. It gets loaded on your Thinkorswim platform. Don't have to trade on Thinkorswim. Just trade on however you want. I trade on Tradier, but I have my indicators coming up on Thinkorswim. Again, this gives you the SPY Super System software annually. You get a month in the live trading room if you buy the software for the annual. You get the market scanners I showed you. I didn't go into a lot of detail on the scanners, but just kind of show you how they work. You get all of videos on how to trade, the strategies that we use, all the indicators, how to use them. I've got a lot of in there. I've got a video on the 11 most common mistakes that most retail traders make. And you'll get the installation done by Rightline. They'll take over, unless you want to do it, but they take over your machine and put it on there, and it'll look exactly like mine. Right? You'll have the same indicators, the same scans, everything. Or you can buy this one time, so you'll own the software forever. $19.98. You get to keep it forever. Any updates, obviously, you get updates whether you're annual or one time, but any updates that we make changes, you will get on that as well. All right, so those are the options. I think Rory has posted something in the chat box somewhere. Yeah, and in the Traders Corner, there's the links to these 2 options are out there. This sale ends Tuesday, so you can click on them. Go and click on the drop down there in whatever this is called, the chat box. Yeah, it's showing up, so you can do that. You can call Rory at 786-732-4656. Tell him you're interested in either the text alert service or the trading room or the SPY Super System. This thing is I can't tell you how important this piece of software is to me, and is how much it improved my trading. Even when I was a professional trader, I had about a 78% win rate. This moved me up to 88%. It may not sound like a lot, but let me tell you something. When it comes to P&L, it's huge, right? So this is for the Super System. This is for the text alert service and trading room. And I did a little kind of analysis on the annual subscription, 1600 max. That's if you were doing the, it's actually a little more than that. If you're doing the quarterly pricing. Anyway, average trade size 2,000. Assumes all the trades were taken. The results come back at 40x ROI. This means you're getting 40 times what you're paying for, what your subscription cost is annually, every year. 40 times is what it's averaged out. Again, ROI, high ROI, simple math, proven results. Disclaimer, past performance is not indicative of future results. We all know that. There's risk in trading. All right. Do we need the software? Subscribe to the quarterly or annual service? I have the software up on the screen all day long, Al. You won't have it on your own machine to use, but if you're in the room, I have it up on the room all day long, like the one I showed you. All right. This is what if you're in the room, this is what you see. You know, I have the SPY up there, or one of those trades that we were looking at. I put them up here, so you can see all of this all day long, and see how that's performing. So you can maybe a lot of people come into the room, and then they'll buy it later. All right, get the wrong thing here. There we go. And then they'll buy it later. All right, so there you can, if you have any questions, call Rory. If you have any questions here, you don't need it for now. No, you don't. You do not join the room. You do not need the software for now. It's something that I think is extremely useful for everybody. I think it'll make people better traders. But when you're learning it, if you're in the room, you'll be able to learn it in there, and you'll see me talk about trades, post trades. If you have a question on a trade, you can ask, and I'll bring the platform up with your trade on there, or with your stock on there, and we can look at it and see. Okay, that will get you going. All right. Anybody else? Any questions? I'm gonna end it here, and I'll let Anthony take over. Thank you, Anthony. Appreciate it.
Hey, thank you. I didn't leave you hanging this time. Thanks, David. What a tremendous presentation, and everyone was really interactive, so that was great. And a fantastic way to conclude today's summit. We appreciate your valuable education, generous offer, and your time with us today. David's special offer the link is in the chat box, so make sure you check that out. He is very good at what he does. And now it's time for what many of you have been waiting for, the Prop Shop Trader $100,000 giveaway. So let me just share my screen and show you that I've been working with the random number generator here. Let's see. Okay, great. All right, guys. So we're just gonna pull from this this area here, and these are not the winners just yet. I'm gonna do some random generations, and this will get mixed up. These might be the winners, but they're not the winners yet. So first, I want to see. Does everyone know where the react buttons are in the bottom left? If you do know where the react numbers are, just do me a favor and just, yeah, do that. Raise your hand instead. I know last time we did the thumbs up, but it was going too fast, and I think I might have made a mistake last time, and I don't want to miss anyone. So if everyone could just find their hands up, I'm going to give you a few seconds. And if you could see my screen here, just continue left. Just go left, and you'll see a hand, and then you'll see an arrow, and then click on that arrow. And then you'll see raise my hand. And I just want everyone just to raise their hand real quick, just so I know that you're here. It just makes it easier for me versus having to look at the whole list of people and everything else. All right. And also, I guess it gets everyone familiarized with the platform too, so that's good. All right, so what I'm gonna do here is I'm just gonna click, this time I'm just gonna click 4 times, and these are gonna be our winners, unless, of course, we have a duplicate or an error message. I had to remake this today because my last computer I had 2 computers crash in the last 2 months. I really have no idea why. And so I just rebuilt this little stupid random number generator, and so I didn't get any error messages. But if we get an error or a duplicate, I'll black this out. You know, whichever has a duplicate or something or has already been chosen, I'll keep choosing until there's no duplicates or errors. Okay. All right, so let's go. Hopefully we get it in one shot. I'm going to 4 times, and on the 5th time, I'm going to stop, and that'll be our winners. So 1, Didn't. So here we go. 1, 2, 3, 4. Let's see. Okay, so these are our winners here. Ken, AI Goose on Goose on Math. I hope that's a real person. AI, I think it is though. It says Stev and Balawa. You are our winners. So, all right, excellent. I hope that worked out better. I was just trying to reduce the confusion and not miss anyone or anything like that. So that's going to be our winners right there, a little bit faster, a little bit quicker. And that's it. So thank you. Thank you, everyone. Thanks for being here. And continue your great education here. And yeah, we ended on a really positive note. So, you know, good luck trading this coming week. And just continue your education because it doesn't stop. The markets are always trading, so we have to as well. So thank you, everyone. Have a good day.